products, crude, fertilizer, even electricity, all of them in very low single digits or even negative. In fiscal data that we got, November tax data, over there, the positive would be that tax growth, income tax growth is very high. Importantly, capex was fairly good for the month of November. I mean, it was about 20% higher than a month ago. But we have still not bridged the April-November capex. If you look at April-November capex, it is still 13% lower than April-November of 2023. So it looks like the government will not be able to reach its overall capex target. In terms of tax revenue, overall not very good, 0.5% higher. Corporate tax revenue is actually lower if you look April-November. But income tax has done very well. And that becomes important because that spurs consumption, hopefully. And GST number, I'm only taking CGST, that's not very relevant. We need the overall GST numbers. One hopes that is higher, but we have to wait for a few days to get that number. So growth signs look modest. You can't call them robust. And of course, auto sales due today, tomorrow will perhaps be the best lead indicator. What do you have for us?
Okay, let's just quickly recap once again the US markets, because Wall Street ended lower for the fourth consecutive session, but it was a languid, low volume trade. S&P 500 down close to about 0.4%, the Nasdaq slipping nearly 1%, but it was a remarkable year for US equities and US exceptionalism shown. For the year, S&P 500 is up 23.3%. Sorry, and 23 and 24 combined gives S&P 500 a 53% kind of a return. And this is the best two-year gain since the 66% rally that we had in 1997 and 1998. The Nasdaq, the AI-powered boom pushed up the Nasdaq index to close to about a 30% gain, though the Magnificent Seven accounted for more than half of S&P 500's 2024 return. And look at the way NVIDIA boomed. NVIDIA's stock price was up 170% in 2024. For the Indian market, yesterday was a flat finish despite the intraday recovery. The Nifty closed at 23,644, so still below our 200-day moving average. So resistance for our markets will be closer to 23,870, which is the 200-day moving average, going up to 24,000. On the way down, yesterday's intraday low of 23,460. So 23,460 to 500 should be the support or the markers you should have in terms of a trade. Flows, the DII's net bought 4,546 crore. The FI's net sold 4,645 crores. So pretty much evenly matched. But the FI selling in the month of December is nearly 17,000 crore rupees. And the total FI selling since the market made its peak towards the end of September stands at 1.85 lakh crore. Now, typically, January has not been such a kind month for the Indian market. So there is a seasonality associated with, January. And at least in the last 6 years, the Nifty has given negative returns in the month of January, ranging between -0.3 going up to 2.5%. And brace yourself for a roller coaster ride, at least in the first half, because lots of cues, auto sales, PMI numbers, quarterly business updates come through from banks, from real estate. So that should start trickling in this, starting this week. Corporate earnings, of course, the big one will be 9th of January, TCS, Trump swearing in, the Fed meet towards the end of the year, and first, union budget. So we're giving you cues till the 1st of February, but, it's going to be a very news-heavy, headline-heavy roller coaster ride for our market.
Oh, absolutely. I mean, it's extremely well put. Thanks for a nice wrap, Rima, of the things that are going to move January. January tends to be weak also because there are conflicting views about what will come in the February budget. So that has been historically one of the negative points. But I know some Januaries which were outstanding. And I think that was one of my first budget years, perhaps 1997, Vajpayee's year. It was a dismal finish, the 97 December, 98 in just about 13 trading days, we rose 25%.
Wow.
25%. Those days we tracked the Sensex.
This is why I love anchoring with you, because Lata, you give us perspective and history, which we've never seen.
Okay.
So it's,
some advantages of experience. Okay. But it's important that, January tends to be difficult only because people discount the bad news. And usually we have very good Februaries, the post-budget rallies. Remember, so many of them. But anyway, one day at a time. Let's look at some very important advice and comments that are coming ahead of the new year. Sanjeev Prasad of Kotak Institutional Equities gives us the equity call of the day. He says 2024 was a year of two halves. with solid returns in H1 and no returns at all in H2 for the market. He says 2024 returns varied from moderate large cap index to solid small and mid cap indices, while 2025 will likely start soft given expense. So valuations, continued consumption weakness, a wide range of possible US domestic and global policies and outcomes, and an unsettled global situation.
Sanjeev has also announced some model portfolio changes. He says they reduce the weight by 90 basis points on ICICI Bank, allocate some to IndusInd Bank. They remove Britannia and reduce the weight by 150 basis points on United Spirits and allocate 30 basis points each to Dabur and GCPL. They also remove SBI Life from the portfolio and allocate the same to HDFC Life and ICICI Pru. Sanjeev says they increase the weight in Adani Ports and Cipla by 50 basis points.
Okay, that's useful advice to start the day and the year. But we have more. We have a global expert, Matt Orton, Chief Market Strategist at Raymond James Investment, joins us now. Matt, good morning to you. It's really kind of you to join us on New Year's Day when everyone is having a hangover after the party. But first up, a very happy 2025 to you and your family.
Year to you as well. We're still a couple of hours away from that here in the US.
All right. Okay. In advance, in that case. Okay. Well, let's help us cast our eyes over at least the first quarter of 2025. Do you think we're going to continue to see US exceptionalism? I mean, dollars finished at 108.5 yesterday.
Yeah, I think US exceptionalism is going to continue. That doesn't mean that other parts of global markets can't do well. What it does mean, and I emphasize this to clients, is that selectivity really, really matters. This is where you can't just own an index fund to get broad exposure to emerging markets or international developed markets to help diversify your US exposure. You really need to be specific. And that's one of the reasons why I'm so bullish on India as kind of a satellite to a core US portfolio. But thinking just broadly speaking about why I'm optimistic about the market, because I am going forward. I think we're going to have a higher volatility bull market in 2025. We're already seeing what that's going to feel like, I think, over the coming months. And in particular, as you highlighted at the opening of the segment, there's a lot of uncertainty right now that we need to work through earlier in the year. There's uncertainty with respect to geopolitics. There's uncertainty with respect to what the US Congress is going to look like. We have earnings coming up. But the fundamental backdrop is still very solid. I think in the US, we're going to see continued strong earnings growth. I think we're going to see a resumption of earnings growth in India. And I think all of that provides a buying opportunity for investors on weakness, and that's what I'm encouraging clients to do.
Matt, since you spoke about geopolitical, in a message that Xi Jinping has given as his New Year message, he said no power can stop China-Taiwan reunification. That's quite a stern message. And considering that Taiwan is the sort of the epicenter of everything related to AI in Asia, how would you read this statement and what are the implications?
You know, Rima, I think this just adds to the mosaic of uncertainty that we have from a global perspective, and it keeps investors on edge. But we've seen the saber rattling before. You know, we've talked at length in the past about why I don't like China as a long-term investment and why I think it maybe is a tactical trade at best. But China has a lot of serious domestic challenges that it needs to deal with before I think it can worry about invading Taiwan or finding a way for reunification. And we're seeing those issues continue to play out. The government refuses to still implement a bazooka kind of fiscal stimulus package that's going to give investors and consumers alike confidence in the path forward. So I think China's a wild card, but I don't think it's a wild card from a geopolitical perspective. I actually think it's a wild card from a global inflationary perspective because we are all benefiting from China exporting deflation to the rest of the world. So I often ask myself, and clients ask, well, what could happen with China? I say, if China's successful and they start to get their economy moving into a higher gear, I think that actually poses more of a risk to the long-term investment perspective, because it's going to force central banks to maybe not ease as much as we're expecting. But that's not my base case. I think we continue to see weakness in China, again, a reason to move to India for emerging markets and remaining overweight in the US.
Now, I take your point. Macro disinflation coming out of China is very good for India as an economy, as the macro economy. But try saying that to Tata Steel. You know, Bao Steel is selling, according to the Tatas, they're selling steel at $50 less than their own cost of production. Forget the Tatas. And likewise, the chemical companies will tell you that. So Chinese disinflation can really hurt at a micro level. So let me boil it down to stocks. Yesterday all day we were speaking about the winners of 24. Now, the big winners have been these assembling companies, those who are trying to get into the global value chain. The Keynes, Amber, Dixon, who are, assembling plants for iPhones and laptops. They're the best performers. Do you like them? And the other set of best performers have been the e-commerce companies, the Zomatos, Swiggies, all of them. Would you like this set? Would you pursue them despite their triple-digit gains?
Yeah, I'd be a little wary because of the triple-digit gains, but that's why you risk manage your portfolio, right? You don't let your winners become too large of a position, and you also try and diversify into other maybe secular growth winners, like some of my other favorite names, like a Mahindra, ICICI Bank. Those are long-term winners, in my opinion. But that push for supply chain diversification from a global perspective, particularly away from China, that's only going to continue and pick up even more once we start to see Trump tariffs unfold, which I think we're going to get a picture of what that looks like very early in his new presidency in January. I also think there's drivers in India itself, a push to the more manufacturing, increased manufacturing in India by Modi. I think that's going to also help a lot of those companies continue winning down the road. So focusing on domestic production, I think, is a really long-term, durable theme in India in particular. And it's also a theme I'm telling clients in the US to lean into, because reshoring is a very real thing that's happening. And so many industrial and machinery companies in the US are doing well as a result of that. So it all comes down to balance. So I think you can continue to hold those winners, but also look for areas of diversification, say in IT services, some of the tech consulting companies. They've done well, maybe not as well as many of the others, but as the rest of the world recovers, financials in particular, you're going to see that part of the market work too.
Okay, so for diversification, you're also looking at IT services stock. What else, Matt? And on IT, some of the global counterparts are trading at much cheaper and reasonable valuations compared to Indian IT stocks. Is there a preference? Because, one of the guests we were speaking to yesterday, and he says he would prefer global tech companies over Indian IT companies.
Yeah, I think when I look at a lot of the trends, say in Infosys, for example, I think you have to look into who their consumers are. And this comes back to that concept of selectivity. It's not enough anymore, I think, to just paint a broad brushstroke for an industry or a sector in particular. You really have to dive into the fundamentals. And so I think if you want to own some of the IT services name, number one, I want to see better free cash flow generation. But most importantly, I also want to see more visibility into the earnings trajectory going forward. And to me, a lot of that's going to be generated by asset management firms globally, as well as global financials that are leveraging a lot of IT services and Indian IT services in particular to help outsource and provide a lot of additional support, helping them integrate artificial intelligence into what they're doing. And I think you see that with a handful of Indian IT companies. So I think that continues to play well. And, you've seen a rally as well. I'll call it fintech more broadly speaking, but say a 197 that's got Paytm. They have more cash on hand after the PayPay sale of their stake. And I think looking at where those companies are going to spend money going forward is going to be important too. How can they help to invest to continue to see earnings growth, especially if they do get a better regulatory regime going forward? So there's definitely a lot of opportunities, but it's that whole concept of knowing what you own that's going to be, I think, very, very important to success in 2025.
Okay, well, let us not throw sectors at you. You build a model portfolio for us. Say for an ab initio investor, what would the picks be?
So I think, first of all, you're going to want to have a core overweight. If we're going to be a global investor, you're going to want to have a core overweight to the US. And I think owning even something as simple as a SPY or the ETF RSP, which is an equal weighted S&P 500 ETF, I think that gets the job done very, very well for the US allocation, because I think breadth is going to continue to play out. I think to hit your global allocation within India, I think owning companies like I'd mentioned before, I really like ICICI Bank to handle your financials and traditional banks. HDFC Asset Management is another name that is certainly worth keeping on your radar and having a stake in. I think Mahindra & Mahindra is the prime asset in the auto space. That is a name where you're seeing not only continued growth due to vehicle launches, they're in a very favorable space with vehicle launch, but they're also seeing growth in their farm equipment business, and they get the royalties from the other more diversified conglomerate of Mahindra. So that's a name that I think hits a lot of different parts. I like Infosys, Tata Consultancy as well to kind of round out the IT services picture. And then on top of that, a name like Adani Ports as well, I think gets you some exposure to the infrastructure theme. That has sold off in sympathy with, I think, cyclical slowdown in India, as well as some of the research and the DOJ probe earlier this year. But I think that looks very interesting, especially if we see a re-acceleration in India moving forward.
Okay, yeah, and India, of course, has its eyes peeled on port and import-export gains. So, yes, take your point on port infrastructure. Thank you very much, Matt Orton. It's a pleasure speaking with you, and thank you for filling us with a bag of goodies for 2025. I hope you have a brilliant one.
Great to join you. Thank you.
Okay, so that's the word coming in, still very positive. Just, yes, US exceptionalism continues, but that doesn't mean other markets will not have very good investment picks, and you heard that list. Well, what have we got lined up today?
Well, these are the corporate interactions that are lined up for you on the show. So first up at 8:35, we've got Peter Maguire of XM Australia joining in to discuss his outlook for commodities for 2025. At 9 a.m., we have Bhavesh Shah of Equirus Capital to talk about the primary market action in the year gone by and how things may pan out next year. At 9:20, Sameer Arora of Helios Capital will be our market master for the day. 9:30, Sunil Singhani of Abacus Asset Manager will talk about markets and the outlook. Following that, B. Bhaskar of Kim's Hospital will be chatting with us at 9:40. A little later at 9:50, Sanjeev Singhal of Mazgaon Dock Shipbuilders will join in as the Ministry of Defence signed a contract valued at nearly 2,000 crore rupees. And towards the end of the show, in our special segment, It's the Economy, Lata will chat with C.S. Shetty of SBI to discuss his outlook for the banking sector.
Okay, that's a long list of very important people. So don't miss, even if you are a bit bleary-eyed. We're going to go into a break, and here's the list of top stocks that are lined up for you, which are in the news. Plenty of them coming up for you. You'll definitely hear about gas stocks. I mean, after all, we've got a cut in ATF and gas prices. So all that are lined up for you.
Three, two, one, zero.
Okay, we're getting to our research team, which is standing by bright and early on New Year's Day. Guys, all of you, a very happy New Year to you. Winnie, let me start with you. Okay, only the two of you at the moment. Winnie, tell us, what are the stocks in your list?
Good morning and Happy New Year to you as well, Lata. Firstly, I'll start with the aviation names coming in. We have Interglobe Aviation as well as SpiceJet also in the aviation stocks in focus. ATF prices that have been cut in Delhi by 1,401 rupees per kiloliter, and now the new prices are at 90,455.47 per kiloliter, and this is in Delhi. Mumbai also the prices have been cut by 1,349 rupees approximately, and now the new prices are somewhere around 84,511 in Mumbai. Do not forget that for aviation companies, fuel cost accounts to around 40% of their cost, so big cost that comes in from these prices. Other than that, OMCs are going to be in focus. Why? We're expecting a bit of a red here. Now, 19 kg LPG cylinder prices that have been cut by 14.5 rupees. So the new prices in Delhi for this is 1,804 rupees. So a bit of a negative coming in on that front. Maybe that could then move on to the neutral side is what we're watching out for, because these price cuts happen fortnightly for these OMCs. Other than that, let's keep an eye out on Zomato and Swiggy, because everyone across India has been Swiggying last night for New Year's, whether it was party supplies, whether it was snacks, what they ordered. So what came in from the quick commerce side and food delivery platform, Blinkit saw the highest ever order in a day, highest order in per minute, most chips ordered, grapes sold in a day was in yesterday's trading session and yesterday's New Year day. Swiggy and Instamart too reported record volumes, surpassing last year's sales is what they highlighted, and they saw the previous peaks, which was Mother's Day as well as Diwali. They crossed that as well. So we're expecting a positive coming in from Zomato and Swiggy.
You know, so the reason why grapes was so popular, because I think, you know, if you eat grapes on New Year's Day, it brings you good luck.
Wow.
So there is some superstition. There is some superstition attached to that. But Vivek is now here with us for some more stocks in the news.
Well, good morning and wishing you and the entire team as well as our viewers a very happy new year. First up, quite a few stocks on the radar on the back of news flow. First up is my trip, like we highlighted yesterday. Nishant Pitti yesterday sold 1.4% stake out of the total 14.2% stake that he held in the company. This was done via block deal. The intention was to exit the entire stake, but only 1.4% was sold last in yesterday's block deal. The next stock on the radar on the back of order win flows is Kalpataru Projects. The company yesterday has announced that it has received projects worth a little over 1,000 crore rupees. This has been got both in the overseas as well as in the domestic business. YTD order inflows have now surpassed 17,300 crores. The order book well in excess of 60,000 crore at the end of Q2. The next stock on the radar is SJVN. The hydropower company is the one that is in focus. The company yesterday has announced that it has signed MOUs for multiple pump storage projects, and this is in the state of Bihar. So the company has committed to a total investment of close to 10,000 crore rupees in Bihar. Out of that, the main investment will come in the Hathida Durgavati PSP. Over here, the project cost is a little in excess of 5,600 crore. Daily peak energy is 6.325 million units, which works out to an annual peak energy of 2,308 million units. Levelized tariff is quite high, so that is quite positive for SJVN. Levelized tariff is 9.39 per kilowatt hour. Also have a look out for NCC, a smallish order win coming in, a little over 349 crores worth of orders that the company has received. This particular order has come in the building division. Order book very strong, over 52,000 crore at the end of Q2. Order inflow guidance that the company has given is close to 20 to 22,000 crore. This H2 implied ask is quite steep, given the fact that H1 ordering activity was quite muted.
Okay, thank you very much for that impressive list. When you look at these micro data, you do get the feeling that capex is not bad at all. Look at the number of orders, SJVN, NCC. But here are some more orders. Is it Abhishek has a list, Ireda and Nugent Software?
Well, to begin with data, they have come out with a business update. Disbursements are pretty robust over here. It's at 7,454 crores, which is up 67.2% on a sequential basis. Now, it looks like the tenure of the book has increased, and that's also aided the loan growth around this time at 36.5% YOY and close to 7% quarter-on-quarter. My calculation shows that disbursements to AUM ratio might have come in at 60.4% when compared to just around 29% in the previous previous quarter. With respect to Newgen, they have got various orders. One order is of 14 crores for 5 years for the credit automation services product that they offer. The other order is of 11 crores. That is for 4.5 years sub-knowledge and record management system. They have another order close to 15.64 crores for 2 years in terms of digital account opening, retail loans, ECM and collections as well. And then they have, last but not the least, one order nearly 21 crore for a period of 1 year for their remittance system business. Back to you.
Okay,
Thank
that's
you.
quite impressive.
Yeah,
And
Newgen won
Ireda-
orders even earlier this week.
Yeah,
or maybe
and
it was in last
Ireda
week.
is a renewable energy lender. So that means that again, like SJVN, means the power sector is still hungry for more funds and projects.
Here's a quick recap then of the top stocks. Stocks with positive news flow are Interglobe Aviation, Swiggy, Zomato, Kalpataru Project, SJVN, NCC, IREDA, Newgen Software. Stocks with negative news flow are the oil marketing companies and Easy Trip Planners. Now let's get to Manisha for a complete roundup of all the action from the commodity market overnight. Manisha, was there any action?
Well, Happy New Year. Very less action, I can tell you, in the international markets, for most of the important markets shut today. But you know what? For the first day as well, when you look at the weaker volumes in the markets, we have seen some starting trends on the first day of the year. Crude oil prices, for one, after ending 2024 as a second year of decline, and we did see 3% of decline in 2024, but 2025 has started with more than a percentage point of gain right now in the Asian markets. Well, it is about strong China numbers, whether it has been about manufacturing data and factory activity. That seems to be defining the first day of action here. In other commodities, we have seen strength continuing in case of gold. 2025 was the best annual gain since 2010, and we've seen 2025 start the year with $2,600 an ounce on the higher side. Prices did gain 26% in the previous year, and the markets have seen some buying support continuing here as well. The other thing that has seen strength has been silver. We've seen platinum prices gain up on the first day. What hasn't seen so well is the natural gas prices. After posting best annual gains since 2016 and gaining by 60% in the previous year, 7% of a decline in the Asian markets is what we're looking at. So clearly some profit taking coming on for this one.
Okay. Thank you very much for that, Manisha. In any case, natural gas saw some big spikes, so perhaps some correction was expected. But we have an expert who will take us through all that. Joining us now on New Year's Day is Peter Maguire, CEO at XM Australia. Peter, good morning. Thank you very much indeed for joining us despite perhaps the overnight New Year celebrations. And here's wishing you a brilliant 2025 from all of us at CNBC-TV18.
Thank you very much, Latha, and to the same to everyone there. It's a special place in my heart, you and certainly the CNBC team, Manisha, Rima. It's a pleasure to join you, and sorry about the cricket. We're 2-1, but let's say in the last test, it might be 2-2. So there we go, and Happy New Year.
Oh, thank you. We have put behind a 2024, which has not at all been kind to cricket fans, but more on that on another day. You can bring tears to my eyes. Well, perhaps a new guard is waiting in the wings, and the old guard will have to make way. More on that later. Tell us about, just about every commodity. First, let's start with crude. Are the big days over? I mean, China officially said that they have peaked off in terms of energy usage. So do you think that's, for an importing country like India, it's one worry less? We won't see it go beyond, say, $74, $75?
Well, I think a lot of things working through what we saw in 24 and building on what Manisha mentioned. In 25, I think we've got the President Trump presidency and what he's going to do as far as production. China, and as you mentioned, are they at the top end as far as consumption? What's going on from a global demand picture? Are we going to also see further strip outs as far as geopolitical tensions, Latha, and building that into the market? And then you've got the mighty king dollar running at 108. I mean, the price of the US dollar at the moment, 108.50 for the US dollar index. So stronger dollar, traditionally cheaper commodities. So that's the storyline at the moment.
So Peter, on the dollar first, where do we go from here, at least over the near term, to your mind, and what would be the key factors determining that direction?
Well, good to see you, Ruma. Happy New Year. I think
Happy New Year.
Thank you. Couple of things. Has the US dollar got the potential to hit a 110 handle? Now it's at 108.50. It's been an enormous trade to the upside, US dollar against everything. The Aussie dollar's been crushed. You've got a 103 handle for euro. You've got a yen sitting at the best part of 158, 157. So do we see intervention from Bank of Japan? And I think that the overall trend at the moment, there might be a 25 basis point cut by the Fed in May. So I think the dollar's going to build over the next month or two. And I won't be surprised to take a 110 handle out for US dollar and maybe even parity against the euro.
Okay. Parity against the euro. Okay. I think euro fell 8% this year. I think yen fell about 11%. So yes, it has been a period of dollar strength, but you think 110 is possible. But then it peaks off, you think? I mean, could we see it a sharp retracement? Or because Trump looks like such a binary event, would it peak off and fall substantially from there or just remain strong for 25?
I want to see, Alatha, I want to see how President Trump, I mean, the first 90 days, like anyone, a new CEO coming in, a new board coming in, he's got it's hard to keep up with what he's actually doing because there's so many moving parts to this. And as the chart tells the story, you've seen that yen. So there's been incredible volatility across the whole currency complex over 24. And I think you're going to see a build in the sense of US dollar because if you're not seeing a rate cut, and that's what they're penciling in, being in May for 25 basis points, then I feel as though it's going to be one-way traffic for US dollar, at least for the first quarter. So strap yourself in. I think it's going to be volatile, and I don't think it's going to be short of surprises.
Okay. Well, actually, the rupee has fallen the least. Just a word more. Yes. Peter, I wanted to ask you about base metals. I mean, that impacts us the most. So will the Chinese disinflation keep base metals cheaper? I mean, if you can tell us, copper, aluminum in particular.
Well, if I look at, first off, the likes of iron ore, Arthur, you're running at $100 a tonne, which is very, very soft pricing when you're thinking of what it was, that 180 level. Copper at about 87.50 at the moment. Aluminium's had a bit of a run up, and so has zinc, and so has tin. So we've just got to see, again, the appetite coming from China. You've got to see internal demand and, of course, the global demand for these finished goods. Are we going to see what's going to happen as far as tariffs being introduced? President Trump's key mantra is tariffs. So what impact is that going to have to the likes of China exporting all of these metal-ended products across certainly to the US and certainly across the world?
What about crude prices, Peter? In 2024, we saw Brent crude prices slide close to about 4 to 5% on the back of weak Chinese demand, which weighed on the oil demand. For 2025, at least in the first half, what is your forecast?
I think it'll be softer from here. I think first off, again, dollar, unless you see something dramatic happen from a geopolitical standpoint. So if things were going to escalate, then that's an uncertainty that just wraps across the whole complex. But I think that as far as dollar up, crude prices softer, President Trump going to increase production. So where's that increasing production going to go into the market? It's going to be cheaper prices, one would think. So it's going to be good for consumption and good for the consumer. I don't know whether it's got a sub 60, but I feel as though the mid 60s are going to be the home for pretty much crude leading into the next.
That's a headline. Peter, coming from you, that's a headline. If it's going to be mid 60s. So what would be your range and your average?
I think I've got to go to 65 as the starting point. I mean, you're at 71 for WTI at the moment. Lather, you're at 74 for Brent. But I think you're going to see softer prices. I feel as though the Trump administration wants softer prices. They want to cut in the sense of from an inflation standpoint and increase production. So that's going to be cheaper prices. Okay. The other side of it is, what does OPEC want to do as far as their maneuvering? And we've just got to work through that whole process. And that's why I'm saying the first 90 days are going to be critical to really review.
Got that. Softer prices. I like to hear that word because we are consumers. What about gold finally? That outstanding performance in the earlier part of the year of 2024, does that continue? What are your range and, again, an average?
Well, I wore the handkerchief for a reason. I think it was just extraordinary what we saw in 24. Manisha made reference to it as far as 26-odd%. It's just absolutely mind-blowing, and so is silver. So I feel as though that momentum will continue as far as there it is there. Boy, that's just incredible numbers. So you're going to see again, I think 3,000 is going to be the strategic point. Gold is sitting at 26.50 at the moment. Silver's running at the best part of 29.25 an ounce US. So I feel as though silver's got to hit that $40 potentially in 2024. That's what 2025, I should say. That's what many analysts are calling. And of course, gold at 3,000. Let's see then. Let's hold our breath and just see whether it materializes. But I feel as though it will.
Okay,
Peter?
3,000.
Peter, thank you very much for joining us today. Wish you a very happy new year. And we'll be watching the next test very closely and cheering for India. Thank you once again. We'll slip into a break. But as we do that, as we step into 2025, CNBC TV18 is asking some key questions. So how will the Nifty perform in 2025? What are the sectors and themes to bet on? Will the faltering GDP revive? Will the RBI start cutting rates? We'll ask the experts for you. So stay tuned for the most comprehensive market poll coming up at 9:20 a.m. today.
Need is very clear because we have already the programs announced. Chandrayaan 4 is announced. We have the Bharatiya Antariksha Station building is announced. Mission to moon and landing on the moon is planned. So all of this requires docking. Docking will start from tomorrow onwards. Many processes will happen, but final docking will take place possibly by 7th of January. This is the 99th launch of any launch vehicle from Satish Dhawan Space Center. So that's also.
Welcome back, and it's that time of the morning when we will have an expert guest joining us to parse the news that we have got overnight and to help us pick stocks for the day, for the week, for the month, for the year. Joining us now is Devin Choksi, Managing Director at KR Choksi FinServe. Thank you very much for joining us, Devin, and here's wishing you a very happy new year from all of us, me, Rima, and the entire CNBC TV18 team.
Thank you, Lata. Thank you, Rima. Wish you all very happy 2025. And we pray God that this year brings a lot more prosperity that we will ever enjoy in our life.
Devin, keep your WhatsApp messages coming. I mean, they're extremely encouraging. I enjoy those. Okay, let's start with the markets now. At this point in time, how are we poised, do you think? The year we thought we would have a 20% gain. But if you looked, as many people have pointed out, from June to December, we have not gone anywhere. We remain at that 23,600 mark. So has the time correction come and now the stocks will build up, or is there more of the time correction left?
So, Lata, the understanding is that on one side, we have got plenty of new IPOs which have entered in 2024. And probably the entire market segment got busy with this number of IPOs, including the institutional investors with the retail investors. Everybody seems to be, I think, overly busy with IPOs. Because these IPOs probably have given them the faster return than probably, I think, the frontline stocks would have ever given to them. And that is one of the reasons for which significant part of the activity has shifted towards it. When we looked at, I think, about 80 odd IPOs study that we did, and out of which I think somewhere around we made recommendation, we found that I think average 40 to 45% kind of appreciation has been produced by IPOs in the listing times, I think post-listing times. So certainly those who invested pre-IPO, those who invested as anchor investors, those who I think started buying after listing and I think exiting after the lock-in period is over, they have made phenomenal gain. This could be one of the reasons for which I think our market remains subdued as far as the frontline stocks are concerned. Frontline stocks, nothing wrong with the fundamentals as I see it. I think most of the companies have shown the performance, and at the same time, the valuation-wise Nifty 50 stocks are today quoting at around 20 or below 20 PE. Historically, it has been also seen that I think whenever the stocks have gone below 20 PE, I think the reasons have come from everywhere, and probably I think the market has started correcting or re-rating thereafter. I believe that I think that's where probably we are looking at 25. In 2025, probably you should be seeing a smarter rally in some of the large cap stocks, which are languishing currently at a lower valuation, but promising to produce better results going forward in these quarters as well as in subsequent quarters.
You know, Deven, talking about large caps, Reliance Industries slipped 5 to 6% in 2024, and it's only the first time in the last 10 years that Reliance Industries is giving you a negative annual return. So after having a subdued return last year, would Reliance Industries be one of the large caps you would bet on? And there's also talk about the Jio IPO.
Yes, I think that's more important. I think the clarity on the future listing of the Jio platform as well as the Reliance retail has been missing. And that probably, I think, checked the patience of most of the long-term investors, those who remain invested for a very long period of time. I think they haven't been finding that clarity coming from Reliance about when they would like to separately list these companies. Having seen the Jio platform reaching the annualized revenue base of 120,000 crore and EBITDA base of 60,000 crore, it is naturally expected that I think this company goes into a separate listing mode and provide the unlocking opportunity to those investors who want to unlock, I think, their investment as well. So from perspective of, I think, looking at this particular aspect, maybe the company hasn't delivered, and that's where probably some of the long-term investors, particularly the FIs, have exited the counter. That is what we gather. Maybe I think corrective course will happen in 2025, as I believe. And I think these two companies, Reliance Retail as well as Jio Platform, both these companies should be separately getting listed. And that's where probably unlocking of the values should take place for Reliance. Maybe patience is being checked at this point of time.
Okay. Well, to be fair, Rima and Devin, even in the US, the Dow has done only 12% this year. It's the NASDAQ which has done 28%. So it is like, if you remember, Devin, you and I were there to cover 2000 as well. It was all IT stocks. At that time, of course, it was the ICE stocks, and then we had some crazy valuations in the internet stocks. So this has been, as you pointed out, the magnificent 7-year, and therefore the smokestack stocks haven't done well. So, you know, with that backdrop, Devin, build a portfolio for us. What may be the winners of, if you're building for an initial investor, how should the portfolio look?
So, Lata, I think to us, the things remain, I think, pretty simple, not very complicated. We believe that some of the large cap companies, which are producing the larger part of the profits also in the entire listed universe, they are the ones who are available at the valuation which is compelling, which is attractive. And that's where we believe that I think larger part of the money should flow into. Maybe I think one would talk about companies like Reliance, one would talk about in some of the banking space, corporate banking companies, even large NBFC companies, including Jio Finance. Some of these companies have significantly large amount of deep value into them. And we believe that I think these are the companies who could possibly give you faster and better return in 2025. As much as I think we are seeing it, I think the profit performance of these companies are not going to disappoint. On the contrary, I think it is going to probably sustain and surprise on the upside in subsequent quarters. So we believe that I think the some of the large bank and BFC companies would be the right choice. Maybe if we start getting some positive news pertaining to the war-related situation between Russia and Ukraine, in my viewpoint, I think some of the metal commodity companies will probably have reason to go up, and that could be a contra-buy opportunity. Also, because of the fact that demand would increase from the global side as well, apart from India infrastructure story. More importantly, with the mixture of energy cost, I think, which is along with renewables, which is giving them some amount of tailwind from a profit margin. I believe that I think metal commodity companies could be another choice of companies which one could look at. And I think most importantly, renewable play, wherein the ancillary companies who are basically catering to the larger part of the power generation or power distribution activity, they are the ones who could possibly give you the opportunity to rally further, grow further, and make your portfolio gain further.
When you said ancillary, you mean power ancillary companies, right?
That's right, power ancillary companies. Yeah.
Okay, because that's what we were showing. Okay, then we got you right. Yeah.
Devin, sorry, did you say metals also?
That's right. Yes, I think we remain distinctly positive about the possibilities of metal commodity stock going up, because we believe that I think the demand scenario is going to improve from here on.
Okay.
But dollars on the rise.
Yeah, there may be, I think, a contradictory situation for a particular quarter or so. I'm not thinking that I think this is going to be a permanent feature. Maybe the markets have the habit to adjust over a period of time. So I think one will have to look around for the opportunity on a contra-buy basis as well.
Okay. We have a few more questions. Devin, may I request you to go and catch a cup of coffee while we take a break and come back and speak to our technical experts as well. We are not done with questions for you. Quick break, technical experts thereafter.
So we are going for the 100th launch and in the beginning of next year.
We are already in the process of growing our business in the domestic world. Especially the Indian defense is is picking up. There's a massive opportunity that we have yet to grab, and also the nuclear sector with the nuclear.
Welcome back. It's that time of the morning when we are going to get to technical trades from our experts, Mitesh and Sudarshan. First, Mitesh has joined us. Good morning to you, Mitesh. And here's wishing you a very happy 2025.
Good morning, Lata. Wishing you, family, and the CNBC viewer family, and the CNBC family at the studio. All of you wishing you all a very, very happy and a very blessed 2025. Coming to my index outlook,
Yes.
I have been maintaining some kind of a ranged bias, but keep a watch on 23, 550, 560 zones. We are likely to open around those levels as the GIFT Nifty is indicating. And if we start dropping below that, then good chance that we'll retest the lows of 23, 350. So it's mildly negative, but in case we don't see a follow through post the gap down opening, then we go back into the contracting range, which means that for the day we would have made a low around 23, 550, 560 zone. So I'll watch that level very, very closely.
Sorry, once again, what's the level you would watch?
23,550 to about 23,560. And on the Bank Nifty, I would just want to add, yesterday we hit the 200-day average and bounced back from there. So yesterday's low, or rather 50,600, 50,550 zone is a very critical zone. A bigger decline would shape in case we start breaking below that.
Oh, right. Okay, we'll keep both those in mind. Sudarshan has joined us. Good morning to you, Sudarshan. And here's wishing you a brilliant 2025 from all of us at CNBC TV18.
Yeah, good morning, Lata.
Okay, well, let's get to the index strategy for the year. I'm sorry, for the day and for the near term. What would your Nifty targets be?
But I'll start with the year. It does appear that we are in a correction, as we all understand. And once a correction comes to an end, then the markets usually build a base. That takes some time, maybe weeks, maybe months. So for the year, I think somewhere around the second half of the year, the Nifty should see real upside action, by which time all the corrections, all the base building will be over. That's only an anticipation. Obviously, no one knows what exactly will happen.
Yeah.
For the short term, we are in a downtrend. We broke 23,600. That support level was broken, and I suggested step aside. Now, with gap downs, it becomes very difficult to go short after a 100, 150 point gap. And in any case, a correction is difficult to short in the first place. The best way to trade in a correction, once you realize that we are falling, is to step aside and not trade the indices, focus on the stocks.
Okay, that's a fair point. Let's get to the stocks then. What are you watching today itself?
Well, I'm watching 4 mid caps, and all 4 of them are for buying. The idea is that, we keep on talking about buying on dips. So these are the dips. And if the stocks are outperforming, then adjust the stop losses and consider going long once the market stops falling. Britannia is the first one. My initial stop is 47.20. Escorts is a buy with a stop under 32.50. Godrej Consumer, another from the FMCG pack, which usually outperforms in a decline, is a buy with a stop under 1,060. And finally, from the IT pack, Syngene is a buy with a stop under 840.
Okay, it's good to hear a buy on Godrej Consumer as well, because that company had rattled us a bit with their bleak Q3 forecast. Well, Mitesh, what are the specific stocks you're looking at?
So, contrary to what Sudarshan has, I have more of sell calls. Okay. I have a sell on ICICI Bank with a stop at 1296 for targets of 1250. HDFC AMC, I think, is sitting right on the weekly pivot of 4180 and it's close about 15 odd points higher from there. So if it breaks 4180, 4175, take a short here as well with a stop at 4221 for targets of 4050. A buy on Balkrishna Industries for targets of 2990 and a stop at 2875. And finally, a sell again on Ambuja Cement with a stop at 543 for targets of 515.
Okay. Well, Sudarshan, since you are on buy mode, may I ask you whether you've looked at Nykaa, Zomato? I mean, usually they're excited around the new year, especially Zomato. Any of these stocks, is there a buy call?
Not for Nykaa, absolutely not. But for Zomato, I think so. It's a stock that should give a steady return. So it's a buy on dips.
Okay. Well, thank you very much, gentlemen. We are going to come back to you closer to the opening time at 9:10. For the moment, it's a break. We're going to come back. We will have the pre-opening rates with us, the first rates of 2025. We'll also have a guest, Bhavesh Shah, the Managing Director and Head of Investment Banking at Acquirers Capital, joins us to discuss the fundraising frenzy we are seeing on the IPO street. Stay tuned. We are back.
Demand increasing from at least 3 times from where we are now. So we want to kind of capitalize the opportunities in the nuclear and defense segment, and also to an extent space segment. So we are definitely looking at expanding to Indian market.
SME IPOs continued to make headlines this year as well, mostly for the eye-watering subscription figures that they generated, but also for some wrong reasons as well. Now, after nearly doubling last year, the BSE SME IPO index has jumped nearly 2.5%. This time around, gains of nearly 140%. Now, since 2021, the number of SME IPOs every year has continued to increase. Now, this time around, we had a total of nearly 250 companies going public, which are SMEs. And if that number is not enough, they raised a cool 8,700 crore rupees as well. Now, what is so special about this 8,700 crore? Now, that figure is the sum of the funds raised during the previous 5 years put together. Now, if that is not enough, the next figure is even more eye-watering. Now, these 240 SME companies that went public this year received bids worth over 12.5 lakh crore rupees. That in the
Welcome back. No cues to take from the Asian markets today. They're shut on account of New Year celebrations. But the GIFT Nifty should come up for you on your screen. Monday was a tough session. Yesterday, there was an intraday recovery. We closed flat. And the GIFT Nifty is suggesting the implied open is now down close to about 75 points. It's time now to get a handle on a few futures and options trading ideas. Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, is with us on the show. Chandan, thank you for joining in. Clearly there is no holiday for us, for the likes of you and me. But how would you approach trade today, and what would the strategies be?
Good morning. Thanks for having me. Wishing everyone Happy New Year. And we believe that 2025 is going to be a fantastic year. However, it may be more of sector and stock specific, but we have to understand and take the next leg of rally to generate alpha in life. So looking at the index first, we witnessed some profit booking in last couple of weeks, but the good part is that supports are intact at lower level. 2-3 data internals are supporting that lower zone could act as a bargain buying level. FI's long short ratio has come to 12-13%, which might provide some recovery, but it needs to hold beyond 23,850, then only the stability will be big. So as of now, we need to play the broader range in between 23,300 to 23,850 marks. Looking at the Bank Nifty index, it also witnessed some profit booking decline, moving in a narrow range with capped upside, but multiple supports are visible at 50,000, and this index is moving in a rising channel from last 2.5-3 years. So now looking at the selective stocks, first that is buy on lower slab. We have positive view on the most of the pharma name. Nifty Pharma Index is doing well, and Lotus Lab has the strongest name apart from Lupin, Ipca, Glenmark, Divisley. So recommending to buy on Lupin as it completed a pole and flag pattern, which has bullish implication. Rollovers were better, so one can buy with support of 593 for an upside target towards 632. Second trading idea, that is buy on Muthoot Finance. Price has retested its breakout zone, and consolidation breakout is giving the fresh leg of rally, moving in a rising support trend line, holding well to key moving averages. So one can buy with support of 2085 for target towards 2235. Last trading ideas, that is United Spirit. We believe that high speed will continue at the beginning of the new year. Has been making higher base. Momentum could continue. One can buy with support of 1600 for an upside target towards 1700 zone.
Okay. Thank you very much for all that. And Chandan, here's wishing you on my behalf as well a very happy 2025. Okay, so that's the word coming in on F&O trades that you can have for the day. And now, just a word on how the opening trades are panning out. It's starting off in the green. The implied Nifty close was actually in the red. But it's opening in the green. Let's wait for it to settle down. It's a bit too early to speak about any of the trades just yet. It's a little confusing. I mean, a DLF is down -1%, ONGC down 1%, and you have some, 2.5% on some other stocks. It's okay. I think we'll wait for the trades to settle down and use that time to discuss the IPO market, to discuss the fundraising. In 2024, actually, Indian companies raised a whopping 3.5 lakh crore rupees across 438 issuances. Bhavesh Shah, the Managing Director and Head of Investment Banking and Acquirers Capital, joins us to give us an idea whether the IPO frenzy continues. Well, Bhavesh, good morning. Thank you very much for joining us. A very happy new year to you. And tell us if the happiness continues for the IPO market in 25 as well.
Good morning, Lata, and wish you all a very, very happy new year. I think this year of 2024 has been exemplary for capital raising. I think because of 2-3 factors. I think the markets, of course, have been buoyant, but I think it's because of the domestic liquidity which has been coming in. We had situations where we were always dependent upon FIIs, but the last 2 years we have seen domestic inflows, coming in, and we're no longer dependent upon the FII inflows for the issues to happen, which used to be very cyclical. So we would have IPOs happening maybe 1 year in a 3-year time frame, but now we might have see more consistent IPOs happening going forward. So I think overall, I'm very positive about the coming year. I expect the flows to continue, and I'm looking at even on the supply side, the companies which are now coming are fantastic businesses, fantastic promoters, good business models, and they will want to raise capital, and there will be investors who will be wanting to invest capital. So I expect this trend to continue. Obviously, there'll be risks involved, but otherwise, I think that the way we're looking at it right now, the trend seems to be very positive for this year as well.
In the previous cycles, we used to always say that when IPOs start listing at a discount, that clearly means companies have gotten greedy and the IPO frenzy has brimmed over. Now we are not seeing that. Actually, we're seeing most of the IPOs make money even on listing day, even the ones that listed this week. So do you think, therefore, just the change of the calendar doesn't mean the IPO season is over, because companies seem to be behaving responsibly?
Absolutely right, Lata, and so that's a great observation. Why I think, what's happening here right now is the domestic institutions who are becoming more and more flush with funds, they are incorporating more and more stricter processes for their investment decisions. Gone are the days where you can actually call a fund manager and you can the fund manager himself takes a call to put in the money in an IPO. But now there's a process where the analyst gets involved, the consumer gets involved, the director gets involved, the IC gets involved, the fund manager gets involved, and it's a joint decision, because now the mutual fund industry, for example, is managing more and more money. So I think with that, the amount of diligence the institutional investors are doing on each and every IPO, A, to select which IPO to invest in, and B, the pricing. The pricing discipline is fantastic. I think I must compliment the mutual fund industries for that. And I think the promoters also, on the other hand, are realizing that IPO is not an event which has to be milked for getting all the valuations upfront. Their promoters are now viewing this opportunity or an event of an IPO as a stepping stone for value creation in a long-term journey, and it's just a milestone in the company's IPO, in the company's lifetime. I think the combination of all these factors have resulted in people or the investors making money, and which is in fact one of the major reasons I also believe that it lends credence to the optimism that I have in the coming year as well. At the moment these investors become reckless and their returns start falling, that is the start of the fall of the market.
Bhavesh, hi, morning. Rima here. So tell us, how are FIIs approaching when you go to them with a primary issuance or IPO as anchor investors? Because the FIIs have largely shunned the secondary market, buying in the cash market. So when you go to them, with the prospective IPOs as anchor investors, are they interested in it? Have they been? So of the inflows, what percentage of it, for instance, has come in from FPIs?
Hi, Rima. I think, what's happening is, as I was saying earlier, the FII money continues to be cyclical in India. They are there for a few months, they are not there for a few months. And depending upon their investment, sentiment, whether they're investing in India or not, their appearance comes up in the IPO. But what we are now seeing is the domestic inflows are becoming more and more stronger and stabler for an IPO to happen. We used to have a situation many, many years ago where the domestic investors will look up to the FIIs and set the price, and they will kind of dictate whether the IPO is happening or not. Today we are having a situation that FIIs are looking at the domestic, whether they are investing, what is the price they're investing, and then we'll be the followers. That's the general trend we are now seeing. I'm not saying that happens every time, but compared to what we used to see earlier, we are now seeing more domestic. So it's kind of a, if I may use the word, nationalization of investments that is happening now in India, which is the dependence on foreign investors is going down.
Okay, yeah. What are the big ones we should look forward to? I remember LG, right? LG is going to come, and HDB Financial. Any other marquee IPOs we should look forward to?
No, I think quite a few, Lata. My view is, I think a big chunk of, the internet companies which have raised a lot of private equity and will look to exit. Not a lot of them will have to, make sure that their business model pivots into something which is more profitable and growing. But a good chunk of IPOs in the coming year will be coming from these new age companies. B, I think manufacturing is another big area where I believe that there could be a lot of fundraising coming in, and consumer and healthcare will be another area that is where we see a lot of fundraising happening without getting into specific names.
Okay. One of the complaints of the IPO season that's just gone by and which is underway is that most of it is, for PE funds and promoters to cash out. We haven't seen too many. I mean, there have been exceptions. Even this week, there was an exception of people raising money for expansion. Would you see that as a negative?
I think most of the businesses, the way I think about this is, if a business needs a lot of capital, which is always dependent upon external investors, it's obviously a cash-hungry business. There used to be a time when there was a lot of preference for primary issuances and not for secondary issuances or offer for sales. But I think the investors are starting to think that if the businesses are cash-hungry businesses, they are not necessarily generating profits or not generating cash flows. So rather to invest in a company which is doing an OFS, which is a cash-generating business, rather than investing in a company which is only kind of taking up cash. But I see the question that you have is more around the expansion and the project expansion that we would have. I think we are expecting more and more of the fundraisers to happen going forward, which will be for expansion, more around the manufacturing space. Most of the other businesses and the financials, of course, there'll be a lot of primary issuances around that. Most of the other businesses, we are looking at companies who are absolutely fantastic businesses, throwing cash, generating profits. They don't need to really need to raise capital. And if they're doing an IPO more for other reasons which are beneficial from a strategic standpoint from the company, I think investors love lapping up them too.
Yep. No, I'm sorry, we are getting close to the market opening time. Bhavesh, it's a pleasure having you with us. Thank you very much. And for all the key takeaways from the conversation, the IPO boom is likely to continue. We're getting the Bajaj Auto sales numbers as well. It's flashing for you on the screen. But before that, let's just get the 9-10 calls going so that our technical advisors can get back to their day. Sudarshan, the 9-10 call?
Well, consider buying Escorts. Escorts is a buy with an initial stop under 32.50.
Okay. Mitesh, your 9-10 call?
Balakrishna Industries, that's a buy for targets of 29.95.
Okay. Thanks a lot for that. We'll keep coming back to you all, of course, later on in the day. For the moment, the Bajaj Auto sales numbers are not looking spectacular. Three-wheeler is good and the exports are good, but looks like the other December auto sales numbers are not. Oh, there comes the Escorts numbers. Again, that's a bit disappointing. I mean, this is a year-on-year comparison.
So Bajaj Auto's total sales are down 1% year-on-year at 3.23 lakh. It's lower than the CNBC-TV18 poll of 3.5 lakh units. So a miss on Bajaj Auto. Even for Escorts, the total sales are down a little more than 10% on a year-on-year basis. We'll get to the details of these, but for now, it's over to Vinny for Indigo and oil marketing companies.
Good morning. Yes, keeping an eye out on both these, the aviation space as well as OMCs. Now, aviation space, why? ATF prices have been cut by 1,400 rupees per kiloliter. This is in Delhi. So the new price of ATF prices in Delhi is 90,455 rupees approximately. Even ATF prices in Mumbai have been cut by around 1,349, and the new price now is around 84,511 per kiloliter. Do not forget that for aviation companies, this is important because major raw material is fuel, which is around 40% of their cost. So big amount comes in from this front. OMCs, why are we keeping an eye on this? Because the 19 kg LPG cylinder gas prices, they have been cut by 14.5 to 1,804 rupees, and this is in Delhi. So a bit of a negative for OMCs, while ATF price cuts is a positive for aviation stocks. So that is why keeping an eye out on both these sectors.
Okay. Thanks a lot for that, Vinny. Let's also get to, okay, they have, the Indian market ended with fairly good gains on the real estate space. So Nimesh is here to tell us more, is it?
No, I think we've got Winnie still with us
sorry.
for an update on real estate.
Absolutely. So we have the update coming in from Antique this morning. They've said that the Q3 sales booking may remain quite muted for AB Realty, Prestige Estate, Shobha, Suntech Realty as well as Kolte Patil. In the brokerage note, they're also highlighting that the Q3 sales booking are expected to remain muted. Why? Because they're expecting limited or lack of new launches. So that is something that could be impacting there. Now, in terms of numbers which are expected to do well and companies which are expected to do well, one is Godrej Properties, Macrotech Developers, DLF, Oberoi Realty as well as Brigade is expected to post good set of numbers. Antique is highlighting that Q4 FY25, they're expecting to see a surge in coming in terms of launches from AB Realty, Prestige as well as Sobha, and they believe that they're quite optimistic in terms of the real estate players that will be able to launch the remaining project pipelines that they have in Q4. So that is something that they're watching out for. Top picks being Oberoi Realty for Antique as well as AB Realty, and that is why we're keeping an eye out on both these stocks.
Okay, thanks a lot for that, Vinny. That's helpful. Antique is still positive on most of those real estate stocks, as you can see. We're just counting down for the market opening. It's not giving us any cue, the pre-opening rates. They are like kind of all over the place. The Sensex up about 0.1 and the Nifty flat as flat can get. But there goes the bell. And the first rates for 2025 are absolutely in the green. It's only 0.1%, but nevertheless important. And the Nifty Bank is the one that's a slightly bigger shade of green. Let's look at stocks that are doing well this morning. Well, Apollo Hospital, Adani Enterprises, Bajaj Finance, ITC. Those are the stocks which are starting with a mild green tick. I mean, it's just about 0.4. I guess the market is really looking for cues at this point in time. So no major cues, but Bajaj Auto, of course, has got the cue. The December sales are a little less than what the street was anticipating, less than the CNBC-TV18 poll. We were expecting a 3.5% jump. What we've got is a mild downtick in December sales year on year. So that's 2.4% down. Adani Ports a little bit has taken off, down about 0.6. ONGC, HDFC Life, Tech Mahindra, Britannia, all those stocks down just a smidge. I mean, you can hardly call it down. It's about 0.5% to 0.3% down on those stocks. Mid caps, any standouts?
Escorts, let's pull that up because the total sales have fallen by 10% on a year-on-year basis in the month of December, and year-to-date, which is April to December, also total sales are down close to about 0.9%, and Escorts is opened with a cut of about 2.7%. So we'll watch for the tractor sales from Mahindra and Mahindra too. M&M to begin with is on the back foot right now, and that's down close to about 0.5%. Outside of that, watch for Swiggy as well as Zomato, because as Vinny was saying, the New Year Eve orders were through the roof. They surpassed all previous peaks seen during the festivities. But the stocks have opened flat considering the kind of up move that we've already seen. But the news there is positive. Well, in terms of, it's very, very quiet, but in terms of some volume traded stocks, Vodafone Idea, but that's, flattish. Sagility is down close to about 4%. Easy Trip is still not having an easy ride. On day one, it's down nearly about 0.5%. SJVN, where they've entered into an MOU for nearly 10,000 crore rupees with the Bihar government. That's opened up with some strength. MobiKwik has a gain of close to about 3%. Suzlon is higher in trade. Travel-related stocks. So late travel news tech, I think it's called Ixigo. in terms of the platform that you would commonly use. That's up close to about 3.7%. Greaves Cotton, Wright, GMR Power, DAM Capital, Z Entertainment, Bajaj Hindustan, IREDA, where the disbursement numbers are out. These are some of the winners on day one. But very, very quiet. You know, you'd be hard-pressed to find stocks moving more than about 1-2% on either side.
Yes, that's true. It's rather a flattish market. The rupee is also opened lower and it's drifting lower. It opened at about 62, 85.62 and it's gone down now to 85.65. So those are the minor cues that we have to work with on a day when the world has decided to celebrate, but India has decided to work. Let's do one thing. Let's invite our market master for the outlook. Okay, do we already have Sameer Arora with us?
No, we have actually Nimesh, because remember that comprehensive CNBC-TV18 poll going, in terms of the outlook. So 2024, we know, ended with positive returns, about 8 to 9% on the headline indices, but about 23-24% for the mid and small caps. But the big question is, what's in store for us for 2025? Nimesh has done the most comprehensive market poll, and he joins in to give us the answers. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Okay, Nimesh, thank you so much for being up to the button early in the morning and giving us the results of your 2024 poll. Let's welcome our market master to analyze this and give us the Outlook 2025. Samir Arora, founder and fund manager at Helios Capital, joins us. Samir, first up, a brilliant 2025 to you from all of us here.
Thank you very much. And Happy New Year to you and Rima and all the people watching and everybody at CNBC and otherwise, all the Indians, of course.
Hey, nice to see you in the pink of health, Samir Arora.
I have to be colorful on day one because day one sets the tone.
You bet. Actually, if you looked at Nimesh's poll, clearly the market is going with what didn't perform this year should perform in 2025. Even the Dow, as Rima and I were discussing, Dow did only 12%, NASDAQ did 28% in 2024. And likewise here, the Nifty didn't do well, but mid-caps have done 26 to 30%. Do you think that trend continues, that we are not going to see the big boys, do so much?
No, so for me, the model, and actually for everybody, it should be like that, and maybe it is, that you take it from different pockets. You buy some stocks because they are growing well, but they have also performing well in the market, and some which are doing well but are cheap or value. And it is that combo of buying some financials and some of these high growth stocks that you're talking about, these food delivery or otherwise, or whatever be the new growth. Also, if you look at the FIIs, it looks as if FIIs are selling, but they are effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio from some of the older names that they may be having in consumer and auto and others, and buying into these new IPOs, which are, at least many of them or some of them, are offering high growth. So there is no point in ever talking about absolutely one or the other. Of course, you can have groups of sectors doing well and expectations of groups of sectors doing badly, but there is no overdoing anyone, I would say, because you really never know what fancy the market takes.
No, I agree. But, you're a veteran of, how many cycles in the market? Probably 30 years. So Correct. At this juncture, bhagta hua ghode ke piche hi bhago, EMS, e-commerce types, mid-caps. Put a larger share in the one that did not perform, HDFC Bank. I mean, you can't complain about the quality of some of these stocks, but not their best year.
So that's why we have, I think, a good description of these. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market. And you have more money than otherwise. And then you have these smaller, newer, faster growing where you keep a limit on each stock and you diversify across the different themes and have maybe, in our case, maybe around 15, 18%, but that also in 5-6 stocks. And it is that combo which lets us sleep every day without overly one. If you say you have to make only one investment and that one investment is the marginal new investment, then also there's an easy answer. It depends on what you don't have. If you are too much into small and mid cap, then it is better for you to buy a large cap, stabler stock. And if you are only into the old stodgy companies, even though they are promising to be okay, you need a bit of variety and a bit of higher growth, higher risk. I think it's, in the end, portfolio construction adds at least a few percentage points. Because I'm a fund manager more than an analyst, and I always say that construction has helped us. Otherwise, investors will come in to me and say, all my analysts are responsible for my performance. I say yes, but there was also this construction bit which I did. So I would suggest to everybody, you cannot.
So talking about your construction, Samir, hi, good morning, Rima here. You're saying only 15 to 18% of your portfolio would be in some of these smaller, faster growing companies, while 85 to 90% or whatever, 80, 90% would be in these large cap HDFC type bank. Okay.
No, the larger, well-known, these compounder names that were given, which spoiled their compounding immediately when that name was given, those are 50, 60%. These 18, 20% are these super high growth guys, which are these, 25, 30% and growing also, but making losses, maybe all these Paytm, Swiggy, Zomato types. And you still have a third group. No, these are the groups where you are discovering new companies and they might be a little valued a little cheaply, or their growth is a little high, but you're not expecting them to make 25 and 30% for 4-5 years. This could be indigene types or these smaller hotels or something, which are not also super well known, not super well ready in terms of quality and history, but they are promising. And we are trying to discover some of them. So there are sort of.
Do you want to tell us some of these stocks that you're discovering?
No,
like
we
Indigene is one.
Don't tell you any more, because now we are also separately in the mutual fund business. So you can see 100% of the portfolio every year, including the changes that the Indian guys make. And broadly, although I manage an offshore fund, because the research is common, many of these names will be there. But so you can see all of them itself. There's nothing for me to highlight here separately.
Okay, clearly since you manage global money as well, Samir, is there any chance of a global accident? I mean, not like the Lehman variety, but minor accidents like, SVB or something, which takes away 10, 20%, because we have a president who can do extreme things coming on Jan 20th.
Yeah, so right now the bet is that he will not. So first, let me talk about the US a little bit, global a little bit. People talk that the US market has gone up a lot. Actually, maybe 15 stocks have gone up a lot. And if you look this year, the S&P's returns 50% are from 7 stocks. So therefore, if you see the Russell 2000, which is like the mid-cap index, or you see the S&P equal weight index, where all these guys are getting extra weight, the returns over the last 5 years are 9-10% per annum, which may be considered good in dollar terms, but they are not wild. And those 15 stocks, which includes these 7 that everybody talks about, even more, you could do Spotify, Netflix, all these which have done very well. Those stocks separately look very, very good. We have nearly all of them except Apple, and they look very good separately. So the thing is, there may be an accident driven maybe by some policy thing, but I would think there is one risk, which big picture is considered positive, but in the small picture may be negative, which is that if really the US, because of Elon Musk and Vivek Ramaswamy and all, really are able to convince the US system to cut costs on government waste and all that. Now, that is a big part of the growth of the economy in the last few years, because the government spending, government deficit, all has led to this growth. And so if you cut that, big picture, it is supposed to be positive that government deficits are being brought under control and you are making the overall deficit sustainable. But it can lead. Now, but my hope is that these things don't happen immediately. These things are not as straightforward as Trump signed some tariff things. But by the way, separately, I think that from an India point of view, I think India has to make peace with China. I think India, for its growth, needs to not think that we are not going to let the Chinese in, we are going to compete with them. They are so far ahead in many things that there should be no fight on those points, because we have already lost those battles. We should let them in on EV, let them in on solar, do joint ventures, give control to whoever, whatever the rule is, or whatever works for both the parties. But you can't say we will discover and reinvent the wheel, because we won't let these guys even send their employees here. I think that is overdoing it, because that would be a waste of many years of the lives of India.
Okay.
Got that. So Samir, you spoke about that, how FIIs may not be putting money in the secondary market, but they are in the Indian equity market by participating in IPOs, QIPs, etc., in the other forms of fundraise that is taking place. Is there any more nuance to this? Is there a preference that FIIs are gravitating towards? Have you done any analysis on this?
No, so my big picture, I don't do all this analysis. I just interpret other people's analysis. But big picture, out of the 20 odd years, if you see all this data, there are only 4 actual calendar years in which the FIs have been negative. Okay. Now this year you can say they are sort of break even on an aggregate basis. Adding both primary and secondary. But you can draw this conclusion that the stocks and the sectors that they are liking now in terms of is basically what I was saying, that diversify a little bit away from the old sectors to a little bit to the new sectors. So that is one big picture. But second is not to think in absolute that the FIs are writing off India and selling India, because as you can see in the percentage years, you can see it in the years in which their flows are negative, that you can attribute it to something specific. In 22, the interest rates were hiked from whatever 0.5 to 5%, and there was a war. In 18, we had this crisis. In 13, it was that, then before Raghuram Rajan came, whatever the
paper tantrum.
28% or whatever, 19%, and the market fell 28%. And then one was 2008. So to take those 4 years and say, oh, FIIs, will they buy or not buy? Mostly you have to assume they will buy, mostly. Then if there's something specific, then they will not buy. But this year, because of a massive shift towards US, because of Trump victory, which clearly on the margin made money move there, and the currency dollar strengthening and all that, should not be taken as that every year on first day you say, will they buy or not buy? First day you broadly say they will buy, and then let's see whether they buy or not. Unless you know, of course, something specific which is negative, the general tendency would be to buy.
Got that. Samir Arora, always a pleasure having you with us, and particularly happy that you joined us on the first day of 2025. Have a brilliant one yourself.
Thank you very much.
Okay, from one market master to another, we also have Sunil Singhania, founder of Abacus Asset Management, with us. Sunil, good morning. Thank you once again for not letting the hangover get the better of you and be with us. Very happy 2025 to you from all of us here.
Good morning, and great wishes for a great 25 to you and all viewers of CNBC-TV18.
Oh, they'll be particularly happy to get it from a fund manager like you, Sunil. Okay, well, for starters, I mean, the same question that I asked Samir Arora as well. What is the philosophy a stock picker should assume? Bhagta hua ghoda ki piche, the one that's already performing for us, the EMSs, the e-commerce, the mid-caps, or do you go to the one that did not perform, the HDFC banks, ICICI banks, Reliances of the world?
So, I think the last 4-5 years have been pretty good, Lata, for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets has done much better. 24 also is similar. If you actually see, Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward, it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so, because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in, and valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoon's good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy that stock. And obviously when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start to have a bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250 you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed, and the markets as well as the economic environment being so dynamic, from time to time one ends up finding a few bets which you can look out for. So I think at this point of time what we are trying to do is in our funds which are like we have an all cap fund which is more a mix of large and mid. We have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much better than otherwise. And I think a little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like that Jyoti CNC, I think it was 300% or something above issue price. You don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy. And when interest levels are such crazy, you obviously will have in the near term, pricing also reflecting that. But, we are not here from a 3-6 months perspective, I think we have still not seen a major drawdown as far as the broader markets are concerned. The markets have been flattish last 6 months on the Nifty, but broader markets have been, I would say, pretty decent. I think once the valuations start to reflect the reality, that is when some of these companies, at least as stocks, would face a challenge. And the other thing is, Lata, what happens is when a company comes in for IPO, obviously there is a very limited history of performance in various cycles. And one is relying completely on the guidance given from a next 2-3 years perspective from the investment bankers and management, and no one gives negative guidance. Everyone's guidance is superb. So a company which has made 100 crores over the last 20 years cumulatively is expected to make a profit of 400 crores in the next 2 years. And you are willing to give the benefit of doubt till it comes. So I think let the result season start for these companies in the next 1 or 2 years. We'll know, how many of them end up doing better. But as I said, there are definitely good companies which are hitting the market, and there are companies which are maybe good but overpriced, and then there's a third lot which are not good and overpriced. So one has to be careful about the three buckets.
Yeah, absolutely. Sunil, tell us what could be the red flags that you would watch out for. I mean, not a worst case, but likely red flags.
So the good thing is that India still stands out. I am very sure that we will head back to the 6.5% growth rate. Obviously, Trump coming in will lead to a little bit of rhetorics. Obviously, he's known to speak a lot, but every politician speaks a lot, and not everything what they speak ultimately gets implemented. So once he takes power, who comes to power, we'll see what happens. But we are already seeing some movement on the currency side. Indian rupee has been resilient but still depreciated by 2.5–3% over the last couple of months. I think that movement has to be watched very carefully, because depreciating money will push back maybe the likely FI inflows which we are expecting in 25. The other red flag is purely earnings. I think as long as corporate India keeps on reporting earnings which are 12 to 15% year-on-year growth, I think the macro are pretty decent. We are heading to the next 4 years, 5 years of this new government. Hopefully the budget will be pro-growth, which always happens in the first 2–3 years of a new term. We have decent foreign exchange reserves. I think there is a lot of government spending which is lined up. Companies are quite optimistic. And we are also coming out of maybe a 12–15 months of a lull as far as consumer spending is concerned, and that should also come back. So I think we are heading to a nice 2–3 year setup. I think the only thing we need is the corporate profit to come back, and that also hopefully from March will come back. From a global front, as I said, rhetorics and talks would maybe cause near-term ups and downs, but I don't see a major issue even there.
But doesn't it worry you that urban consumption has been falling? I mean, not just the warning from Godrej. Did you just see the Bajaj Auto sales also down, about 1.5% year-on-year? Will that not be an issue?
So, there are segments, obviously real estate. Everyone was selling apartments in Bombay at 1 lakh and 1,50,000 rupees a square feet. Now there are only that many, Indians would be able to afford those kind of apartments. And suddenly, you have buildings coming in left, right and center. Everyone is going in for redevelopment. And there is going to be a lull at some point of time, though we are quite optimistic about the real estate sales, but I don't think prices can go further from here. As far as auto is concerned, I think auto in India, two-wheelers and four-wheelers on the passenger side, has never seen volume growth consistently of more than 5–6% year-on-year. So I think it's not a surprise. And the other thing which you have not to forget is that the number of players are increasing. So maybe the volume overall is growing at 5–6%, but the listed guys are not able to retain their market share, which is happening in a lot of places. I was speaking to a major tile company, and this is the segment is growing, but there are new players coming in from Morbi who are now selling in their own brands. So it is getting a little bit more competitive. And I think that is going to be the case. I think one thing which we should not forget, Lata, is that capital has been available in plenty, and hopefully that will be available in plenty. Now, capital raising is good for the companies, but we also have to not forget that it breeds competition. Because if a company is able to raise 1,000–2,000 crores of capital, the ability of that company to compete with existing players increases quite meaningfully. And we are heading into a phase where maybe the ROEs, which was 17–18% for Indian corporates on a consistent basis, might fall to maybe more around 15–16%.
Okay.
That's a good point. Thank you, Sunil, for joining in. So this capital breeds competition, and that could be a risk for some of these existing companies.
And not just that, I think, Sunil, it was such a beautiful 180-degree perspective on sectors, competition, unlisted competition, the India growth. Thank you very much for giving us such a nice wrap to step into 2025 with enough perspective and the optimism that India is a growth story. Thank you very much for joining us on Outlook 2025.
Get into a break. On the other side, we'll be joined by B. Bhaskar Rao of Kim's Hospital to talk about the next year. Oh, this year. Stay tuned.
To 9,000 crores. The SME IPOs were back in the news recently because of this company called NSE Infra, which became the most subscribed SME IPO of the year, got bids of close to 14,500 crore rupees and ended its trading debut almost double of its issue price. But is NSE Infra the IPO that got the highest bids this year? Not really, because Ganesh Infra World takes that title, getting bids worth nearly 23,000 crore rupees. It planned to raise 100 crores through its IPO. Others in that list also got bids anywhere between 17,000 crore to 20,000 crore rupees. Now, cumulatively, out of the 43 SME IPOs, on nearly 20% of the total SME issues this year got bids worth over 10,000 crore rupees or more. If NSE Infra was the most subscribed IPO this year, which were the
Welcome back. 70 points down now on the Nifty. At the index level, it's a third of a percentage point lower at the day's low. Banks are under pressure. ICICI Bank in particular is down over 1%. The Nifty Bank is down close to about 400 points. And Bajaj Auto continues to remain the top Nifty loser today on the back of disappointing December auto sales numbers, even though the company is doing very well on the electric two-wheeler side. But in terms of the pure, sales, auto sales, it's been a rough month. Sales are down 1%. But it's time now to get Kim's Hospital, that's the next management on the show, to talk about the business outlook and the key growth drivers going ahead. We have with us B. Bhaskar Rao, Chairman and Managing Director of the hospital with us. Thank you very much, sir, for joining in. So it took you about 4 years to double your revenues from 1,000 in 2020 to about 2,000 as of 2024. When do you think you will be able to double the revenues from 2,000 to 4,000? And what would be the key drivers to your mind?
So our expectation will be around in next 2 to 3 years, it will be doubled. The reason is we are doing more expansions, and nearly this year we are expecting around nearly 2,000 beds are going to come to operational. These are all, most of them are in metro, in Bombay and Bangalore. There looks like very high ARPOPs. With that, the revenue ramping up will be much faster than compared to the previous 4 years, because we were doing all these years in the tier 2 cities. Now in the metros, the ARPOPs are more. So we are very confident that it can be doubled in 2 to 3 years max.
Okay. And so this beds, you said 2,000 beds will be added this year in 2025, yes. FY26.
Yes.
What about, have you made long-term plans in terms of further expansion into metro cities or the number of beds that you would like to achieve eventually?
Next 5 to 6 years, we are planning to total from including these 2,000 this year. We'll be adding around nearly 6,000 beds, which comes out to be 10,000 in total by Kim's Group.
Okay, that's an ambitious plan. But let me get to the immediate year. So you said that you're going to add in the metros and therefore it won't be margin dilutive. But you've been doing good margins. The last one was 25.6%. In fact, H1 you did 27%. You'll be able to maintain that, or will at least in FY26 the margins fall because of the fresh capex?
The way we are looking at the margins may not able to fall, because the type of consultants we are going to tie up and already is going, maybe 1% or 2% short term, 1 or 2 quarters it may go down, but on the whole, it will be able to sustain the margins.
Okay. So what is your expected RBOP, the average revenue per bed from the, from Maharashtra, Karnataka, your metro cities versus your current RBOP?
See, in metros in Maharashtra, first time we are entering into Bombay, they are all looking into other competitors are doing around 3.5 to 4 crores ARPOPs. We may be always little down than compared to others, as we would like to keep that competitive, not competitive, to provide to good healthcare at an affordable cost. Even Bangalore is also better than Hyderabad. Today in our group, we have the highest ARPOPs are in Hyderabad city, whereas in Andhra, their all ARPOPs are very, very low. So with these two adding up Bangalore and Bombay, I think the ARPOPs increases and the margins also will increase there.
Okay, well, I think we have to explain to everybody who is not in the hospital business that ARPOB, a word which we've been using, is average revenue per occupied bed. So that's an improvement which helps hospitals, but too much of that hurts customers, hurts patients. But you all have had a lot of revenue coming in from Telangana, I believe 47%. Are the margins still good there? Will you see yourself being more of a non-Telangana player? What will that do to revenues and margins?
So as of now, the margins are good in Telangana, and as well as the whatever margins historically we are showing in Andhra Pradesh, that is also there. Even if you go to other states, the margins will be definitely better than Telangana. That's what even the present market showing there in those areas.
What are your occupancy levels, Mr. Rao? Percentage?
Right now, I think we are, because we keep adding about 60-65% on the beds in total. If it is a operational beds, we are around 70-75%. Whenever there is a need, we keep on improving because the entire capex has been kept for all those 100% beds. But whenever there is a need, we just only add a few more nursing staff and other staff that will be able to. We have still a lot more growth in the existing, that is in Telangana and Andhra. And moving forward, because the Bangalore and Maharashtra is coming, on the whole group level, the occupancy rates may come down for a 2-3 quarters. Because initially any hospital will take about 3-4 quarters to build up. By the time once it comes to in 4 quarters, again we'll be able to pick up the occupancy rates to what it is in the present scenario.
Yeah, that's why analysts were asking us to ask you about whether margins will fall below the 27% mark. Now, can you also tell us how long does it take to break even? For instance, your Nashik hospital, that's new. How long will it take to break even? Typically, how long does a hospital?
2 to 3 quarters max, the break-even point comes.
Okay.
Sir,
In even the same Bangalore and Bombay also, we are thinking around only 3 quarters max.
Oh. 3 quarters. Sir, since you do have plans to get to 10,000 beds in totality in the next 5 to 6 years from the current 4,000, would you be making acquisitions also?
See, mostly we are looking for a brownfield, semi-brownfield that is already running hospitals where they need our help. We are trying to acquire those things. And few already started as a greenfield projects, like all these 3 are Bombay and Bangalore are greenfield projects. Most of the Kerala projects are all brownfield as of now. Maybe we'll get 1 or 2. That's why we have talked about next 5 to 6 years. This 10,000 beds is a mixture of brownfield, M&As, and as well as the greenfield projects.
Will you require any fundraise, a capital raise?
So we have been seeing that next this beds, I don't think we may require any fundraise or internal accruals itself will be able to resolve. And the only thing is maybe 1 or 2 quarters we will be able to touch to EBITDA to 1:2. Debt to EBITDA is 1:2. We would love to keep it at 1:1.5. That is our goal. We will definitely will not cross that. But sometimes, because the opportunities are there, instead of raising the funds, maybe 2-3 quarters it will go up to 1:2 EBITDA debt ratio.
Okay. All right. Mr. Rao, we'll leave it at that. It was a pleasure speaking to you. Thank you very much for joining us. And let's hope you and everyone at KIMS have a great 2025.
Thank you. Wish you the same. Thank you.
Okay, so that's the word coming in from a hospital company that things are looking good and they're going to expand rather aggressively, I would say. A 2,000-odd bed hospital now getting into 4,000 in probably the next couple of years and aiming at 10,000 beds. With that, let's take a look at the markets. We haven't done that in a bit, and it's the Nifty Bank which is still struggling. The others are still down, but 0.25%. Nifty Bank is down 0.5%.
Mitesh is now with us for a few technical trading strategies. Hi, Mitesh. Sluggish, but with a downward bias.
So, again, the idea was that if we break 550, 560 zone, there was chance of a breakdown. The bank Nifty, it was about 50,500. The low for the Nifty is 23,560 and the low for the bank Nifty is about 54.85. So I think today's low become important markers. The structure is slightly on the weaker side, but in case we can hold on to today's low, then I think there can be a pullback on the half-hourly, hourly chart. So that could keep the market slightly healthier. But in case we see breakdowns, then I think we'll look at declining continuation, and then especially on the bank Nifty, a close below 50,500 450 zones would suggest a further correction of at least 1,000 points. I suspect could be more, but that's the minimum which I'm looking at. So the structures, we keep cautious, and I think keep monitoring today's low, I think, as important marker levels. On the stock side, I have a buy on Muthoot Finance with the stop at about 21.29, just below 21.30, and look for a target of 22.50 here. While a sell on Apollo Tires, I think that's something which is weakening. So sell on Apollo Tires with a stop at about 531 for targets of 505.
Okay. This week we have seen some big losses in Sagility. Of course, that's a new stock. Any of the metal stocks would you trade? NMDC's seen a bit of a bad week, about 6% down. Hindalco is down about 3.3. Do any of these interest you at all? Because in the morning you started off with a set of short trades. Are these lending to short trades?
The metal pack, has been weak for quite some days. In fact, if you look at NMDC, if you look at the last few days of price movement, after making a high of around 80.81, since the 12th of December, we have seen the stock price come down to 66. It's still weak, and for me, I think that's the case with most of the metal stocks. But given the fact that they've had some correction, here I would at least want to see some bounce back. So my entry point gives me a slightly better risk reward equation.
Okay.
Thank you very much for joining in. Let's get to the next corporate on our show then. Mazgaon Dock Shipbuilders. Just 2 days back, the company signed a 990 crore rupee order with the Ministry of Defence for the construction of units that allow submarines to stay underwater for longer. Sanjeev Singhal, Chairman Managing Director of the company, is with us on the show. Thank you very much and Happy New Year to you. First, if you could give us details about this order and the execution timeline.
Yeah, as far as the AIP plug is concerned, this has been developed by DRDO, but considering that MDL has constructed the Scorpion submarines, we have already delivered 5. The 6th one we are about to deliver, and we are likely to get another contract for 3 more Scorpion submarines. So these are this AIP plug is to be fitted in the existing conventional submarines, whereby the submarine is cut open. This plug is approximately 10 meter in length. So this plug is inserted in between and the submarine is welded again. So it becomes a much longer submarine, and it provides the capability to the submarine to remain in under submerged in water for 2 to 3 weeks. So this is a very huge capability enhancement for a conventional submarine. Considering that we are talking of 9 submarines of Scorpion make 6 as per the current order and 3 more which we are expecting soon. So this AIP plug would be sequentially fitted in almost all the submarines depending upon the success of the first project. So we expect a very healthy pipeline going ahead with respect to retrofitting of this AIP plug in the conventional submarines.
Okay, got that. Understood about submarines. Can you give us an update on your current order book? Out of this, what is your order book that will be for exports? And seasonally, since H2 is usually better for you than H1, what is the order inflow target that you have set for the second half?
As far as my order book is concerned, as on 30th of September, we are around 38,000 crores. Of course, the third quarter figures are still under finalization. So a better view would be available in a couple of days from now. Going ahead, as I said, we are expecting a significantly large value order in the form of 3 number of Scorpion submarines, which is a follow-on order for the 6 submarines which we are currently executing. 5 we have already delivered, and the 6th one is almost on the final leg of delivery. So we are expecting the delivery within the month of January.
Got that. So talking about your revenue, now Q2 was strong, 51% top line growth, the highest that we've seen in the last 5 quarters. Is that solely because of seasonality? Were there any other factors? And what's the outlook for the second half of the year? Do you think you could end with the highest ever revenue growth or numbers this year?
As far as 24-25 is concerned, we are expecting a growth of around 10 to 12% over last year. And going ahead also for FY26 also we are expecting a similar kind of a growth. But at the same time, as far as our projects are concerned, we were running 3 projects parallelly, Scorpion submarines P75, the 15 Bravo destroyers, 4 in numbers, and 17 Alpha frigates, 4 in numbers. As far as 15 Bravo destroyers are concerned, we have completed this project in the form of the last delivery. Of course, certain liabilities are pending and B&D spares, which we will be supplying over next 4 to 6 quarters. 17 Alpha is progressing. We have delivered the first vessel of 17 Alpha. Balance 3 vessels will be delivered over next 2.5 to 3 years. And project 75, which is 6 number of Scorpion submarines, we have already delivered 5, and we are on the verge of delivery of the 6th submarine. And moving ahead, we are looking forward for 3 more submarines of the same projects, follow-on submarines. So this should be giving us a continuous pipeline of projects and executions. So we don't, moving ahead for this year as well as for next year, we are expecting something between 10 to 12%, 13% growth.
Okay. Well, now let's come to your margins. You had guided for a 10 to 12% EBITDA margin range for FY25, but brokerages are expecting the higher margin to sustain even going forward. That is actually for the next 2 years, FY27, because major deliveries are planned over the next 2 to 3 years. Where do you see margins after this year, after FY25? And also, are you sticking to the FY25 guidance?
I have been maintaining and I continue to maintain that as far as this industry is concerned, a 12 to 15% margin is a very healthy margin. There has been a certain uptick in our margins in recent years, primarily because these are very long gestation projects and the margins are based on the projection with respect to cost to completion. So when the project is not fairly mature, it is difficult to estimate accurately the cost to completion. As we move deeper into the project, a more accurate assessment with respect to cost to completion is available. In addition, there have been certain refunds with respect to the liquidated damages on the Scorpion submarines, which were deducted earlier. I think we have already received 3 refunds. 1 more has been sanctioned very recently. The 4 LD refunds, these have also contributed quite substantially to the bottom line of the company. And moving ahead, 1 more LD refund is under discussion with the Indian Navy. And with respect to the 6th submarine, which again would be delivered most probably in the month of January, there also the liquidated damages have been deducted. So once the delivery is completed, we would be entering into discussions with the Indian Navy with respect to ascertaining the attributability of delay. And we are quite confident that for the 6th submarine also, in due course of time, this LD refund should be coming to MDA. So all these things would also be contributing to the profitability of the company.
Okay. So can you give us an update on your P75I orders? Is that likely in FY26?
Yeah, as far as project 75I is concerned, 6 number of conventional submarines with AIP and lithium-ion batteries. Here, Mazagon Shipbuilders is participating in collaboration with ThyssenKrupp, Germany. And the field evaluation trials for our submarines have been found to be successful. So technically, all the evaluations have been done. We believe that we are the only collaborators, we are the only combined MDL and TKMS whose bids have been technically found to be successful. So moving ahead, there would be commercial discussions and negotiations, and we are quite hopeful that within the next financial year, this order should materialize.
Okay, and lastly, you're targeting 3 deliveries, right, for 25 and 26. Are you on track? Any update?
As far as FY25 is concerned, we have already delivered 2 vessels, 1 destroyer and 1 frigate, and we are very much on track with respect to the 3rd delivery, that is the 6th and the last Scorpion submarine of the current project. We are targeting that this delivery should happen anytime soon in the month of January. going ahead with respect to FY26, we expect there can be, if the year goes well, there can be 2 deliveries of frigates. Otherwise, at least 1 frigate delivery is definite.
Okay, we'll leave it at that. It was an extremely optimistic conversation to ring in the new year. Thank you very much indeed for joining us, sir. Well, that's the word coming from Mazagon Dock. Big orders and a very enthusiastic managing director out there. We have to take a break on that note, but just a word, market's still a little under the weather, you'll have to say. But what I wanted to point out was there is a bit of a recovery after the first hour of selling, especially the Nifty Bank. Okay, not just the Nifty Bank, it's more so in the Nifty and the Sensex. Sensex now almost in flat terrain as the mid-caps as well. That's good to see. Advanced declines, of course, are in favor of advances. That's important to note. We'll take a break on that note, and thereafter, we're going to connect with the big man from the banking industry. That's the industry that went through a bit of a struggle as far as the markets are concerned. We will have the chairman of SBI, C.S. Setty, joining us to discuss outlook for 2025.
HOAC Foods, Hamps Bio, KC Energy and Infra, and Toss the Coin is all seeing subscriptions of over 1,000 times. And of course, one must know that these SME IPOs have a smaller size. The number do appear elevated after that. But that also does not mean that there is no demand. All 5 of them saw listing day gains of anywhere between 90% to as high as 370%. So which is the issue that has generated maximum returns this year? It's a company called Oves Metal, which is up over 1,000% from its issue price of $87. The rest two are up anywhere between 700% to 1,000%. A note of caution here, most of these names are under the extra surveillance measures or ESM framework under various stages. Now, if these are wealth creators, there are wealth destroyers also. MVK Agro, Baveja Studios and others have either halved or are down nearly 70% from their issue price. With thinly traded stocks, little or no institutional interest and no widespread ownership, the scope for manipulation among SME IPOs is a lot higher. Therefore, market regulator SEBI has already come out with tighter listing norms for these companies, and they are potentially stricter rules that are also in the offing. Therefore, it will be interesting to see if these numbers are affected in any form post these stricter SEBI rules, or will this chota packet continue to give bada dhamaka returns in 2020?
Welcome back. We started the morning by telling you that there are quite a few orders that have come in overnight, and one of them was for SJVN, if you remember, the power company, Satluj Jal Vidyut Nigam. Vivek is here to tell us more about SJVN.
Well, that's right. A very interesting development, like we highlighted in the morning. This particular development stands out given the fact that the tariff that the company has mentioned as far as, the press release is concerned is quite strong. And on the back of that, you're actually seeing quite a strong up move. Also remember, SJVN is a recent entrant as far as the F&O space is concerned. But let's have a look at what is it that the company has told the exchanges. The company has signed MOUs for multiple pump storage projects in Bihar. So the main project that the company is discussing is a project called as the Hatida Durgavati PSP. Earlier, the size of the project was expected to be close to 1600 megawatt, but after conducting the feasibility study report, the size of the project is now at 1000 megawatt, which will be 4 units of 250 megawatt each. What is it that the project cost will be? The project cost is a little over 5,660 crore. The daily peak energy is expected at 6.325 million units, which translates to an annual peak energy of close to 2,308 million units. Now, the levelized tariff that the company has indicated in the press release is that it is going to be at rupees 9.39 per kilowatt, which is based on the Feb 2024 levels. On the back of that, SJVN positive development, also given the fact that it gives visibility as far as capacity addition is concerned, you're seeing the stock do quite well in the session so far.
Yep. Thanks a lot for that, Vivek. A levelized tariff of 9 rupees is damn good, per kilowatt. Not good for consumers, though. Okay, let's get to Rima. Rima, Bajaj Auto numbers, quite a disappointment. The market's not happy.
No, so total sales are down 1.1% at 3.23 lakh units. This is lower than the CNBC-TV18 poll of 3.5 lakh units. Motorcycle sales are down 3.8%. Exports, though, continue to do well. So year-on-year, down 1.1%. On a month-on-month basis, you will see a sharper fall because the total sales would compare with 4.2 lakh units in the month of November. But again, it's not a fair comparison because the prior month got a festive boost. But what's interesting to note in the internals is the contribution of exports has been steadily rising. So even as domestic sales are faltering, look at the contribution of exports over the last 3 months. And now exports are nearly 50% of the domestic sales. Now, the stock is under pressure today. This year, in the last year, it's up close to about 30%, but it's still off about 32% from its peak levels. Also, we got the electric two-wheeler Vahan data. And here, Bajaj Auto is making rapid strides. It's emerged as the #1 player in electric two-wheelers with a market share of 25%, followed by TVS Motors at 23% and Ola Electric at 19%. So it's quickly displaced its peers to get the numero uno position. MK has written a note on two-wheelers where they're saying that both Hero and Bajaj have seen about a 33 and 30% fall from peak levels, and according to them, this is unwarranted. The outlook on exports is improving and poised for a sharp recovery. So that's the view coming in on MK, but today there's clearly disappointment.
Yes, and there's disappointment even from M&M in certain parts. Total auto sales is up 16%, but it's not as good as the market wanted. The CNBC-TV18 poll was expecting over 70,000 vehicles. They've done 69,000. So it's lower than the market expectation, but individual, like exports have done very well. PVs have done very well. It's per se 9% growth looks good,
It looks good.
but looks like there are the analyst community, as you can see, CNBC-TV18 poll was 71,000 units, but they've delivered 69,000. The market anyway is excited, not terribly worried about analyst expectation. Okay, with the auto sales number now, let's shift our focus to the interview of the day, of the morning. We are joined by the biggest banker of the country, CS Sethi Chairman, State Bank of India, to give us an idea of Outlook 2025. Good morning, Mr. Sethi. We really appreciate you giving time for us. And here's wishing at the outset a very happy new year to you and to everyone at State Bank and your family.
Good morning, Lata. Thanks for having me on the first day of the year on your show. And it's an honor. And I wish all the viewers of CNBC TV18 a very happy new year. Along with your viewers, the whole customer universe of SBI, I wish all their families and their businesses a wonderful year ahead.
Well, 2024 was not an unkind year at all for State Bank of India. It was bad for the banking sector. Bank Nifty, I'm entirely talking from a market point of view. The Bank Nifty went up only 4%, whereas the Nifty went up 9%. But State Bank shares went up 24%. So it was an outstanding year for some of the banks. Mr. Sethi, what went so right for SBI in 2024?
Apart from the market, of course, market has took some time to recognize the potential of the stock, obviously. What we have shown our resilience and consistency in our performance, essentially. I think it is not only in terms of the largest amount of profit among the corporates in India. We also had focused on increasing our customer offerings, number one. Number two, we continue to invest in the technology and digital adoptions. I think that also had contributed to our recognizing the value what SBI brings to the fore. The other thing is, some of the conventional business lines, what SBI has been known for, we have strengthened our focus on them, particularly on the MSME, large value agriculture, and we continue to be market leader in home loans. And more importantly, above all, I think we have demonstrated the resilience in our asset quality. I think all these things have helped us to present a good picture to the market.
Okay. Well, that's good to hear. But, the big problem that bedeviled the banking sector, one of the reasons why perhaps the index itself underperformed is this desperate hunt for deposits and the rise in the costs. How do you see that panning out? Will the cost of deposits abate?
So, as I mentioned earlier also, Lata, in your show, that I think there's only so much we can compete on the interest rates. and we have to increase our customer services and in terms of value proposition, which the bank account brings or bank deposit bring to the customers. I think more importantly, the post-COVID credit growth, which was substantially high, and the deposits have not kept pace, probably had created this imbalance. If you see the November numbers, I think broadly both the deposits and advances are coming to some equilibrium. So the renewed focus on the deposit mobilization by the banks and the balanced growth in advances, I think, is helping us to set the balance in place. So I don't think there will be too much cost escalation on the deposits. Obviously, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits?
Okay, so you think this, I think even SBI offered 8% product for a 1 year, FD. Is that the peak?
No, I don't think we have offered 8%, but it is our highest rate Amrit Vrishti is around 7.25%.
Okay.
So with some additional interest rate for the senior citizens.
Yes.
But I think I personally believe that the interest rates on the deposits are picked.
Okay, that's good to hear from a bank investor point of view, even if it's not very good news for pensioners. But how do you see credit growth picking up? That was the other issue. Credit growth had to be brought down below deposit growth, or at least to deposit growth. Where are you seeing credit demand? Are you seeing industries, corporates hungry for credit at all?
Corporate credit growth essentially is coming from some of the sectors. Obviously, the renewables, roads, some of the petrochemical expansion has also contributed to the credit growth. But I think core sectors, the capital expansion has not been happening, particularly in the steel, cement. I think there's a more of consolidation which has been happening there. Hopefully, one important thing what we noticed is the housing sector is doing well. Which means that some of these sectors like steel, cement probably would do better in the current calendar year. As far as renewables is concerned, I think as you have shown in your show also, that the renewables is coming across solar, hydro, pumped hydro, for instance. I think a lot of capacity additions is happening on the renewables. And the green financing probably would be more focused in the current calendar year.
Okay. So for 25, what kind of a credit growth, or even FY26, what kind of credit growth, what kind of margins, ballpark ranges?
Margins, I think, broadly would stabilize because, as I said, interest rates on the deposits have peaked. And we need to watch out on the policy rates also, how interest rates movement is going to be, behaving in the current financial year and, of course, current calendar year. My view is that I think rate cuts would be there, which means that the softening of interest rates will be there, which would spur the demand, particularly on the retail side, which was some kind of, other than housing, the other segments of retail personal was slightly slowing down. And the interest rate reduction would definitely spur the retail credit growth. As far as the corporate is concerned, the capacity utilizations are at the peak now. I think most of the sectors have reached 75% capacity utilizations. But I think external sector is making them to hold back a little on the capital expenditure. So if some clarity emerges on the external environment, I think they all will come back to the capital expansion.
Yeah, I take your point. Quite a few CEOs were saying that uncertainty over trades, tariffs, exports is leading to perhaps postponement of decisions. But let me come to the micro challenges, or rather specific challenges to the banking sector. One, do you think fee income is under threat? I mean, you all made a lot of fee income because of selling insurance. Now both the insurance regulator and the banking regulator are moving to curb that. Will that be a dampener for the entire sector?
Fee income, particularly which comes from the
sale of insurance.
Cross-selling is not very significant. If you see large banks, our fee income is minuscule from coming from the cross-selling part. I'm sure, I think most of the large banks also have a lot of other income streams other than cross-selling, which is available to us. Particularly, we have bulk of income coming from the forex and treasury activities, and also from the loan processing charges. I think these other income streams will continue.
Okay. All right. I think the problem is more for SBI Life, or perhaps for all the life companies, if their parent companies are curbed from selling too much of their products. It's not your problem, it is the insurance companies' problems, right?
No, most of these insurance companies are also diversifying the way they source their business. Obviously, the agency channel is picking up across the industry. Obviously, in the initial stages, the dependence on banker will be there, but I'm sure, I think all these companies will find different ways of doing the business.
Okay. Well, there are three big overhangs on the banking sector from the regulator. One would be LCR, the other would be the project finance higher provisioning, and the LDR provisions as well. Expected loss provisions as well. Do you think FY26 will see the brunt of all these, or will they be more diluted than we think?
So we've been engaged with the regulator through various fora, especially through the IBA. We have given our views on all these three areas where the discussion papers and draft guidelines were issued. And I'm sure the regulator will relook into, some of the suggestions what we have given. So we'll have to wait. I have no view on, what is the timing and in what form it is going to come in.
We will reserve that question.
But RBI, I think the regulator would definitely consider many of the suggestions what we have given.
Okay. No, I agree with you. I'll reserve the question for the RBI governor if and when we get him. Just a final word on this unsecured loans. Both the Financial Stability Report and the previous Trends and Progress in Banking kept saying that they're worried about unsecured loans. Although GNPAs are at all-time, at 13-year lows, do you think this unsecured loan is going to give NPAs even for SBI?
If you ask me, from SBI side, we always said that our unsecured loan portfolio is completely different. In fact, we keep saying that our unsecured loan portfolio is more secured than anything. So I don't see any asset quality issues. Of course, it's not appropriate for me to talk much about that on the SBI numbers. Our silent period kicked in. But one definite development in the market is that with various measures, what RBI has taken, there is a moderation in terms of the growth of unsecured personal loans, as well as the way the unsecured personal loans are being underwritten, priced, monitored. I think there's a huge amount of work which had gone into it. So obviously, I think that would result in the better asset quality going forward.
All right. We leave it at that, sir. Thank you very much. You give us some optimism that for the banking sector, deposit costs have peaked and therefore margins, if anything, will stabilize, and you are seeing signs of credit growth. Thank you very much indeed for joining us.
Thank you, Radha.
Okay. So, well, that's setting the tone for a good 2025 from the banking sector. Quick break, and thereafter, Manisha is going to tell us about the commodity trades in 2025.
(2024) became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at 108,000, surging 130%. The crypto market cap also hit an all-time high of $3.9 trillion. Well, the year 2024 started on a higher note with launch of Bitcoin ETFs, which gave easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion worth inflows. Ethereum also did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Institutional investors now own nearly 20% of all Bitcoin ETFs traded in the US. And then it was also about Bitcoin halving, an event that happens every 4 years. It leads to reduction in block rewards by
Welcome back, and it's over to Manisha. Manisha, what's the big commodity of 2025 that you're tracking?
Well, it's day one. The Asian markets are just opening, and most of them are not even opening right now. But, much of the cues would come in from 2024. And, well, yes, there's a lot of uncertainties as we get into the new year as well. So one thing that I want to put on table clearly is about the dollar index. And this has been the best year since 2015 when you look at the dollar index move, which has been up by 6.5% in the previous year. And when you look at 2025, the first day that is, we are holding above 108 onto this one as well. Well, there are expectations of pro-growth, inflationary policies from Trump when it comes to taxes and tariffs, and that perhaps could keep the dollar index surging higher. We've heard a lot of experts telling us that 110, 111 is where this rally perhaps could peak out. So that is still 300 points on the higher side from here on. Well, I want to talk about the crude oil prices because we've started 2025 on a positive note. 0.25% on the higher side, but the volumes are quite thin. But when you look at 2024 and what we are carrying from that one is the fact that you've seen second year of decline in 2024. We saw the prices decline by 3% in the previous year. Also, when you look at the Chinese demand manufacturing data for the month of December has been on the positive side. Is the reason you've seen last 2 weeks actually positive for crude, and is the reason that much of the loss that we were looking at for this year seems to have gone down as well. At one point in time, we were trading 9% down on crude, but we've closed the year down by just about 3% there. Well, positive Chinese data has done that trick, but the markets will watch out for a lot of things in 2025. It is going to be about risk of excess supply, geopolitical tensions, Trump's oil policy, and add to that the fact that the Chinese demand is still not clear, and then you have higher supplies coming in from US and many of those non-OPEC countries as well. But within this space, it is about the US natural gas prices, which gained quite strongly. It was the best year since 2016. We've seen nearly 56% of gains come in. Today, we've seen 7% of a decline, but that's about profit taking. It's winters, January is going to be colder, and all of that perhaps will lead you to buying opportunities there. I also want to talk about precious metal prices because we've seen gold and silver actually do better than various equity indexes as well. Not so much the case for platinum and palladium, but when you look at the gold prices, this is the best year since 2010. Silver is put in the best yearly gains since 2020 as well. So it's been a good year in that sense for gold and silver prices, also given the fact that we've seen all-time highs, and you could be looking at further all-time highs in the year 2025. When it comes to the base metal prices, ferrous metals did not do well. We've seen 15% of decline in iron ore and a 22% of decline for steel. Copper, while has gained 5% for the year, but when you look at the last couple of weeks, it has continued to decline. It's trading at a 3-month lows right now, and the markets are looking at copper prices coming off 30% from its all-time high that we saw in 2024. So it's going to be tricky for metals. Buying continues in precious metals, though, is what the cue is as we step into the new year.
Okay, thank you very much for that overarching wrap, Manisha. And here's wishing you as well a great 2025 as we wind up on Bazaar. We have at least conquered the red in the market, is handing over to Chartbusters in the green. Chartbusters for you after the break.
Lowering the supply of bitcoins. It was also then that the rally took wings with the US President-elect Donald Trump pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested US Bitcoin reserve, and there also was a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who is a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have cheered, expecting favorable regulations going forward. The Russian President Vladimir Putin recently said that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. After El Salvador, countries like Tonga, Paraguay, Panama are also considering adopting Bitcoin as a legal tender. The cryptos also are taking support from wider adoption of real-world assets. The stablecoins are also emerging as payment tools for enterprise businesses. The year 2024 also had its share, though, of frauds, hacks, and rug pulls. The sector lost nearly $2.3 billion this year in frauds, though lower than the last year. The names that went through issues this year was Wazirex, Radiant Capital, DMM Bitcoin, among others. While the Bitcoin grabbed the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano all reached all-time highs, while the lesser-known altcoins like Palm AI and Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor, with market cap now at $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and blockchain as a technology, and the markets have...
Bajaj Auto and Escorts Kuboto record lower than expected sales in December. Both stocks correct about 2% in early trade.
IREDA is the stock in focus, and that's up 3.5% after reporting a strong business update in the third quarter. Disbursements are up 67% on a sequential basis, while the disbursement to AUM ratio stands at 60.4% compared to 29% in the second quarter.
SJVN is up over 5% after the company inks an MOU with the Bihar government for a 5,663 crore rupee 1,000 megawatt pumped storage project.
And Southwest Pinnacle's shares that are up 5% after the company has won a contract extension worth 158 crore rupees from Reliance Industries. You're with us here on Chartbusters on CNBC-TV18 on this first day of 2025. I'm Hormus Fatakia. With me is Vinny Motiwala. Wishing all of you, our viewers of CNBC-TV18, a very, very happy and prosperous New Year. Vinny, good morning and a very happy New Year to you as well.
Good morning, Hormus, and happy New Year to you as well. Surely slight bit of that happiness is coming in the markets as well, no? At least in the green. Nifty right now, flat maybe, not that much of in the green. Just the 0.% that is up, but move to the positive territory, not a bad day. 23,648 right now is what the Nifty is at.
Well, the bigger takeaway, the color is more important,
yes.
Right? And right now, the numbers are not, because it's the first day of the year. The volumes are going to be extremely low, and that is what the case has been. So the focus will always remain on specific stocks, as has been the case all through these last few days of December and this week as well. But a couple of stocks that I wanted to mention, PSUs, after the correction that they had in the last 6 months of December, they have said, okay, we are going to make 2025 our year again. And two names stand out in today's session. SJVN is one of them. And after 4 consecutive years of positive annual returns, SJVN has begun 2025 on a very positive note, 5.5% higher after that MOU with the Bihar government, as we just highlighted. And IREDA is the second one, and that came out with its business updates as well. We'll talk more about that as the show goes by. 3.5% higher there as well. And despite a 30% correction from the top, IREDA still ended up with gains of 105% in 2024. So good going for these PSU names. But time for a chart check on the first day of 2025. Vinay Rajani of HDFC Securities is joining in for a quick chart check. Vinay, good morning. Thank you for joining in. Wishing you and your team a very, very happy new year. The index, they saw a bit of a recovery from the lows yesterday. Some recovery is coming from the lows today as well. But how big a barrier is that 23,800, 24,000 range for the Nifty? Does it have enough legs to A, first get there, and B, cross that level? What's your call on the index now? And couple that up with your stock recommendations as well for the morning.
Yeah, good morning and thanks for having me on the show. Yes, and happy new year to all of you. So definitely the 23,800 to 23,900 is a very strong hurdle for the Nifty. So benchmark indices are still weak. They are not out of woods. If I were to look at the moving average setup also, they are trading below the important moving averages. So the positional trend has been negative. But if I were to look at the broader markets, they are considerably doing well. In fact, small cap index, Nifty small cap index is trading at 7 days high. Micro cap index is also showing strength. So broader market has been doing good. There has been stock specific bullishness, which is doing good in the start of the new year. So definitely one can look at mid cap segment and small cap segment for trading long. But as far as benchmark indices like Nifty and Bank Nifty are concerned, they are still not out of woods, and there are hurdles at higher level. So I think that the positional trend is still down. One can remain bearish on the Nifty with a stop loss of 23,900. Unless that is taken out, we are advising our clients to adopt a strategy of sell on rallies in the indices. But yes, for alpha generation, one can concentrate in the mid cap and small cap segment with a strict stop loss. However, any level below 23,460, which was the yesterday's low, any level below that definitely will bring the momentum in the sell side. So 23,460 is a trigger level after which we can expect some more momentum selling. So this is the range we need to play as of now. So I don't see any momentum trade in the Nifty and Bank Nifty as of now, but stock specific bullishness can be there and we can trade accordingly.
Okay, stock-specific bullishness is what you're talking about, as well as you like the mid and small cap. Any suggestions or any names that you're looking at in the large cap side, as well as the mid and small cap?
Yeah, so the large cap side, pharma and healthcare sector has been performing very well. So my advice would be to remain long in this particular segment. So one of the stock which we like is Apollo Hospital and Sun Pharma. But from the recommendation in today's trade, I would recommend from the mid cap space. So Praj Industry has given a fresh breakout on the charts and looks quite strong. Primary trend has been bullish and the stock is trading near its all-time high. So Praj Industry can be bought at around 849. Stop loss can be kept at 835 for the traders. On the higher side, I'm expecting a target of 900 for next couple of weeks. The second pick would be from the consumer durable space, the Blue Star company. So Blue Star has given a nice breakout from the consolidation, looks quite strong on the chart. So, and the entire air conditioning space and the consumer durable space has been doing well. So Blue Star is looking good at 2170. One can go long. Stop loss can be kept at 2120 and target can be seen at 2300 in next couple of weeks. So two trading long recommendation from my side, Praj Industry and Blue Star company.
Okay, Vinay, thank you so much for joining in with us this morning on CNBC TV18. It's always a pleasure having you on the show. On that note, let's shift focus to our special segment where we will get you a few ideas of profit from Money Control Pro. Anant Chaudhary from moneycontrol.com joins us now to talk about a stock that he's been tracking closely. Anant?
So we like TBO Tech Limited, a leading global travel distribution platform. It's a platform where travel agents and travel management companies can book flights, hotels, car rentals, cruise, and many more packages. We like the company due to rising outbound travel globally. Young first-time travelers from countries like India, Indonesia, Brazil, they often rely on offline travel agents for their complex bookings. These travel agents lack the necessary infrastructure to manage their clients and the extensive inventory database. TBO also solves payment issues by enabling suppliers to be paid in their local currency while allowing travel buyers to collect payments in their preferred currency. TBO has an existing base of large buyers and suppliers, and they plans to further expand it. With network effect at play, a large buyer base attracts higher supply, which in turn helps in the even higher number of transactions on the platform. GTV generated by buyers in their 6th and 7th year is 5 to 6 times higher than the first year, which showcases the platform's ability to retain buyers. TBO has high operating leverage to play as there is zero marginal cost for new transactions due to technological automation, allowing all incremental benefits to flow directly to the bottom line. So due to very niche business model and no listed peers, stock trading at 50 times on FY26 earnings appears reasonable to us.
By the way, flashes on your screen the big news that is coming in from Easy Trip, where Nishant Pitti, one of the co-promoters of the company, has resigned as the CEO from effect today due to personal reasons, is what he has cited in his letter. And Rikant Pitti, who is one of the other promoters of the company, has been appointed as CEO with effect from today. No effect on the stock price as of now, but Easy Trip was in focus yesterday. Nishant Pitti was in focus yesterday because he had announced the fact that he wanted to sell his remaining 14% stake in the company through block deals. But yesterday, only 1.4% of that stake was sold in the block deals through the day. So that has kept the stock in focus, and the resignation letter also cites only personal reasons. No other factor has been cited in that letter from Nishant Pitti, and the stock so far absolutely unchanged. We'll keep you updated with more that comes in from Ease My Trip. But for now, the big news is that Nishant Pitti, who wanted to sell his remaining stake in the company, could not do so in yesterday's trading session, has now resigned as CEO from today itself, citing personal reasons. So Easy Trip will be the stock that will remain in focus. But time for a short break. On the other side, we'll take a look at how the market is likely to shape up for 2025. Stay tuned.
Higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein now expecting $200,000 per Bitcoin. MicroStrategy, in the meanwhile, expects Bitcoin to rise 29% per annum over the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
(2024) began with a bitter pill for contract development and manufacturing organizations, or CDMO players. A muted biotech funding environment dampened the pace of early-stage projects, leaving these biotech firms feeling the heat in 2024. But here's the good news. Positive triggers are emerging on the horizon, and there are clear green shoots that are visible and indicating a turnaround for the sector. The first one is an uptick in biotech funding, signaling a recovery. Welcome back. You're watching Chartbusters on CNBC-TV18, and let's go across to Nimesh, who's here. The Indian market has actually ended 2024 with positive returns, and this is despite a roller coaster ride that we're seeing. But the big question is, what is in store for 2025? So let's go across to Nimesh, who has more details on this.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's a record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
And that is what almost every market participant would want to hear as well. Nimesh, thanks a lot for that. Now, as we move into the new year, we got in touch with Samir Arora of Helios Capital on the likely triggers for the Indian markets going into the new year. He also spoke on the sectors that he is bullish on for 2025. Listen into an excerpt from that conversation.
You take it from different pockets. You buy some stocks because they're growing well, but they have also performing well in the market, and some which are doing well but are cheap or value. And it is that combo of, buying some financials and some of these high growth stocks that you're talking about, these food delivery or otherwise, or whatever be the new growth. Also, if you look at the FIIs, it looks as if FIIs are selling, but they're effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio from some of the older names that they may be having in consumer and auto and others, and buying into these new IPOs, which are, at least many of them or some of them, are offering high growth. So there is no point in ever talking about absolutely one or the other. Of course, you can have groups of sectors doing well and expectations of groups of sectors doing badly, but there is no overdoing anyone, I would say, because you really never know what fancy the market takes.
No, I agree. But, you're a veteran of, how many cycles in the market? Probably 30 years. So at this juncture, bhagta hua ghode ke piche hi bhago, EMS, e-commerce types, mid caps, yeah, put a larger share in the one that did not perform, HDFC Bank. I mean, you can't complain about the quality of some of these stocks, but not their best year.
So that's why we have, I think, a good description of these. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market. And you have more money than otherwise. And then you have these smaller, newer, faster growing, where you keep a limit on each stock and you diversify across the different themes and have, maybe in our case, maybe around 15-18%, but that also in 5-6 stocks. And it is that combo which lets us sleep every day without overly one. If you say you have to make only one investment, and that one investment is the marginal new investment, then also there's an easy answer. It depends on what you don't have.
You're saying only 15 to 18% of your portfolio would be in some of these smaller, faster growing companies, while 85 to 90% or whatever, 80-90% would be in these large cap HDFC type bank. Okay.
No, the larger, well-known, these compounder names that were given, which spoiled their compounding immediately when that name was given, those are 50-60%. Okay. These 18-20% are these super high growth guys, which are these 25-30% and growing also, but making losses, maybe all these Paytm, Swiggy, Zomato types. And you still have a third group. No, these are the groups where you are discovering new companies and they might be a little valued a little cheaply, or their growth is a little high, but you're not expecting them to make 25 and 30% for 4-5 years. This could be Indigene types or these smaller hotels or something, which are not also super well known, not super well ready in terms of quality and history, but they are promising. And we are trying to discover some of them. So there are sort of
You want to tell us some of these stocks that you're discovering?
No, we
like
don't
Indigene is
not
one.
tell
Yeah.
you anymore because now we are also separately in the mutual fund business. So you can see 100% of the portfolio every year, including the changes that the Indian guys make. And broadly, although I manage an offshore fund, because the research is common, many of these names will be there. But so you can see all of them yourself. There's nothing for me to highlight here separately.
So Samir, you spoke about that, how FIIs may not be putting money in the secondary market, but they are in the Indian equity market by participating in IPOs, QIPs, etc., in the other forms of fundraise that is taking place. Is there any more nuance to this? Is there a preference that FIIs are gravitating towards? Have you done any analysis on this?
No, so my big, I don't do all this analysis. I just interpret other people's analysis. But big picture, out of the 20 odd years, if you see all this data, there are only 4 actual calendar years in which the FIs have been negative. Okay. Now this year you can say they are sort of break even on an aggregate basis. Adding both primary and secondary. But you can draw this conclusion that the stocks and the sectors that they are liking now in terms of is basically what I was saying, that diversify a little bit away from the old sectors to a little bit to the new sectors. So that is one big picture. But second is not to think in absolute that the FIIs are writing off India and selling India, because as you can see in the percentage years, you can see it in the years in which their flows are negative, that you can attribute it to something specific. In 22, the interest rates were hiked from whatever 0.5 to 5%, and there was a war. In 18, we had this crisis. In 13, it was that, then before Raghuram Rajan came, whatever the currency fell 28% or whatever, 19%, and the market fell 28%. And then one was 2008. So to take those 4 years and say, oh, FIIs, will they buy or not buy? Mostly you have to assume they will buy, mostly.
Okay, and just a quick look at the markets that we should be taking, because Nifty as of now is up almost 0.4% in trade. Sharp recovery that we're seeing coming in for the markets. Day's highest point is what the Nifty is trading at, 23,733. So 86 points up for the day as of now. Keeping an eye out on that. Top contributors that we should be watching out for today in terms for the Nifty 50. We have the banking side. So HDFC Bank, ICICI Bank is among the top contributors. From the auto pack, we have M&M also that is supporting some bit of a growth for the Nifty. Keep an eye on that. And other than that, we have L&T. While losing side, obviously, Bajaj Auto, not a great set of numbers that came in for December auto sales. So that is under pressure. Hindalco also is down and out, as well as NTPC among the losing side. But top contributors, Nifty Bank side. So top private banks are doing well, and that is supporting the Nifty 50. But on that note, we're going to sip into a very short break. But as we sip into the break, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app that is getting instant access to breaking news articles as well as in-depth financial knowledge, updates from across the world at just your fingertip. Download the CNBC-TV18 app from the Apple Store as well as the Google Play Store. CDMO players. Demand for CDMO services in late stage as well as commercial molecules is also on the rise. Moving on to the third one, we have broad-based commercial contracts in biologics and small molecules that is picking up pace, as well as biologic CDMO demand that has remained robust, and we are expecting the good growth to continue going forward. Nutraceutical manufacturing demand that is also recovering quite steadily, and now we will shift focus and talk about what the highlight and commentary is coming in from the CDMO players. That's a key one, because what they're signaling is that maybe in the near term, there could be some mixed near-term challenges that we're watching out for, but a promising outlook that is coming in for the medium term. Piramal Pharma is expecting to see early teens growth as the CDMO segment is outpacing the company's.
Welcome back. A new year begins, so it's time for a lot of changes as well, and you need to get ready for a slew of changes in the way we transact. Ritu Singh is now joining us with the big 4 changes that have come into effect from today, and how will they impact our lives. Take it away, Ritu.
The new year ushers in some major updates across the financial landscape, and here's a quick summary. Starting this year, RBI will implement new guidelines leading to the closure of 3 specific types of bank accounts to prevent frauds and misuse: dormant accounts which have had no transactions for a continuous period of 2 years or more, inactive accounts where there's been no transaction activity in the last 12 months, and accounts that maintain a zero balance for a prolonged period. Second, we have new guidelines for fixed deposits with NBFCs and housing finance companies, where depositors can withdraw small deposits of up to 10,000 rupees prematurely without interest. For larger amounts, withdrawals are capped at 50% of the principal or 5 lakh rupees, whichever is lower. Third, starting the 1st of January, credit data will be updated fortnightly instead of monthly, because RBI has now asked banks and financial institutions to refresh records on the 15th and the last day of each month, or even more frequently as agreed with credit information companies. And this means for you and me, faster updates where our credit score could potentially change multiple times during the month versus once a month earlier. And lastly, the per transaction limit for UPI 123 Pay will now increase from 5,000 rupees to 10,000 rupees, while the limit for UPI Lite will increase from 500 rupees to 1,000 rupees. And this will particularly benefit underserved groups like senior citizens and rural users who have limited access to digital payment methods.
Thank you so much for that, Ritu. But with that, we're absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. But as we wrap up, we leave you with some visuals of New Year's Day celebration across the globe. Stay tuned in to CNBC TV18, and a Happy New Year to all our viewers. DB's Lab, they remain quite confident in terms of a double-digit growth in terms of revenue. We have Syngene, Laurus as well as Newland Labs. Now their commentary is quite similar, because what Syngene is saying that they're expecting high single-digit growth in FY25, but FY26 expected to be stronger. Similarly for Laurus Labs, expecting a soft growth in FY25, but a good growth from FY26 and onwards. And Newland Labs also flat growth in FY25, but targeting a 20% CAGR growth in the medium term. Now let's look ahead. The industry is poised for an acceleration in terms of top-line growth. Currently somewhere at 9%. By FY27, 16% growth is what one is watching out for. However, valuations, that's the key concern coming in here, because valuations currently are ranging somewhere between 47 times to 60 times for these players. Following the surge that we've seen coming in on a YTD basis in terms of a stock performance, that was somewhere between 40% to 80% in the run-up that we're seeing, which is outpacing the Nifty Pharma's 34% rise that we saw this year, approximately on that front. Now, finally, here's what investors and analysts need to keep an eye out on. One is the progress in terms of the Biosecure Act, when it's going to be picked up in the US Senate. Moving on to the next one, we have seen sustained recovery in biotech funding. Will that continue in 2025? That's going to be a key factor. Uptick in RFQ surely is there, but are they translating into confirmed orders? Keep an eye on that, as well as company-specific new launches. What is the trajectory that they have for price erosion in generic APIs is something that is very important for CDMO players. The CDMO sector is navigating a complex landscape of challenges and opportunities that they're seeing. While there are signs of recovery that is quite evident, sustained momentum will be a hinge.
Good morning. Welcome to Trading Day. It's the first trading day of the new year, and there is a pickup in the markets now. The Nifty is up close to about 0.5%. So after opening absolutely flat, there is some positive momentum. Banks, which were down close to about 0.5%, they were down 400 points, is now reversed course. So the Nifty banking index is up nearly about 0.5%. The advanced decline ratio has also turned favorable. We've got more than 3 stocks advancing for 1 stock in the red. And M&M is your big mover, so that's up 1.7%. ICICI Bank, Axis Bank, IndusInd Bank, even in HDFC Bank. Pull up the intraday chart of all these banks and you will spot that intraday recovery, which has pushed the markets higher. Hi.
Good morning, Rima. I wish you and the team a very happy new year. A little tough to start off the year, on a working note, given the fact that everyone else is on leave. But markets have actually begun 2025 in a very volatile but a positive note. Like you can see, the Nifty has gained significantly from the intraday lows. What is it that's doing quite well? You just mentioned, most of the private banks, but it's not only the private banks, even the PSU banks that's given a bit of a fillip to the market. So all of the PSU banks, look at names like SBI, Bank of Baroda, PNB, Union, Indian Bank. All of these banks actually have recovered very sharply and now trending or trading near the day's highest point. What else is doing quite well? SJVN is one stock, from the broader end of the markets. An MOU with the Bihar government that the company has given more details on that, and that particular stock is doing quite well, almost 6.5% higher. The entire auto pack is in focus on the back of sales. And Ease My Trip, you just saw the news flow come in that the CEO has resigned and he is going to be replaced by his brother, Rikant Pittis. But overall, a green start to the market, and most of the indices, including Bank Nifty, has seen some recovery intraday.
Indeed. So that's the picture as of, the markets and individual stocks. But let's zero in a little bit more on the auto sales numbers because they're trickling in. So first, let's start with Bajaj Auto. Now, Bajaj has reported disappointing domestic sales. So total sales are down close to about 1.1% at 3.23 lakh units. And this is lower than the CNBC-TV18 poll of 3.5 lakh units. Even on a month-on-month basis, you are seeing a decline. But again, it's not a fair comparison because the prior month had a festive boost. But what's interesting is the export contribution. So exports as a percentage of the total sales is now close to about 50%. So the export leg is doing very well for Bajaj Auto. And they're also doing very well in the electric two-wheeler segment, where as per the Vahan data, they have regained the numero uno position. They're the top, they've got the top market share at 25%, followed by TVS Motors at 23% and Ola Electric at 19%. So that's Bajaj Auto for you, and that stock will come up for you. Bajaj Auto stock price was down about a little more than about 2% and now it's still down about 1.7%. Let's talk about M&M because M&M is higher in trade because their passenger vehicle, that's basically the UV, the SUV segment is doing very well. The total sales for M&M have gone up by 16% to nearly 70,000 units in line with expectations. Now this is broken up as about 50%. Actually more than 50, way more than 50%, 2/3 of it comes in from their SUV segment, which is doing very well because that's seen a growth of 18%. Commercial vehicles is mixed. In some tonnage, it's not done so well, but overall growth is about 9%. Exports is small, and that's seen a jump of nearly 70%. But where M&M also stands out is the tractor performance, and that's come in much higher than exports. M&M's tractor growth is now at 20% in the month of December, while for Escorts, the tractor sales were down 10.8%. And even the performance on a year-to-date basis, the auto sales numbers from April to December, for M&M tractor, it's up 10%, while for Escorts, the tractor sales are down 0.8%. So M&M is doing very well. The SUV segment is, firing, continues to fire. Tractors, they're outperforming Escorts, and M&M is a stock where you are seeing considerable buying coming through, while Bajaj Auto is a bit on the back foot today on the back of disappointing domestic sales numbers, even as they do well in exports and electric two-wheelers.
Thanks so much for that. And no wonder then M&M is doing quite well in the session. In fact, even if you look at the commentary, they're actually saying that they're expecting very strong or poised for significant growth, while on the other hand, like you just mentioned, Escorts has seen a bit of a degrowth. But the stock that I'm tracking today is SJVN, a stock we don't discuss too often, but it's one from the hydropower pack. Closest peer would probably be a company like NHPC. Remember, this company is a recent entrant as far as the FNO space is concerned. But yesterday, the company gave the exchanges an update, and this is regarding multiple MOUs the company had intimated earlier, way back in 2022. So yesterday, the company said that they have signed multiple MOUs, and these are for PSPs, which is pump storage projects in the state of Bihar. The company has committed close to 10,000 crore worth of investments in Bihar to set up these particular pump storage projects. And for one particular project for which the company has already done the FSR, or which is called the feasibility study, and this is for the Hatidar Durgavati PSP. What is the total project cost that the company has intimated? Close to 5,663 crore. Daily peak energy, which is what the company intends to sell, is close to 6.325 million units, which works out to an annual peak of close to 2,308 million units. The levelized tariff is something that the company has intimated, and this is as per February 2024 levels, and this is what is keeping the stock quite perked up in the session. The tariff that the company has indicated is that it could be around 9.39 per kilowatt hour, significantly higher than what you see generally in terms of other competitive bidding tariffs that have so far come up. Now, operational renewable power energy capacity for SJVN close to 2.5 gigawatt, but the company has a strong pipeline of close to 17 gigawatts, some which are under construction and some which the company has already intimated that they will be setting up. But no wonder then the stock higher by almost 6% in the session today. With that, we'll slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Like funding, legislative support, as well as execution capabilities of these key players. However, could these stretched valuations limit the sector's ability to deliver significant gains in 2025? Let's watch out for that.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, investing.
Well, welcome back to Trading Hour. Like we've been mentioning, the market rebound continues, and this time some of the tech stocks have joined the rebound. So some of the names are, look at, if you could pull up a chart like LTI Mindtree, HCL Tech, even some of the other names, Emphasis, etc. All of them are seeing a bit of a rebound in intraday trade. In fact, LTI Mindtree up almost 1.5%. The other stock today that's actually going ahead and helping the index move higher is capital goods heavyweight Larsen & Toubro. Larsen & Toubro, after a while, is seeing quite a bit of a bounce today. In fact, higher by 1.5%. Now, the other stock that we are looking and which is doing quite well in the session, a bit of a rebound, is Coal India, and that stock too now trending near the day's highest point. But let's now shift our focus to the commodity space. Manisha Gupta joins in, and today we are focusing on crude and natural gas.
Well, yes, we are, Vivek. You know, when you look at the overall commodity sectors within the space, you've seen precious metals being mixed. You've seen base metal prices actually post a positive 2024. But when it comes to energy as a market, almost everything saw a decline, starting right from a heating oil to a gasoline prices. The only thing that has seen gain clearly has been the natural gas prices. But I'll start with the crude oil prices. And we've closed the year 2024 as a second straight year of a decline. At some point in time, the crude oil prices were down by 9% as well, but the yearly closing is down by 3%. The thing to watch out for is that as 2025 begins, the first day today, we've seen a bit of a positive moves coming in here. So $74 plus kind of levels on your screens right now. When it comes to crude oil prices, well, it is about Chinese demand that the street will watch out for. It also is going to be about the couple of Chinese data that we've seen come in the month of December, whether it has been about manufacturing numbers, factory activity. Those came in positive, and that's exactly what the crude prices are right now reacting to. But then again, going forward, it's going to be about geopolitics, the very heavy currency volatility that we've seen. Dollar index, remember, gained up by 6.5% in 2024, and the markets believe you could be looking at further gains in this year as well. That is something that could keep the markets in check here. The third thing really is about the supplies. US is producing record crude oil. The non-OPEC countries have been increasing production as well. So there are these concerns about excess supply in the next year. And then it is going to be about the Trump policies, oil policy in specific, that could change the shape and form on how we look at energy going forward there. But as I said, barring crude and barring some products, natural gas is something that saw very strong gains. The best of the gains since 2016. We've seen prices gain up by 56%. This is winter season right now. January is expected to be cold, demand higher. And in any case, because the natural gas inventories world over are below 10-year average, I mean, that is something that could continue to support natural gas prices, at least in the first quarter of 2025.
Thank you for that. We should pull up GAIL, if GAIL is getting impacted because of the rise that we've seen in natural gas prices because of the cold in North America. GAIL will come up for you. GAIL is slightly lower today. We'll slip into a break. On the other side, we'll discuss market technicals with Mitesh Thakkar and get in his top trading bets.
The SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now, what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now, with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now, over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25.
Welcome back. Mitesh Thakkar, as promised, is with us now for a quick technical check on the markets. Mitesh, would you read anything into this recovery?
Good morning again. So, I would actually read a lot into this. One, I had highlighted that 23,500 and 50,500 would be the important levels to watch for both the indices. And we've had a bounce back from right around those levels. So, those supports are holding on. And while we don't have a sign of a full reversal as yet, I think holding on to 23,500 means that the Nifty is still doing that range of 23,850, 900 on the upside. So, about 23,500. And we should now most likely try and attempt an upper end of the range. Similarly, for the Bank Nifty, 50,500, 600 is the area of 200 average. It's also weekly average around 50,500. So it's bounced back from there. The first target was around 51,100 being done. I think on the upside now the bigger challenge is at 51,400. So maybe we will head towards 51,400 and then see some kind of profit booking or some kind of selling pressure and line again. So broadly, it's a market which is chopping around.
Mitesh, what are your individual picks for the day?
I have a buy on IRB Infra. That's one. And, here I would recommend buying with a stop at about 57. Look for the stop to head towards 61.80, which is the 200 average area. But more likely, I think, I'm penciling in a target of around 64 over here. So IRB Infra is one stock which I like on the buying side. And the other one which I have is Loris Labs, which I would recommend buying with a stop at about 599 for targets of 625.
Okay, Mitesh. So IRB Infra and Loris Labs are the two stocks that are on your radar today. Both of them are in the green in today's trading session. Well, moving on, Muscount Dock Shipbuilders has signed a contract worth 1,990 crore rupees with the Ministry of Defence for the construction of units that allow submarines to stay underwater for longer. Earlier today, we spoke to Sanjeev Singhal, the Chairman and Managing Director of the company, about the order and the company's future outlook.
the Scorpion submarines, we have already delivered 5. The 6th one we are about to deliver, and we are likely to get another contract for 3 more Scorpion submarines. As far as my order book is concerned, as on 30th of September, we are around 38,000 crores. Of course, the third quarter figures are still under finalization, so a better view would be available in a couple of days from now. As far as 24-25 is concerned, we are expecting a growth of around 10 to 12% over last year. And going ahead also for FY26 also we are expecting a similar kind of a growth. I have been maintaining and I continue to maintain that as far as this industry is concerned, a 12 to 15% margin is a very healthy margin.
Well, that was the management of Mazagon Dock Shipbuilders and talking about the future outlook of the company especially. Let's now take a short break. Up next, we'll discuss the market fundamentals with Manish Dangi, CEO and founder at Mosaic Asset Management.
Has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while NBFCs may see improvement or stability in their net interest margin because their cost of borrowing from the banks will incrementally reduce, which is one of
Welcome back. The Indian equity markets ended 2024 with positive returns. Though it was a fairly roller coaster ride, the Nifty and the Sensex ending up close to about 8.5–9%. The broader markets outperformed. But the big question is, what's in store for 2025? Nimesh is here with the most comprehensive CNBC-TV18 poll. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's a big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was a lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be range between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Thank you so much for that, Nimish. A very interesting poll that's just thrown up some very interesting observations. Well, earlier today, we spoke to Sunil Singaria, the founder of Abacus Asset Management, on earnings expectations for the year, FII monthly inflow, and a lot more. Let's listen in to excerpts from that conversation.
So, I think the last 4-5 years have been pretty good, Lata, for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets has done much better. 24 also is similar. If you actually see, Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward, it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so, because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in, and valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoon's good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy the stock. And obviously, when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time, sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250 you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed, and the markets as well as the economic environment being so dynamic, from time to time one ends up finding a few bets which you can look out for. So I think at this point of time what we are trying to do is in our funds, which are like we have an all cap fund which is more a mix of large and mid, we have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much better than otherwise. And I think little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like that Jyoti CNC, I think it was 300% or something above issue price. You don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy. And when interest levels are such crazy, you obviously will have in the near term, pricing also reflecting that. But, we are not here from a 3-6 months perspective, I think we have still not seen a major drawdown as far as the broader markets are concerned. The markets have been flattish last 6 months on the Nifty, but broader markets have been, I would say, pretty decent. I think once the valuations start to reflect the reality, that is when some of these companies, at least as stocks, would face a challenge. And the other thing is, Lata, what happens is when a company comes in for IPO, obviously there is a very limited history of performance in various cycles. And one is relying completely on the guidance given from a next 2-3 years perspective from the investment bankers and management, and no one gives negative guidance. Everyone's guidance is superb. So a company which has made 100 crores over the last 20 years cumulatively is expected to make a profit of 400 crores in the next 2 years. And you are willing to give the benefit of doubt till it comes. So I think let the result season start for these companies in the next 1 or 2 years. We'll know, how many of them end up doing better. But as I said, there are definitely good companies which are hitting the market. And there are companies which are maybe good but overpriced, and then there's a third lot which are not good and overpriced. So one has to be careful about the 3 buckets.
Yeah, absolutely. Sunil, tell us what could be the red flags that you would watch out for? I mean, not a worst case, but likely red flags.
So the good thing is that India still stands out. I am very sure that we will head back to the 6.5% growth rate. Obviously, Trump coming in will lead to a little bit of rhetorics. Obviously, he's known to speak a lot, but every politician speaks a lot, and not everything what they speak ultimately gets implemented. So once he takes power, who comes to power, we will see what happens. But we are already seeing some movement on the currency side. Indian rupee has been resilient but still depreciated by 2.5–3% over the last couple of months. I think that movement has to be watched very carefully, because depreciating money will push back maybe the likely FI inflows which we are expecting in 25. The other red flag is purely earnings. I think as long as corporate India keeps on reporting earnings which are 12 to 15% year-on-year growth, I think the macro are pretty decent. We are heading to the next 4 years, 5 years of this new government. Hopefully the budget will be pro-growth, which always happens in the first 2–3 years of a new term. We have decent foreign exchange reserves. I think there is a lot of government spending which is lined up. Companies are quite optimistic. And we are also coming out of maybe a 12–15 months of a lull as far as consumer spending is concerned, and that should also come back. So I think we are heading to a nice 2–3 year setup. I think the only thing we need is the corporate profit to come back, and that also hopefully from March will come back. From a global front, as I said, rhetorics and talks would maybe cause near-term ups and downs, but I don't see a major issue even there.
But doesn't it worry you that urban consumption has been falling? I mean, not just the warning from Godrej. Did you just see the Bajaj Auto sales also down, about 1.5% year-on-year? Will that not be an issue?
So, there are segments, obviously real estate. Everyone was selling apartments in Bombay at 1 lakh and 1,50,000 rupees a square feet. Now there are only that many, Indians who will be able to afford those kind of apartments. And suddenly, you have buildings coming in left, right and center. Everyone is going in for redevelopment. And there is going to be a lull at some point of time. Though we are quite optimistic about the real estate sales, but I don't think prices can go further from here. As far as auto is concerned, I think auto in India, two-wheelers and four-wheelers on the passenger side, has never seen volume growth consistently of more than 5–6% year-on-year. So I think it's not a surprise. And the other thing which you have not to forget is that the number of players are increasing. So maybe the volume overall is growing at 5–6%, but the listed guys are not able to retain their market share, which is happening in a lot of places. I was speaking to a major tile company, and this is the segment is growing, but there are new players coming in from Morbi who are now selling in their own brands. So it is getting a little bit more competitive, and I think that is going to be the case. I think one thing which we should not forget, Lata, is that capital has been available in plenty, and hopefully that will be available in plenty. Now, capital raising is good for the companies, but we also have to not forget that it breeds competition. Because if a company is able to raise 1,000–2,000 crores of capital, the ability of that company to compete with existing players increases quite meaningfully. And we are heading into a phase where maybe the ROEs, which was 17–18% for Indian corporates on a consistent basis, might fall to maybe more around 15–16%.
There was a rich conversation with Sunil Singhania on so many topics, markets overall, but earnings growth needs to come back. But let's get to the macros as well. Now, the rupee remains range-bound today, but the domestic currency has ended about 3% weaker in 2024. Now, Lata polled a lot of economists, and according to the poll, the rupee could slide further to 87 rupees by the end of this year. Lata is here with the key takeaways from the poll and mapping the macros for us in 2025.
Well, the Indian rupee will slide to 86.25 by March 2025 and to 87 by the year end. That's according to a poll of economists and bank treasury heads done by CNBC-TV18. Treasury heads, of course, varied in their levels. The range for March for the rupee was 85.40 to 86.5. But for the year, the economists' forecasts lie between 86.75 and 87.5. That's by December 31. An overwhelming majority expect a rate cut in February, taking the repo rate to 6.25 from 6.5 today. But that will move the 10-year bond yield only a bit to 6.7%, bankers told us. By the year end, however, the hope is equally divided between those who see one more rate cut and those who see two more rate cuts. So the repo rate could be at 6% or could be at 5.75, 50-50 vote on that. However, the 10-year bond yield is not seen going below the 6.5% mark in 2025. GDP growth is on an average seen at 6.4% for FY25, with the range of forecasts being 6.3 to 6.5, while the FY26 growth is seen at 6.6%. Again, the range here is 6.5 to 6.8%. Inflation in the current year, FY25, is seen averaging 4.8%, which is the Reserve Bank's forecast. For next year, that is FY26, the poll shows that CPI inflation may average between 4.4, around 4.4%. The range is 4.3 to 4.5%. Finally, the current account deficit is seen at 1.35% this year, FY25, and 1.2% next year, which is very much within the Reserve Bank's comfort zone. All told, prepare for at least a 2% depreciation of the rupee and a slightly downbeat growth. Of course, that will mellow inflation, and don't expect aggressive fall in bond yields.
Thank you so much for that, Lata. Let's now take a short break. Up next, we'll discuss market fundamentals with Manish Dangi, CEO and founder at Mosaic Asset Management.
Segment right now. Now, management terms are expected to end in 2025 for these banks like IndusInd Bank, Indian Bank, you have Bank of Maharashtra as well. Also for Central Bank of India as well as Punjab and Sindh Bank. Over the last few years or 6 years or so, the gross NPA ratio difference between the PSU banks and private banks have narrowed from as high as 967 basis point to about 127 basis point at the end of calendar year 2024 so far. Similarly, the net NPA ratio difference has narrowed from 451 basis point that you saw in 2018 to right now about just 11 basis point in 2024 so far. Historically, this is
Welcome back. As promised, to talk about macros, micros, Manish Dangi, CEO and founder of Mosaic Asset Management, is with us on the show. Thank you very much, Manish, for joining in, and Happy New Year to you. You were cautioning that 2024 may be a muted year for equity markets, and in a way, it's played out for large caps, with the large cap indices giving a return of less than about 9%, 8.5%, 9%. What's the prediction now for 2025?
Morning, Nima. I guess the view for 2025 also is that the risk premiums will be inverted. I think bonds will end up doing better than equities even 2025. I think it's no more speculative that Indian growth is slowing. All markers, both in consumers as well as otherwise, they suggest that Indian growth has slowed pretty significantly. And these bouts of slowdown tend to persist for longer. So my guess is that for 2025 also, we'll have lowish return in equities, and bonds will still deliver most probably 9-10% or perhaps even higher. So therefore, at margin, investors should still be overweight bonds, and they will likely deliver better than equities over 2025.
And you believe that the growth will remain slow in the first half of the year. In H2, things should pick up. What would be the prediction? And do you think an RBI rate cut or something in the budget can spur investment, spur the consumption cycle back and push up growth?
Yeah, towards the end of 2025, it should start to gain traction. Rate easing, regulatory easings, all of them take an effect, but they take effect with long legs. So maybe 9-12 months out, you should start to see some acceleration. But the past actions of regulatory tightening, high real rates in India, of course, what has happened to USD INR, all of that will continue to impact growth in near term. So you will see some signs of green shoots in 8-9 months' time, but sort of pretty much whole of year would be the narrative would continue to paint a picture of slowing economy instead of accelerating one.
Manish, we get your point. So as far as 2025 is concerned, you believe bonds will most likely go ahead and once again outperform equities. Now, within the equity space, which are the pockets or which are the segments that you like? FY25 has largely been a year where earnings has been quite muted. So going ahead, where do you think there could be a quicker recovery?
I sort of, so let's say if you were to think of equity as capex versus consumption, my sense is that capex is overpriced in India. And so at least the local capex plays, won't do well. Global capex plays like IT, perhaps would do better. It's a better defensive play. Within consumption, of course, the discretionary consumptions would do worse than non-discretionary ones. Staple growth, especially the rural side of economy, would begin to pick up at some point. Albeit it's a smaller part of the economy, but would do rather well. So that part of the economy perhaps would do better. Within financiers, most probably the ones which actually are non-retail in nature would perhaps do better. We are entering most likely in a cyclical downturn in terms of, retail assets. So NBFCs and banks which are hyper-focused on retail only would, see delinquencies rise over the next 6 to 12 months' time and, would perhaps do worse. So in some sense, nothing in absolute terms will do gangbusters, but as a portfolio managers, if you were to sort of create defenses in your portfolios, that's how you'll have to place your bets in the portfolio.
How worried should we be about retail delinquencies?
I think it's fair to say that India is first time ever seeing a nationwide distress in retail. Very, very mild so far, but first time nonetheless. And this is happening without any external intervention. Demon, COVID, GFC, all of that is not present. Just because I think the overall indebtedness of households have risen. The income slowdown is resulting in actually delinquencies rise. So in some sense, it's first of kind. And to that extent, if you as a market participants are betting on very sort of rapid growth in retail lending, I think that bit you should be worried of. Would that be anything close to what we've seen in industrial delinquencies? Answer is no. But you would still see across retail side, including housing most probably, a rise in 1 to 2% NPAs in this year. So the whole of year, there'll be a change in the narrative that Indian retail is such a sort of a solid place, which never gives losses to sort of bankers and financiers. I think that change will happen. You will begin to see a cyclical downturn in the household portfolios of bankers and financiers.
But right now it's an unsecured. But do you think as the cycle extends itself, the stress will extend to the unsecured, to the secured portion of retail loans?
Rima, basically, again, the general chat in the town, of course, if you talk to NBFCs, is that, you're starting to see some stress in, even in the secured ones, so the small labs, gold loans, you sort of starting to see stress in sort of affordable housing related plays. So the stress is no more just in unsecured. Of course, unsecured stress has been sort of well known. MFI and credit card stress has been sort of well known for last 6-8 months. I think it sort of is entering in secure space also. Not in the prime segment, but so-called subprime part of the collateralized lending also is starting to see some stress. I think the big picture still is what is more important is that it is no more this easy sort of a call to take that Indian credit, household credit will continue to secularly rise without giving delinquencies. It's the first time, as we are saying, that we're seeing some stress. It sort of does happen that, of course, it always begins in unsecured and enters into secured globally. I think something similar will happen in India also in next 6 to 12 months.
About US markets, 2024 stood out for US exceptionalism. That became the catchphrase. And equities, everything did well. So what's the call on the mother market? Because it all flows down from there.
Yeah. So it is, for us, actually, the most important thing is US economy must slow. Only then you will get breathing space of actually easing rates and, currency will stop depreciating in a meaningful fashion. I guess it is anyone's call. I kind of thought that by now US should have slowed considerably, but it continues to surprise. In fact, India and US were the only exceptions, until about 8-9 months ago. But India too has fallen off, and US remains the only strong play. There are sort of chinks all over the place in US, but it's anyone's guess whether US would sort of slow rapidly or would still sort of continue to have a very, very slow descent, so to say. Unless, of course, US rates cool off. All bets are off on all assets outside of US. So to that extent, if you are a derivative of US trade, you ought to pray for US slowdown and thereby sort of lowering of US rates significantly from where it is right now.
Manish, one question, you've pointed to the retail delinquencies and we're seeing it for the first time. You said that, one way of easing this particular pain could be a rate cut. So how do you see that particular cycle pan out, and how constrained are we fiscally to go ahead with these rate cuts?
No, fiscal actually, I don't think that's the play here. I think regulatory easing with respect to NBFCs and unsecured finance should come, with the change of guard. There's a little bit of a change that you hear in RBI's view now, in the manner that they're now sort of approaching a lot of restrictions that they were putting on some of these NBFCs. So I think, that change is already underway. This soft communication to bankers not to lend to aggressively to the small NBFCs and to go slow on the unsecured finance. I think there's a little bit of a pullback in terms of communication. You won't hear very strongly from RBI about this, but that change is underway. So I guess that part I'm more convinced that regulatory restrictions or obstructions will actually will unwind. On the monetary policy side, I guess it's more linked with retail stress. And I'm fairly certain that, India will have more rate cuts than what markets are baking in right now. Feb rate cut, I think Lata was pointing out, how a consensus also approaches Feb with sort of one rate cut to begin with. My sense is that India should see, 75 to 100 basis point rate cut over next 12 months. So that should sort of alleviate some pain with respect to all these stress that you're seeing in the retail side.
Thank you so much, Manish. We wish you a very, very happy 2025. Thank you so much for joining us and giving us your view as far as the outlook is concerned. Well, moving on, C.S. Setty, the chairman of SBI, joined us earlier today to discuss the 2025 growth outlook. Let's listen in.
So I don't think there will be too much cost escalation on the deposits. Obviously, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits? Corporate credit growth essentially is coming from some of the sectors. Obviously, the renewables, roads, some of the petrochemical expansion has also contributed to the credit growth. But I think core sectors, the capital expansion has not been happening, particularly in the steel, cement. I think there's a more of consolidation which has been happening there. Hopefully, one important thing what we noticed is the housing sector is doing well, which means that some of these sectors like steel, cement probably would do better in the current calendar year. Margins, I think, broadly would stabilize because, as I said, interest rates on the deposits have peaked. And we need to watch out on the policy rates also, how interest rates movement is going to be, behaving in the current financial year and, of course, current calendar year. My view is that I think rate cuts would be there, which means that the softening of interest rates will be there, which would spur the demand, particularly on the retail side, which was some kind of, other than housing, the other segments of retail personal was slightly slowing down. And the interest rate reduction would definitely spur the retail credit growth. So we've been engaged with the regulator through various fora, especially through the IBA. We have given our views on all these three areas where the discussion papers and draft guidelines were issued. And I'm sure the regulator will relook into, some of the suggestions what we have given. So we'll have to wait. I have no view on, what is the timing and in what form it is going to come in. But RBI I think the regulator would definitely consider many of the suggestions what we have given.
Okay, that's the word coming in from State Bank of India entering into 2025. But moving on now to the insurance space, Yash is now joining in with the top 5 things that one should watch out for in the insurance sector in 2025.
Well, Rima, 2024 was certainly a very, very eventful year as far as the insurance sector is concerned. Multiple reforms got unleashed. Of course, the industry also got time to sort of adjust and, have these reforms incorporated. And a lot of things have been spoken about which will essentially set the course for 2025 as far as the insurance sector is concerned. There are 5 big reforms or changes, whatever you may call it, in 2025 for the insurance industry in the country. The first one would be the Insurance Act Amendment. There are various important things which come under this amendment, be it increasing the FDI in the insurance sector to 100%, composite insurance license, lowering of entry capital for new insurers to start business, opening up of the agency network, investment regulations. All these are expected to be changed and reformed under the Insurance Act Amendment. The second one is the GST changes around health and term life insurance. It did not come through in the last GST Council meeting. All eyes would be on the next GST Council meeting with respect to the changes on GST on health and term life insurance. The suggestions are in the process of being submitted. The third one is regulatory concerns with respect to concentration of business which life insurance companies get from bancassurance and any potential action from the regulator there. We've been reporting on this one with respect to the concentration of business coming from one distribution channel. The finance minister regulator has expressed concern on this thing. We'll have to wait and watch in terms of what comes for this distribution channel in 25. The next one is progress on 3 important things: risk-based capital, risk-based monetary, IFRS, as well as the Bima Trinity, which is Bima Sugam, Bima Vistar and Bima Vahak, unleashing of all these new reforms in the insurance sector. And finally, the current IRDAI, the regulatory chairperson's term, is set to end in March 2025. Remember, under the current chairman, a lot of new structural reforms have taken place. So all eyes would also be on the fact that if the government provides an extension, if an extension is provided, then the current chairman continues or not, and what would be the course for the next set of reforms.
Thank you very much for that crisp expectation list. As we slip into a break, here is some good news for all our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all on your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store. As we enter a brand new year, be ready for a slew of changes in the way we transact. Ritu is now joining in with the big 4 changes that have come into effect from today and how they will impact our lives. Ritu, take it away.
The new year ushers in some major updates across the financial landscape, and here's a quick summary. Starting this year, RBI will implement new guidelines leading to the closure of 3 specific types of bank accounts to prevent frauds and misuse. dormant accounts which have had no transactions for a continuous period of 2 years or more, inactive accounts where there's been no transaction activity in the last 12 months, and accounts that maintain a zero balance for a prolonged period. Second, we have new guidelines for fixed deposits with NBFCs and housing finance companies, where depositors can withdraw small deposits of up to 10,000 rupees prematurely without interest. For larger amounts, withdrawals are capped at 50% of the principal or 5 lakh rupees, whichever is lower. Third, starting the 1st of January, credit data will be updated fortnightly instead of monthly, because RBI has now asked banks and financial institutions to refresh records on the 15th and the last day of each month, or even more frequently as agreed with credit information companies. And this means for you and me, faster updates where our credit score could potentially change multiple times during the month versus once a month earlier. And lastly, the per transaction limit for UPI 123 Pay will now increase from 5,000 rupees to 10,000 rupees, while the limit for UPI Lite will increase from 500 rupees to 1,000 rupees. And this will particularly benefit underserved groups like senior citizens and rural users who have limited access to digital payment methods.
Well, that's right. Thank you so much, Ritu. Ritu, also, we're talking about the NPCI's volume cap that has come in. So the National Payment Corporation of India has extended a 30% volume cap for UPI apps for 2 more years. The NPCI has also removed the onboarding limit for WhatsApp Pay as well. Ritu, you tell us more on that?
In what's come as a relief for the two dominant UPI players, PhonePe and Google Pay, the National Payments Corporation of India has deferred the deadline to comply with the 30% cap on UPI transaction volumes by another 2 years until the end of December 2026. And this is the second such time that the NPCI has extended this deadline. It had first proposed this 30% cap for third-party UPI app providers in 2020 and then extended the deadline from December 2022 to December 2024. Now, this 30% market cap essentially aims to address the concentration risk in the UPI ecosystem, where the top 3 players, PhonePe, Google Pay and Paytm, command a staggering 92% of the market share together. PhonePe leads with 48% of the transaction volumes, Google Pay at 37% and Paytm around 7%, while the rest of the players have a very, very small share, all under 1% each. Now, this extension does not directly impact Paytm, which continues to have headroom to expand its UPI base, especially with the NPCI recently allowing it to onboard new users after a 9-month ban. But the extension does offer a breather for Google Pay and PhonePe, which now get 2 more years for compliance, even though that 30% cap does loom over the longer term. Now, in another important development, the NPCI has removed the UPI user onboarding cap for WhatsApp Pay. Now, remember earlier, WhatsApp Pay was allowed to grow its user base in a phased manner with a cap of 100 million users, but the removal of this cap means it can now extend the UPI services to the entire user base in India, which for WhatsApp is sizable and exceeds 500 million users.
Thank you so much for that, Ritu. Well, an important development there coming in as far as the payments interface system is concerned. And on the back of that, Paytm has seen a negative downtick today. The stock is down over 3% in the session. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Stocks trade in a range at the start of a new year on slim trading activity. Industrials and healthcare see some green, while realty and metal stocks are in the red. Bajaj Auto's December sales miss expectations as domestic volumes dip. M&M also misses estimates on total sales, but tractors see good growth at the cost of Escorts Kubota, which sees volumes decline. Ease My Trip CEO Nishant Pitti quits after looking to sell out of the company. Co-promoter and CFO Rikant Pitti will now assume charge as the CEO. The sequence of events is disconcerting for investors. Aviation turbine fuel prices in Delhi and Mumbai have been cut by around 1.5% each in a relief for airlines for whom this is a big operating cost. And CNBC-TV18's big market poll of over 60 fund managers reveals that expectations of equity returns are modest, with most eyeing under 11% returns in 2025. Those polled mostly prefer large caps, believe that earnings will be a key stock driver, and RBI will cut rates early in 2025 and the rupee will weaken further. Good afternoon, you're with us here on Halftime Report. I'm Hormus Fatakia, wishing all our viewers on CNBC TV18 a very, very happy new year and a prosperous one at that for 2025. Auto sales continue for the month of December. It may be the first day of the year, but the companies continue to report their sales numbers. Hyundai Motors has come out with their latest. The exports are down around 6% as of the month of December on a year-on-year basis. This is 12,870 units. The total sales absolutely flat, in line with the CNBC TV18 poll, 55,078 units. The poll was 55,000 units, and there is no significant impact really on the stock, absolutely flat in today's trading session. By the way, the market, though, at one point it did look like it was going to be a positive start for the year, but it does seem as though we are heading into familiar territory, hitting higher levels and then cooling off from there because there is no sustenance at the highs of the day. 23,780 is the high in today's session, and we are down almost 100 points from the highest point of the day is the Nifty, but still holding on to gains of around about 50 points. There are plenty of stock specific action though in the broader markets. A couple of PSUs that I wanted to address before we move, and that is SJVN is one of them. Vivek will talk about it more as we go ahead on the show. That stock is trading with healthy gains in today's session, 6% higher. Remember, SJVN has now delivered 4 consecutive years of positive annual returns starting 2021. So 110 on SJVN, 6% higher, and the other one is IREDA. We'll talk about that as well on the show. That stock too is trading with healthy gains, and it came out with its business update last night for the third quarter. Strong growth seen in both the disbursements and the loan sanctions as well, and IREDA gains of around 3.5%, slightly off the opening highs, but still around about 3.5% higher. Mind you, the stock is off almost 30% from its peak, and since then, and despite that, it managed to see returns of over 100% in 2024. But the big story of the day is auto sales, and they continue to trickle in. And we were talking more about that. I just mentioned numbers of Hyundai. And we'll be joined by Rima is joining in with more on these numbers. Rima, how do the numbers look like so far?
Well, let's start with Bajaj Auto, and that's a disappointing set of numbers. Total sales are down 1.1% on a year-on-year basis, lower than street expectations at 3.23 lakh units. Month on month, you are seeing a sharper fall, but that's not a fair comparison because the November month was boosted by festive season sales. What stands out for Bajaj Auto is the fact exports are doing very well. Exports went up by 70% and now contribute close to about 50% to the overall sales. Also, the company seems to be doing very well on the electric two-wheeler sales, where the company is now the market leader with a market share of 25% in the month of December as per the Vahan data. Now, for M&M, the passenger vehicles, which is basically the SUV business, that is doing very, very well. So total sales have gone up by 16%, and this is driven by SUV sales of about 18%. CV was a mixed bag, 9% growth, three-wheelers about 8%. Exports a very small base, but that's up nearly 70%. So for M&M, SUVs are doing well, the UVs, and secondly, on tractors. So M&M tractor sales have gone up by 20% in the month of December, outperforming an Escorts, where the total sales have declined by 10%. And the last one is Hyundai, where total sales have fallen by 2.4% on a year-on-year basis, but in line with street expectations. Back to you.
Rima, thanks a lot for that. And the other one, as I was just mentioning, is SJVN. That is seeing healthy gains in today's session. Vivek is joining in with more details on that. Vivek.
Well, SJVN, a recent entrant as far as the F&O space is concerned today, is doing quite well. Yesterday, the company gave an update to the exchanges as to the kind of PPAs or the kind of investments they intend to make in the state of Bihar. So the company has signed MOUs, which is Memorandum of Understanding, for multiple pump storage projects in the state of Bihar. So overall, the company says that they have committed close to 10,000 crore that they intend to invest in Bihar. For one particular project, they have gone ahead and shared more details as to the exact quantum of investment and what is it that they expect to go ahead and deliver. So the total commitment as far as the Hatida Durgavati PSP, which is now close to 1,000 megawatt, where the company will have 4 units of 250 megawatts of power capacity each. The project cost over here is close to 5,663 crore. The daily peak energy is expected to be in the range of 6.325 million units, which translates to an annual peak energy of 2,308 million units. Now, the company says that the leveraged tariff for this particular plant would work out close to 9.39 rupees per kilowatt hour, which is significantly high compared to what is it that you're seeing as far as the discovered tariffs in recent auctions are concerned. On the back of that, a positive development as far as SJVN is concerned. Not only that, when you're talking about the overall renewable power generation capacity, currently it's around 2.5 gigawatt. The company has committed to close to 17 gigawatt, a few of which are under construction, few of which that the company has committed to and will start construction soon. So overall, a positive development for SJVN. No wonder then the stock is doing quite well.
A positive start to the year for SJVN. Vivek, thanks a lot for that. And we are now being joined by Anuj. Anuj, good afternoon. Wish you a very happy new year. It almost seems like the Nifty is on a swing, right? The bulls pushing it from the behind, go a little higher, then the bears push it back.
Absolutely. Harmas, first of all, happy new year to you and to all our viewers. And I think the market's doing more of the same, just like we saw all through last year. A lot of ebbs and flows. Eventually, the market's not either breaking out or breaking down. It's been stuck in some kind of a range of that 500, 600 points. The good news, if you're a bull, is that the bank Nifty is defending the 200-day moving average. Third day in a row, we have seen support right at the 200-day moving average. Today's low, once again, coinciding with the 200-day moving average. Let's see what the last hour, the second half brings for us. Also, keep in mind, we are the only market, there are only 2 markets open today. We are one of them, and the other one is our neighbor, of course.
The only 2 markets that are functioning today, so absolutely no cues from across the globe. But it'll be interesting to see what the second half brings. For now, the Nifty around that 23,700 mark, still stuck in that range. Time for a short break. We'll tell you what's in store for the index and some trading ideas on the other side as well. Manish Hathirapani of Deen Dayal Investments will join in for the same. Stay tuned.
Welcome back. Well, the market's doing well. The Nifty is up 60 points and the Bank Nifty is up close to 200 points. Manish Hatramani of Deen Dayal Investments is now joining us on the show. Manish, good morning. Happy New Year. Tell us what's your view on this market and your stock ideas. Okay, I think there's some audio issue.
To all our viewers of CNBC, happy trading, happy investing. Well, I am working with a clear level of 24,000 to be precise on the resistance side. We have a long-term support that we have created, which was really the place where we bounced from, which was 23,400, 23,450. On the upside, unless we really don't cross the levels of 24,000 on a closing basis, I don't see the upside to resume. From my stock ideas, because I feel we are in a mixed bag, I'm working with one sell call and one buy. My sell is on a Bajaj Auto, which is for a target of 8170, stop loss of 9190. 8719 was the low which we made on 23rd of December, which has been punctured today. As a result of which, it's a weak candidate for a new lower target. We also have good volumes which are supporting and confirming the trend. On the upside, I'm giving a buy on Asian Paints for a target of 2440, stop loss of 2240. A good base building has happened around the levels of 2250, which has acted as a good support as well. Volume accumulation can also be witnessed on the charts.
Manish, what about some PSU names that are doing well in today's session, say for the likes of SJVN or even IREDA for that matter? I know IREDA, you may not have a very long-term chart because it listed only last year or in November of 2023. But what is the chart? What are the charts indicating here? SJVN is up almost 6%. IREDA is up almost 3.5%.
We are seeing some kind of a bounce on SJVN because we've made a support around 103, 104. However, today's high will be very important from a chartical parameter. We are seeing blocks of volume which are acting as resistance over here. Unless we don't get a close above 112 to be precise, we won't really see a bounce thereafter. And we can also exhaust the gap of 104 and fall. Therefore, it's a 104 support and a 112 resistance for this, which has now become range bound.
All right, Manish, thank you so much for joining in and sharing with us your views on the index and on specific stocks as well. Wish you a very happy new year. Moving on then, a stock that was in focus all through last year was Mazagon Dock. At least all three shipbuilders were in focus, but Mazagon Dock is in news today because it signed a contract worth almost 2,000 crore rupees with the Defence Ministry for the construction of units that allow submarines to stay underwater for longer. Now, earlier we spoke to Sanjeev Singhal, the chairman and managing director of the company, about the order and the future outlook as well for Mazagon Dock.
The Scorpion submarines, we have already delivered 5. The 6th one we are about to deliver, and we are likely to get another contract for 3 more Scorpion submarines. As far as my order book is concerned, as on 30th of September, we are around 38,000 crores. Of course, the third quarter figures are still under finalization, so a better view would be available in a couple of days from now. As far as 24-25 is concerned, we are expecting a growth of around 10 to 12% over last year. And going ahead also for FY26 also we are expecting a similar kind of a growth. I have been maintaining and I continue to maintain that as far as this industry is concerned, a 12 to 15% margin is a very healthy margin.
All right, let's do one thing. Let's take a break on that note. On the other side, we'll take a look at how the market's likely to shape up for 2025 with our mega CNBC-TV18 market poll. Stay tuned.
Three, two, 1, 0.
Welcome back. And Coal India just came out with its production update for the month of December, and offtake has grown by 2.5%. Production, though, is absolutely flat, up only 0.7% at 72.4 MT compared to 71.9 in the month of December last year. But the key number to watch out for is the fact that the year-to-date number, which is around about 543, and it has crossed that mark of 50% from their guidance that they had given of 838 million tons, and currently that number is at 543 for Coal India. That comes up to around 65% of their FY25 target, the production target. There were reports recently about some company officials as well who said that they might miss that target by around 10 to 15 million tons, but it remains to be seen where Coal India is headed. For now, for the first 9 months of the year, Coal India has managed to achieve 65% of its FY25 production target guidance, which was around 838 million tons. The stock nearing the highest point of the day, 0.7% higher at 387. But the Indian markets ended 2024 with positive returns despite a roller coaster ride. But the big question is, what is in store for the new year? Nimesh is here with this mega CNBC-TV18 market poll.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's a big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Oh, absolutely. By the way, just look at the market now. The Nifty is up 122 points, and the intraday chart would come up for you on the screen. And earlier in the day, I was making this point, around 9:30, that the market was creating a bit of a trap on the short side. Perhaps would have sucked in a lot of short traders. And if you look at the Bank Nifty, that momentarily broke the 200-day moving average, went 100 points below that, and from there on, you had a big rally which happened in the Bank Nifty. So the last few minutes, the move has been quite stunning. And if you look at the individual stocks, some of the stocks leading that are the two biggest stocks, HDFC Bank and Reliance. If you see intraday chart of HDFC Bank and Reliance, both have moved to high point of the day. And they are, of course, the two biggest contributors in terms of the Nifty. And, of course, HDFC Bank for Bank Nifty as well. But look at Reliance in the last few minutes. That's the one which has done a lot of work for the bulls. Let's move on then. As we move into the new year, we got in touch with Samir Arora of Helios Capital on the likely triggers for Indian markets going into 2025. Let's hear out his thoughts.
You take it from different pockets. You buy some stocks because they are growing well, but they have also performing well in the market, and some which are doing well but are cheap or value. And it is that combo of buying some financials and some of these high growth stocks that you're talking about, these food delivery or otherwise, or whatever be the new growth. Also, if you look at the FIIs, it looks as if FIIs are selling, but they're effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio from some of the older names that they may be having in consumer and auto and others, and buying into these new IPOs, which are, at least many of them or some of them, are offering high growth. So there is no point in ever talking about absolutely one or the other. Of course, you can have groups of sectors doing well and expectations of groups of sectors doing badly, but there is no overdoing anyone, I would say, because you really never know what fancy the market takes.
No, I agree. But, you're a veteran of, how many cycles in the market? Probably 30 years. So right. At this juncture, bhagta hua ghode ke piche hi bhago, EMS, e-commerce types, mid caps, put a larger share in the one that did not perform, HDFC Bank. I mean, you can't complain about the quality of some of these stocks, but not their best year.
So that's why we have, I think, a good description of these. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market. And you have more money than otherwise. And then you have these smaller, newer, faster growing, where you keep a limit on each stock and you diversify across the different themes and have, maybe in our case, maybe around 15, 18%, but that also in 5-6 stocks. And it is that combo which lets us sleep every day without overly one. If you say you have to make only one investment and that one investment is the marginal new investment, then also there's an easy answer. It depends on what you don't have.
You're saying only 15 to 18% of your portfolio would be in some of these smaller, faster growing companies, while 85 to 90% or whatever, 80, 90% would be in these, large cap HDFC type bank. Okay.
No, the larger, well-known, these compounder names that were given, which spoiled their compounding immediately when that name was given, those are 50, 60%. Okay. These 18, 20% are these super high growth guys, which are these, 25, 30% and growing also, but making losses, maybe all these Paytm, Swiggy, Zomato types. And you still have a third group. No, these are the groups where you are discovering new companies and they might be a little valued a little cheaply, or their growth is a little high, but you're not expecting them to make 25 and 30% for 4-5 years. This could be Indigene types or these smaller hotels or something, which are not also super well known, not super well ready in terms of quality and history, but they are promising, and we are trying to discover some of them. So there are sort of
Do you
three.
want to tell us some of these stocks that you're discovering?
No, we
like
don't
Indigene is
not
one.
tell you
Yeah.
anymore, because now we are also separately in the mutual fund business. So you can see 100% of the portfolio every year, including the changes that the Indian guys make. And broadly, although I manage an offshore fund, because the research is common, many of these names will be there. But so you can see all of them yourself. There's nothing for me to highlight here separately.
So Samir, you spoke about that, how FIIs may not be putting money in the secondary market, but they are in the Indian equity market by participating in IPOs, QIPs, etc., in the other forms of fundraise that is taking place. Is there any more nuance to this? Is there a preference that FIIs are gravitating towards? Have you done any analysis on this?
No, so my big picture, I don't do all this analysis. I just interpret other people's analysis. But big picture, out of the 20 odd years, if you see all this data, there are only 4 actual calendar years in which the FIs have been negative. Okay. Now this year you can say they are sort of break even on an aggregate basis. Adding both primary and secondary. But you can draw this conclusion that the stocks and the sectors that they are liking now in terms of is basically what I was saying, that diversify a little bit away from the old sectors to a little bit to the new sectors. So that is one big picture. But second is not to think in absolute that the FIIs are writing off India and selling India, because as you can see in the percentage years, you can see it in the years in which their flows are negative, that you can attribute it to something specific. In 22, the interest rates hiked from whatever 0.5 to 5%, and there was a war. In 18, we had this crisis. In 13, it was that, then before Raghuram Rajan came, whatever, the currency fell 28% or whatever, 19%, and the market fell 28%. And then one was 2008. So to take those 4 years and say, oh, FIIs, will they buy or not buy? Mostly you have to assume they will buy, mostly.
Samir Arora there on the road ahead for the equity markets. By the way, flashes on your screen. Sources are telling CNBC TV18 that the cabinet has approved some important proposals for fertilizer companies, and they have approved a special package for the next 12 months. And there is also a proposal to make the Fasal Bima Yojana attractive to farmers. And these are some of the proposals that have been approved by the first cabinet of the year, the union cabinet I'm talking about. There'll be a briefing taking place at 3 in the afternoon. This is, of course, source-based information that CNBC TV18 has managed to secure. The government will also provide financial assistance for companies that are in the manufacturing of DAP. So some of the fertilizer stocks reacting to this, GNFC, Deepak Fertilizers, even RCF is up around about 3% in today's trade. We'll get more information on this.
Yeah, just to highlight, this is CNBC Awaaz exclusive.
Oh, that's the CNBC Awaaz exclusive as well, indeed.
But it's the same network, of course. But, yes, Lakshman's, of course, broken this news. I'll try to get Lakshman as well on the channel and, get more details on that. But the stocks have done well, of course. I think Coromandel, Deepak, those are the ones which really benefit from that. Basically, the choices, there were 2 choices. Either let these companies raise prices or give them more subsidy support. Now, it's a very sensitive topic. You can't let them raise prices. So this seems to be the only other option. So that's why that's, of course, the first cabinet decision of this year that we have. Let's see if we get Lakshman and he'll fill us in with the information. Meanwhile, we can take a break actually and move on.
But before we move into that break, here's some good news for our viewers, because India's business news leader is now just a click away, and we are presenting to you CNBC TV18's all-new app, where you can get instant access to in-depth articles, financial world updates, and all the research at your fingertips. You can download the app from the Apple Store or the Google Play Store right away.
lead is very clear because we have already the programs announced. Chandrayaan 4 is announced. We have the Bharatiya Antariksha Station building is announced. Mission to moon and landing on the moon is planned. So all of this requires docking. Docking will start from tomorrow onwards. Many processes will happen, but final docking will take place possibly by 7th of January.
This is the 99th launch of any launch vehicle from Satish Dhawan Space Center. So that's also very important now.
Welcome back. Highest point of the day, the Sensex now up 460 points, the Nifty up 120 points, and the Bank Nifty, of course, 250 points. The mid-cap index has underperformed today, but don't let that fool you because it's because of just a couple of stocks which are having high weight in the index. The advanced decline is very strong, actually. It's about 2.5:1 or slightly better than that. So the broader market action is quite good, actually, today. The mid-cap index perhaps not reflecting that. But let's move on then as the equity market looks ahead into 2025. Surabhi gets us the 5 key factors the market will be looking out for as we move into this new year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full-year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
There is a lot to watch out for in 2025 as well. Surabhi, thanks a lot for that. On to the money markets then, where the rupee remains range-bound today. The domestic currency has ended 2024 weaker by over 3%. Now, economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025 against the dollar. Lata Venkatesh is here to map the macros in 2025. Lata, take us through the poll findings.
Well, the Indian rupee will slide to 86.25 by March 2025 and to 87 by the year end. That's according to a poll of economists and bank treasury heads done by CNBC-TV18. Treasury heads, of course, varied in their levels. The range for March for the rupee was 85.40 to 86.5. But for the year, the economists' forecasts lie between 86.75 and 87.5. That's by December 31. An overwhelming majority expect a rate cut in February, taking the repo rate to 6.25 from 6.5 today. But that will move the 10-year bond yield only a bit to 6.7%, bankers told us. By the year end, however, the hope is equally divided between those who see one more rate cut and those who see two more rate cuts. So the repo rate could be at 6% or could be at 5.75, 50-50 vote on that. However, the 10-year bond yield is not seen going below the 6.5% mark in 2025. GDP growth is on an average seen at 6.4% for FY25, with the range of forecasts being 6.3 to 6.5, while the FY26 growth is seen at 6.6%. Again, the range here is 6.5 to 6.8%. Inflation in the current year, FY25, is seen averaging 4.8%, which is the Reserve Bank's forecast. For next year, that is FY26, the poll shows that CPI inflation may average between 4.4, around 4.4%. The range is 4.3 to 4.5%. Finally, the current account deficit is seen at 1.35% this year, FY25, and 1.2% next year, which is very much within the Reserve Bank's comfort zone. All told, prepare for at least a 2% depreciation of the rupee and a slightly downbeat growth. Of course, that will mellow inflation and don't expect aggressive fall in bond yields.
All right, Lata, thanks a lot for that. We'll take a break and we'll come back. We'll track some more stock-specific action for you on the other side.
We are going for the 100th launch and in the beginning of next year.
(2024) has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage.
Back with us here on Halftime Report. The Nifty continues to remain around that 23,750 mark, but then there are plenty of movers on the broader market space, and we'd like to first highlight Tanla Platforms. That stock is up around 8.5% in today's trading session and on very strong volumes as well. And that is the stock, the sharp spikes in Tanla Platforms around about 10:30, and since then it has managed to hold on to those gains. It's the fifth in the last 6 trading sessions that the stock has gained. Also pull up Power Mech Projects. That stock also won an order from Adani Power today. That is the second order that it has won from Adani Power in the last 1 month. So 3.5% higher on Power Mech as well. On the further on the upside is Blue Star. That stock is trading at a record high in today's trading session. So a strong start to the year for Blue Star as well. 4.5% higher on the stock and is building on to those gains, nearing the highest point of the day. But Yash is now joining in to shed some more light on the insurance sector and the top 5 things that you need to watch out for going into the new year. Yash.
Well, Hormaz, 2024 was also quite an eventful year as far as the insurance sector is concerned. Multiple regulatory reforms coming in, the companies adjusting to those reforms. And what was interesting is that a lot of reforms are spoken about, which we will, get to see unfolding in 2025 as well. As far as top 5 reforms, which one should watch out for, are concerned, the first one would be the FDI in insurance sector. That is expected to be raised to 100% from the current 74%. Of course, the intention is to get more and more foreign players, more and more capital into the insurance space to cater to, of course, insurance for all. That's the aspiration which the regulator has. The second important one would be with respect to GST changes on health as well as term life insurance. The last GST council meeting which happened, of course, there were discussions about it, though no conclusion could come out of it. But of course, expected that the next GST council will be able to decide on making changes to the GST rate as far as health insurance and term life insurance is concerned. The third one is with respect to regulatory concerns and a possible regulatory action as far as concentration of business through distribution channel is concerned. We've been reporting how the regulator, finance minister, they've expressed concerns with respect to the bancassurance channel. For regulator, of course, concentration of business from one channel is also another concern. So, of course, that will be one key point to watch out for in 2025 and any potential action there. The fourth one would be with a few new things coming up in the insurance sector, having very structural reforms, progress on risk-based capital, risk-based monetary, IFRS, Bima Trinity, which has Bima Sugam, Bima Vistar, Bima Vahak. All those new things are expected to come up. And finally, the current IRDAI chairman, Debashish Panda, his term also ends in March 2025. All these reforms have taken place under his leadership at IRDAI. It remains to be seen if an extension comes from the side of government and whether he expects and decides to continue or not.
Interesting. Plenty of things to watch out for in the insurance space as well. Yash, thanks a lot for that. Now, India's capex story has been changing the game, especially in 2024. India's growth story has been getting a major boost from this massive capex push. Vamakshi breaks down the year that was for India's infrastructure boom.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government capex side, rising welfare spending is becoming a challenge. With the enforcement of the 3% fiscal deficit limit likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. Capex has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state capex is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.67 lakh crore in the first half of FY25 to just 28,300 crore by the end of November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp up in large, lumpy capex projects. Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, the groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
We'll all watch out for how this story unfolds. Vamakshi, thanks a lot for that. Time for a short break. Up next, Manisha Gupta joins in with Naveen Masur, the Director of Commodity and Currency at Anand Rathi Shares and Stockbrokers. Stay tuned, back on the other side.
On micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be
Welcome back, and joining us on the show now is Naveen Mathur. He is Director at Commodities and Currencies at Anand Rathi. Naveen, hi. Wishing you a very, very happy and prosperous 2025. First day of the year. We do understand that many of the countries are still celebrating and the volumes are on the lower side. But even with that, there are some cues that we are seeing in many of these commodities here. I'll start with the crude oil prices, and we've seen 2 years of negative returns. But this year, we've started slightly on a positive note, and that's on the back of stronger data coming in from China in sense of PMI and factory orders. How are you looking at 2025 panning out when it comes to crude oil?
Thank you very much, Manisha. Wishing you, the entire crew of CNBC, a very happy new year, and to all the viewers who are there on this show. It's been a very great year for commodities, I would say, particularly for bullion, and not that for the crude and the natural gas. Natural gas has been one of the largest return-generated commodity in 2024. Speaking about crude oil, the kind of range-bound movement which we have seen, we did saw markets going back to around 71. They touched even $88, $85 levels in the middle of the year because of the geopolitical tensions. So largely, the crude oil prices, what we expect would be in the range of 70 to 75. I'm talking about the WTI contract, Manisha. In 24, we did saw around 3% of decline in the crude oil, and it's a continuous decline for the last 2 years, 2023 also and 2024. There would be stimulus coming in from China, which may be positive for the metal packs, including the industrial metals and the energy markets. But I would say that the crude oil in international markets, particularly the WTI, would be in the range of around 76 on the higher side and 70, 71 on the downside. So we are currently at around $72 level, 71.72 to be more precise.
All right, so a range-bound trend will continue for the crude oil prices with slight upsides that you can expect onto this one. But yes, the year totally belonged to gold and silver, where we did see all-time highs. And while gold put in the best performance on a yearly basis since 2010, it was the best year for silver as well since 2020. When you look at gold and silver, where is it that you would want to put in more investment for the year 2025?
Manisha, I think the gold and silver has been one of the best of the commodities, I would say. The gold has given returns to an extent of around 27% if you talk about in the dollar terms, and Indian markets about 21 to 22% in rupee terms. Even the silver has given around 21.5% returns for the spot silver in dollar terms, and Indian markets around 17-18%. So overall trend still remains positive. For, I would say, for the next year, not kind of returns which we have seen over the last year. Couple of factors, the China demand, as you rightly mentioned. So the upside we have seen new multiple highs, all-time highs in gold in the last year, 2024. Approximately 38, 39 times what I understand. The gold prices have touched an all-time high. The highest was $2,790 around on the 28th of October. So Indian markets also did saw silver touching a lakh plus per kg. So I think the markets would be pretty much range bound. Kind of a little decline we may see because of the dollar appreciation. And we did saw that current prices are at around 2,624 in international space. And in Indian markets too, we are seeing around 76,800 levels on the MCX. So overall trend in terms of dollar, if you really ask me, would be 2,550, 2,500 on the downside and 2,700 or 650 on the upside. Would be range bound for the next quarter. But we might see a positive pull out on gold, which might take the prices to an extent of 2850 or so. That's the highest, but nothing beyond those numbers, what we see as of now for gold. And even for silver, we did saw $31 levels, $35 levels in October. The highest has been April 2021, when it did touch 49 plus dollar levels. And Indian markets, as I said, 1 lakh. So overall, 89 to 90,000 levels for silver in quarter one. And for gold, as I mentioned, around 78, 79,000 for quarter one. Means the only thing positive for the Indian gold prices is the rupee depreciation.
Rupee depreciation, yeah. Oh yes.
And therefore 77 or so spot figure for gold for the first quarter of this year.
Naveen, thank you so much for that. We've noted all of those levels there. So some bit of a range-bound trend is what you could see in case of crude oil prices. Gold and silver still a buy. But, well, yes, $3,000 an ounce, perhaps not a possibility is what Naveen thinks. Well, with that, that's all the time that we have on the show. But stay tuned, because after the break, Business Lunch will take all the action forward.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5.
Stocks move to the day's high after a flat start at the start of the new year. Industrials and healthcare see some green, while realty and metals are in the red. Bajaj Auto's December sales miss expectations as domestic volumes dip. M&M too misses estimates on total sales, but Tractor sees a good growth at the cost of Escorts, which sees a volume dip. The National Payments Corporation delays the plan to limit the volume of UPI transactions to 30% for each payment app until the end of 2026. The move is a big boost for Google Pay and Phone Pay, which commanded more than 80% of UPI market share. Zomato's quick commerce arm Blinkit records its highest per minute and per hour orders on New Year's Eve. Swiggy's Instamart too notches record orders, topping its festive season highs. CNBC-TV18's a big market poll of over 60 fund managers reveals that expectations of equity returns are modest, with most eyeing under 11% returns in 2025. Those polled mostly prefer large caps, believe earnings will be key stock driver. RBI will cut rates early in 2025 and the rupee will weaken further. Hello, good afternoon. You've tuned into Business Lunch on CNBC TV18 and I'm Vinny Motiwala. A quick look at what the market is doing this hour. We surely saw the recovery coming in from the day's lowest point. Nifty as of now holding on to 0.4% of gain. 23,700 is what it's managing to hold on to. That's the Nifty. In terms of the contributors that are coming in also, that is important to watch out for. We had the Nifty Bank that is doing well. So 0.4% of gains there. And in terms of contributors also, we have HDFC Bank that's coming in top of the list, as well as L&T, M&M and Reliance that is supporting the move coming in from the Nifty. On the flip side, with Bajaj Auto, Hindalco, SBI and Tata Steel that are a bit of a drag in terms of the Nifty contributors. Mid and small cap today, especially the small cap, Nifty small cap, that's seeing a sharp uptick in trade today. Mid cap is holding on to mild gains, but outperformance is coming in from the Nifty small cap side, up 0.7% in trade. Let's look at the Nifty 500 gainers and some of these individual stock moves that we should be talking about. We have some of the names coming in like Century Ply, Tanla Platform, as well as SJVN in the broader market front, which are managing to hold on to very good gains, and Nifty 500 also managing to hold on to gains of 0.3% in trade. But let's begin the show by focusing on the sales numbers for the month of December 2024 for the auto sector. How are they trickling in? What are they looking like? Rima is going to join in with us to tell us more on that.
Well, let's start with Bajaj Auto, and that's a disappointing set of numbers. Total sales are down 1.1% on a year-on-year basis, lower than street expectations at 3.23 lakh units. Month on month, you are seeing a sharper fall, but that's not a fair comparison because the November month was boosted by festive season sales. What stands out for Bajaj Auto is the fact exports are doing very well. Exports went up by 70% and now contribute close to about 50% to the overall sales. Also, the company seems to be doing very well on the electric two-wheeler sales, where the company is now the market leader with a market share of 25% in the month of December as per the Vahan data. Now for M&M, the passenger vehicles, which is basically the SUV business, that is doing very, very well. So total sales have gone up by 16% and this is driven by SUV sales of about 18%. CV was a mixed bag, 9% growth, three-wheelers about 8%. Exports a very small base, but that's up nearly 70%. So for M&M, SUVs are doing well, the UVs, and secondly on tractors. So M&M tractor sales have gone up by 20% in the month of December, outperforming an Escorts, where the total sales have declined by 10%. And the last one is Hyundai, where total sales have fallen by 2.4% on a year-on-year basis, but in line with street expectations. Back to you.
Thank you so much for that, Rima. Let's move on to another stock that has been in focus is Easy Trip. Now, Ease My Trip CEO Nishant Pitti has quit a day after looking to sell out of the company. Co-promoter and CFO Rikant Pitti will now assume charge as the CEO of the company. Hormaz is joining in with us to give us more details on this. Hormaz.
More news coming in on Easy Trip. It's been in the news all through the week. Monday evening, Nishant Pitti announces that he wants to sell out of the company. Tuesday, the block deal does happen. happen, but only 1.5% of that 14% potential stake that he wanted to sell gets sold. But now the big development that has come in is that Nishant Pitti has announced his resignation as CEO with immediate effect, and he has cited personal reasons for his resignation, and he has not cited any other detail or explanation in that resignation letter. It only mentions that he is resigning with immediate effect and due to personal reasons. Now Rikant Pitti has been appointed as the CEO and the co-founder with immediate effect, but Nishant Pitti, now he's been on the board of Ease My Trip since 2008, and Rikant and Prashant Pitti had joined the board only in 2011 and 2016 respectively. So how does the board look like now? Because Nishant Pitti was chairman as well as CEO. His resignation letter mentions he's only resigning as CEO, so he will now only be chairman and executive director, while Prashant Pitti remains who he is, the managing director and an ED. But Rikant Pitti, who was the executive director, now also takes charge as CEO, and he'll also be designated as a co-founder of the company. Now, we spoke of Nishant Pitti's plans. There has been his plans have also kept the stock in the news, whether it be the SpiceJet for tying up with SpiceJet to bid for Go First, or the plans to manufacture electric vehicles, or his initiatives now to sell out of the company. He had sold 14% in September. He'd sold a 3.5% stake in June as well, and that is when the promoters had come on the channel and mentioned that they had no other plans to sell any further stake in the company. And interestingly, Nishant Pitti has also been a co-producer of a lot of Bollywood films as part of his co-branding initiatives, and he's been part of films like Fanne Khan, Batti Gul, Meter Chalu, and even Manikarnika, which was a recent release as well. So no significant reaction in the stock, but a major top-level rejig at Ease My Trip.
Absolutely. Hormaz, thank you so much for that update coming in on Ease My Trip. But let's move on. The Indian market ended 2024 with positive returns despite a roller coaster ride. But the big question, what is in store for 2025? Ramesh is joining in with us to give us those details.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Absolutely, Nimesh. Thank you so much for that. But let's move on to the money market, where the rupee remains range-bound today. The domestic currency has ended 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025. Lata Venkatesh is here to map the macros in 2025. Lata, take us through the poll and the findings of the poll.
Well, the Indian rupee will slide to 86.25 by March 2025 and to 87 by the year end. That's according to a poll of economists and bank treasury heads done by CNBC-TV18. Treasury heads, of course, varied in their levels. The range for March for the rupee was 85.40 to 86.5. But for the year, the economists' forecasts lie between 86.75 and 87.5. That's by December 31. An overwhelming majority expect a rate cut in February, taking the repo rate to 6.25 from 6.5 today. But that will move the 10-year bond yield only a bit to 6.7%, bankers told us. By the year end, however, the hope is equally divided between those who see one more rate cut and those who see two more rate cuts. So the repo rate could be at 6% or could be at 5.75, 50-50 vote on that. However, the 10-year bond yield is not seen going below the 6.5% mark in 2025. GDP growth is on an average seen at 6.4% for FY25, with the range of forecasts being 6.3 to 6.5, while the FY26 growth is seen at 6.6%. Again, the range here is 6.5 to 6.8%. Inflation in the current year, FY25, is seen averaging 4.8%, which is the Reserve Bank's forecast. For next year, that is FY26, the poll shows that CPI inflation may average between 4.4, around 4.4%. The range is 4.3 to 4.5%. Finally, the current account deficit is seen at 1.35% this year, FY25, and 1.2% next year, which is very much within the Reserve Bank's comfort zone. All told, prepare for at least a 2% depreciation of the rupee and a slightly downbeat growth. Of course, that will mellow inflation, and don't expect aggressive fall in bond yields.
Thank you so much for that, Lata. But on that note, we're going to slip into a very short break. Up next, NPCI extends a 30% volume cap for UPI apps for 2 more years. We tell you more about this after the short break.
In 2025, only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house.
Welcome back to Business Lunch on CNBC-TV18. Let's move on, and as we enter a brand new year, be ready for a slew of changes in the way we transact. Ritu Singh is joining in with us to tell us the 4 big changes that have come into effect from today and how they will impact our lives. Ritu, take it away.
The new year ushers in some major updates across the financial landscape, and here's a quick summary. Starting this year, RBI will implement new guidelines leading to the closure of 3 specific types of bank accounts to prevent frauds and misuse: dormant accounts which have had no transactions for a continuous period of 2 years or more, inactive accounts where there's been no transaction activity in the last 12 months, and accounts that maintain a zero balance for a prolonged period. Second, we have new guidelines for fixed deposits with NBFCs and housing finance companies, where depositors can withdraw small deposits of up to 10,000 rupees prematurely without interest. For larger amounts, withdrawals are capped at 50% of the principal or 5 lakh rupees, whichever is lower. Third, starting the 1st of January, credit data will be updated fortnightly instead of monthly, because RBI has now asked banks and financial institutions to refresh records on the 15th and the last day of each month, or even more frequently as agreed with credit information companies. And this means for you and me, faster updates where our credit score could potentially change multiple times during the month versus once a month earlier. And lastly, the per transaction limit for UPI 123 Pay will now increase from 5,000 rupees to 10,000 rupees, while the limit for UPI Lite will increase from 500 rupees to 1,000 rupees. And this will particularly benefit underserved groups like senior citizens and rural users who have limited access to digital payment methods.
Thank you so much for that, Ritu. And in its first cabinet meeting of the year, the government has approved a special package for companies manufacturing ammonium phosphate-based fertilizer. CNBC Awaz's Lakshman is joining in with us to tell us more details of this. Lakshman?
देखिए, यहाँ जो मुझे सूत्रों से जानकारी मिली है, उसके मुताबिक नए साल की पहली कैबिनेट में किसानों के लिए 2 अहम प्रस्तावों को मंजूरी मिली है। पहला प्रपोजल जो किसानों के लिए था वो ये था कि फर्टिलाइजर की कीमतें ना बढ़े, इसके लिए सरकार स्पेशल पैकेज देगी। तो जो सूत्र बता रहे हैं उसके मुताबिक कैबिनेट ने डीएपी बनाने वाली कंपनियों के लिए 1 साल के लिए स्पेशल पैकेज देने के प्रस्ताव को मंजूरी दी है। ये जो स्पेशल पैकेज होगा, इसके तहत सरकार डीएपी बनाने वाली कंपनियों को फाइनेंशियल इंसेंटिव देगी, यानी आर्थिक मदद देगी। ये जो फाइनेंशियल इंसेंटिव होगा, दरअसल डीएपी बनाने वाली कंपनियों को सरकार जो सब्सिडी देती है, न्यूट्रिएंट बेस्ड सब्सिडी, उस सब्सिडी की रकम के ऊपर होगा, यानी एडिशनल रकम होगा जो फाइनेंशियल इंसेंटिव के तौर पर दिया जाएगा। ये इसलिए ऐसा दिया जा रहा है क्योंकि सब्सिडी सरकार ने फिक्स कर रखी है, न्यूट्रिएंट बेस्ड सब्सिडी। इसके बाद लगातार कच्चे माल की कीमतें, रॉ मटेरियल की कीमतें लगातार बढ़ रही हैं। इस वजह से फर्टिलाइजर कंपनियों की लागत, कॉस्ट ऑफ प्रोडक्शन काफी ज्यादा बढ़ रही थी। तो उन्होंने डिमांड की थी कि या तो हमें बाजार में दाम बढ़ाने की छूट दी जाए या फिर हमें अतिरिक्त मदद दी जाए। तो सरकार ने कहा दाम मत बढ़ाइए क्योंकि इससे किसानों को नुकसान होगा, लिहाजा सरकार ने एडिशनल फाइनेंशियल इंसेंटिव देने के प्रस्ताव को मंजूरी दी है। बता दूं कि पिछले साल भी यही सब्सिडी दी गई थी, जिसके तहत इंसेंटिव पैकेज दिया गया था, जिसके तहत 3,500 रुपए प्रति टन डीएपी पर सरकार ने स्पेशल इंसेंटिव देने का ऐलान किया था। इसके तहत करीब 2,500 करोड़ रुपए सरकार ने पैकेज के तौर पर दिया था, लेकिन उसकी मियाद अब खत्म हो गई है। अब ये जो नया पैकेज दिया गया है कैबिनेट की तरफ से, जो सूत्र बता रहे हैं, वो 1 जनवरी 2025 से लेकर 31 जनवरी 2025 तक के लिए होगा, और ये भी प्रति टन के हिसाब से एडिशनल फाइनेंशियल इंसेंटिव दिया जाएगा। दूसरा जो प्रस्ताव मंजूरी दी गई है वो ये कि फसल बीमा योजना की शर्तों को, कंडीशन को ज्यादा ईज किया गया, आसान बनाया गया है, ताकि किसानों के लिए वो ज्यादा आकर्षक हो। तो फसल बीमा के नियमों में, शर्तों में भी सरकार ने बदलाव करने का फैसला लिया है।
Thank you for that, Lakshman. But let's move on and to the Defence Minister Rajnath Singh has said that 2025 will be a year of reform in the defence sector. What is that going to be? More details on that. Parikshit is joining with us. Good afternoon, Parikshit.
Well, yes, India has a target of rupees 3 trillion in defense production by financial year 2029 and also achieving 50,000 crore in defense exports. And in order to lay out a roadmap for that, the Defence Minister held a review meeting last evening. He met all the secretaries of the Defence Ministry, and the focus was on 8 or 9 key reform areas. And that's why they have announced 2025 as a year of reforms in the defence sector. Number one, increasing and bolstering jointness and integration initiatives and facilitate establishment of integrated theatre commands. This is to ensure that we are better prepared for any future wars and conflicts. Then reforms should also focus on new domains such as cyber and space and emerging technologies like AI, machine learning, hypersonics, robotics. Associated tactics, techniques and procedures required to win future wars should also be developed. Now, we have seen how there are threats in the AI world through the cyber world to India as well. So clearly there is going to be a reform push in this direction. Then having a shared understanding of operational requirements and joint operational capabilities through inter-service cooperation and training, simplifying acquisition procedures, making them more time-sensitive to facilitate swifter and more robust capability development, facilitate technology transfer and knowledge sharing between the defence sector and civil industries and also Indian defence companies and foreign defence OEMs. So let's see what happens. But clearly, the defence industry is hoping for a big capex push in the budget, especially for modernization and capital acquisition.
Okay, Parikshit, thank you so much for the latest update coming in on that front. But let's move on. And National Payments Corporation of India has extended a 30% volume cap for UPI app for 2 more years. Now, the NPCI also removed the onboarding limit for WhatsApp Pay as well. Ritu is joining in the task again to tell us more on this front. Ritu?
In what's come as a relief for the 2 dominant UPI players, PhonePe and Google Pay, the National Payments Corporation of India has deferred the deadline to comply with the 30% cap on UPI transaction volumes by another 2 years until the end of December 2026. And this is the second such time that the NPCI has extended this deadline. It had first proposed this 30% cap for third-party UPI app providers in 2020 and then extended the deadline from December 2022 to December 2024. Now, this 30% market cap essentially aims to address the concentration risk in the UPI ecosystem, where the top 3 players, PhonePe, Google Pay and Paytm, command a staggering 92% of the market share together. PhonePe leads with 48% of the transaction volumes, Google Pay at 37% and Paytm around 7%, while the rest of the players have a very, very small share, all under 1% each. Now, this extension does not directly impact Paytm, which continues to have headroom to expand its UPI base, especially with the NPCI recently allowing it to onboard new users after a 9-month ban. But the extension does offer a breather for Google Pay and PhonePe, which now get 2 more years for compliance, even though that 30% cap does loom over the longer term. Now, in another important development, the NPCI has removed the UPI user onboarding cap for WhatsApp Pay. Now, remember earlier, WhatsApp Pay was allowed to grow its user base in a phased manner with a cap of 100 million users, but the removal of this cap means it can now extend the UPI services to the entire user base in India, which for WhatsApp is sizable and exceeds 500 million users.
Thanks so much for that, Ritu. But on that note, we're going to slip into a very short break. But when we return, we will look at some record orders made on quick commerce platforms during the New Year's Eve. Stay tuned in for some interesting data after the break.
% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Welcome back. You're tuned into Business Lunch on CNBC TV18. A quick look at what the market is doing. 23,700 is what the Nifty is managing to hold on to as of now. Gains of almost 0.4% is what it's holding on. Nifty Bank holding on to gains of 0.4% in trade. And the outperformer today is coming in from the broader markets. That's the Nifty Small Cap is seeing a clear outperformance coming in. We have MOIL. We have some flashes coming in at the bottom of the screen also in terms of some pricing action that happened. So that is why MOIL also is in focus, and we saw an uptick coming in for MOIL. So keep an eye out. Stock is at the day's highest point as of now. And this is in terms of prices of all SMRG, which is seen some bit of an increase over there. So yes, that's something to focus on. But on that note, let's move on. And quick commerce platforms, those are in focus today, especially Blinkit, Swiggy, and Instamart. They've marked a record number of orders as on the eve of New Year's, bringing in the New Year surely with a bang. Shilpa, what are we watching out for now? What were those numbers that were there?
Yeah, well, it's yet another year that's been for quick commerce players of, record-breaking orders at the night. And, this is as India took to their phones to order in their New Year party needs. Now, let's start with Blinkit. Blinkit saw the highest ever orders in a day and highest ever orders per minute and per hour as well. And in terms of trends, last night saw the most number of chips and the most amount of grapes being sold in a single day. The biggest order for Blinkit came from Kolkata, worth 64,988 rupees. Now, if you look at Instamart too, Instamart saw its highest ever orders, double of last year. And consumers, what did they look for? Milk, chips, chocolates, grapes, paneer. Instamart, in fact, sold over 5 lakh packets of chips, and orders for party needs saw a major spike. Colas, for instance, up nearly 400%. Non-alcoholic beers up over 1,500%. And cocktail mixers also up about 2,500%. And it's not just metros, Bhubaneswar and Mangalore actually emerged as the busiest cities, with their biggest order also this year coming from Goa actually, and that was worth 70,300 rupees. Now, Zepto also grew over 200% over last year on New Year's Eve. Now, Big Basket co-founder Hari Menon also shared that as of 8 p.m. last night, orders for things like games, party cutlery, soft drinks, mixers, all of these were up anywhere between 200 to 500% on Big Basket, with Ice Cube orders, in fact, growing over 1,500% last night. Now, but what I think was the most interesting trend, however, this year was that of grapes. The highest ever orders on a day in Blinkit and among the most searched on Instamart. And why was that? Well, this is a Spanish tradition of eating 12 grapes at 12 midnight for good luck, one for every month. So lots of good luck being wished for 2025, and a party definitely for all the quick commerce platforms. Back to you.
Absolutely. A party for all the quick commerce platforms is what we're watching out for. But, with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. But as we leave you with some visuals of New Year's Day celebration across the globe. So stay tuned in to CNBC TV18 and have a very happy New Year.
Good afternoon and welcome to Midcap Radar. I'm Vivek Iyer and with me today is Hormaz Fatakia. Good afternoon, Hormaz. We've started off 2025 on a strong note, on a green note, especially with the broad end of the markets. Once again, going ahead and marginally outperforming the benchmark indices. It's a green screen, as you can see at the top. And overall, it does look as though 2025 has started off on a strong note. We still have a couple of hours to go for markets to close, but hopefully we end with the green today.
Well, usually they say what you do something good on the first day, it continues to happen through the rest of the year, right?
Exactly.
So the bulls would definitely be hoping that the green screen remains green until the close of the session as well, and that percolates into the rest of the 364 days of 2025 as well. But these are the headlines that we are looking at 1:30 this afternoon. Stocks have moved to the highest point of the day after a flat start to the new year. Consumer durables, FMCG and banks are leading the gains, while realty and metals are in the red. Mid-caps relatively outperform.
Bajaj Auto's December sales missed expectations as domestic volumes dip. M&M too misses estimates on total sales, but tractors see good growth at the cost of exports. Exports, however, sees volumes dip.
Karur Vysya Bank climbs nearly 3% on the back of its quarterly business update. The bank sees strong deposit growth. However, the net interest margins may come under pressure.
SJVN gains in trade as it signs multiple MOUs for pump storage projects in the state of Bihar. The company commits to investments of rupees 10,000 crore for these projects. Well, good afternoon. Welcome to Midcap Radar. It's the midcap end of the markets, remember, that outperformed as far as 2024 was concerned. The Nifty gained just around 8.8%, but it was the midcap and small cap indices that gave gains in excess of 20% each. But what we need to watch out for is whether this particular outperformance can continue in 2025 as well, especially given earnings, which has been a bit of a dampener, and also valuations, which are quite lofty. But we have quite a lot lined up on today's show. Upasana today is standing by the wall, and this is our special segment, Midcap Movers. Upasana will take us through the midcaps that are moving around in the session.
Well, first up, let us look at the top gainers in today's trading session. First up is Suzlon Energy is one of the top gainers even today. It gains nearly about 4.5% in 2 days. Next up is JSW Infra, followed by IRB Infra, Muthoot Finance, which is the stock is at a 52-week high even today, as highlighted yesterday as well. And next up is Bharti Hexacom. Now let us look at the top volume buzzers for today. Vodafone Idea continues to remain in focus, surging on high volumes even today, followed by IRB Infra. The stock is nearly up about 4% in today's trading session on the back of high volumes. Next up is Yes Bank. The stock is nearly flat at this point of time, but buzzing on high volumes. IDFC Bank also in focus, up nearly about 2%. Now, on the flip side, let us look at the top losers in today's trading session. First up is NLC India. The stock is down nearly about 3.5%. Paytm is down again in the second straight trading session, down about 2.5%. Phoenix Mills also remains in focus today as well. The stock is on a 4-day losing streak, losing 2.5% for the 4th straight trading session. Persistent Systems also in focus, is down about 1%, as MK has given a sell rating with a target price of 5,300 per share. And Oracle Financial Services also down about 2% in today's trading session. Now let us look at the key news makers today. SJVN, the stock is surging on high volumes, up nearly about 6%, as company has inked a pack for a 1 gigawatt pump storage project and up highest in the last 4 months. IRDA is also in focus on the back of the good provisional Q3 business update. Escorts is down about 1.5% as companies reported a weak December tractor sales on a Y-on-Y basis. And lastly, Metro Brands also in focus, up nearly about 3%, as Motilal Oswal has highlighted this stock as one of the top picks for 2025.
Upasana, thanks a lot for that. Plenty of movers there in the broader markets. But what next for the index? Some trading ideas for the afternoon. We have Jay Thakkar of ICICI Securities to tell us just that. Jay, good afternoon. Thank you for joining in. Wish you a very happy new year to you and your team as well. Well, there is a positive start to the year so far for the index. At least that's what the screen is showing. But does it have enough legs to sustain? And more importantly, does it have enough legs to go to 24,000? And also couple that up with your stock recommendations for the afternoon as well.
So very good afternoon to you, Homas, and very good afternoon to you, Vivek. Thank you very much for best wishes, and I wish you and the entire team of TV18, all the viewers of TV18, a very, very happy New Year. I wish that 2025 be quite a healthy and a wealthy year for all the viewers of CNBC-TV18. That's from on behalf of ICICI Securities as well, Homas. Now, as far as the index is concerned, definitely, on the start of the new year, we are seeing good move. At least, I hope that, on a closing basis too, we see a good positive close, because generally on the closing, we see markets reversing as well. The India VIX is going higher and it's inching higher. And we think that, in this month particularly, since we have a lot many things, we have results followed by, US President-elect to take charge, and thereafter, budget. So I think that this month, Homas, is going to be volatile. We expect the IBs or the India VIX to reach towards 17 to 18 going forward. Hence, we're going to see the moves on both the sides. The only positive, Homas, which I see right now is that the FI and net long positions have come down below 14. It's like almost 13.5. And it's getting near to oversold. Now, if that reaches to 12 or maybe 10, then probably, market might just get oversold and bounce back from those levels. Hence, for this particular month, being volatility going to go high, I think that on the downside, 22,800 is going to be very, very critical support. I'm not seeing markets below 22,800, particularly in month of Jan. But yes, once 24,000 levels are taken off, which has been acting as a very stiff resistance throughout the December series, which we had seen. So beyond that, definitely is inching towards 24,750, 25,000 levels as well, which is previous swing high, which we had seen also at the start of the December. So beyond 24,000, yes, one can go long. As of now, till those levels aren't taken off for Mars, the market might just trade in a range of 24,000 to 23,300, which is its previous low. And in that sense, I would say that the focus should be on the defensives, because those are likely to perform. So if you see pharma, that's been moving higher. We have seen a good long build-up out there. The trend has been positive. So we have a buy recommendation on Laurus Labs. 613 is where it's trading right now. One can place a stop loss below 600 and target 650 in the short term. So 650 would be the target. Stop loss will be below 600. Second sector, which I think is too oversold. There are a lot of short positions built up there, and there is a good chance of a short covering out there. Homas is, FMCG packed. You name the stock and they are looking oversold, positive divergence, but a lot of short positions. So Marico 646 is where it's trading right now. It's one of the top picks from the FMCG pack. I think overall it has outperformed the FMCG index. So it can inch towards the levels of 670, 685 in the short term. One can place a stop loss below 630. Berger Paints would also be my recommendation, because that's too quite oversold. Among Berger and Asian, I think Berger Paints is relatively looking better. It has shown that positive divergence with a trend line breakout as well. And both of these stocks have shown a lot of shorts getting built up. So I'm expecting a short covering in Berger Paints. Is trading around the levels of 457. One can expect the target of 480 in the short term and place a stop loss below 445. So these are the three stock recommendations. But overall, I would say 24,000 to 23,300 is the trading range within which defensives are likely to perform well. Beyond 24,000 is where we'll see the action coming in the high beta names as well.
Right. Thanks so much, Jay. Thanks so much for joining us and giving us both your view on the index levels as well as your top picks. Well, let's now slip into a short break. We will focus on the stocks that are buzzing in this session today. Stay tuned.
safe.
Welcome back. Still a 100-point gain for the Nifty at 23,750 as we speak. Auto sales continue to trickle in as well. Domestic sales for Atul Auto have gone up by around 14% on a year-on-year basis. So keep that stock on your radar as well. Some of the other movers on the broader markets today include the likes of Tanla Platforms. We mentioned that earlier in the day as well, but that has now built on to its gains. That is now at the highest point of the day. 12% higher now for Tanla Platforms. Already almost 90 lakh shares of the company have already been traded, and that is almost 33 times its average daily volume for Tanla Platforms. So a 12% surge there. And Go Digit Insurance at one point was up almost 9%, has cooled off from the highs of the day, still up around 5% so far in the trading session. And we had highlighted Blue Star, the stock that is trading at a record high, and that too has built on to its gains, around 6% higher now for Blue Star. But as we enter into 2025, Jefferies and Kotak Institutional Equities have announced model portfolio changes. Nimesh is joining in with all the details on that. Nimesh.
Well, 24 was a good year for a lot of the investors, but now going into 25, some influential, strategists have made some changes to the model portfolio. I'll start with Chris Wood first. He wrote a couple of days back. In the Asia ex-Japan long-only portfolio, he's reintroduced HDFC Bank after a long time with a 4% weight. And he's done that by reducing the weight in 4 other companies, which is Macrotech Developers, L&T, ICICI Bank and Axis Bank by 1% each. So that's a big first change that he's made to the Asia ex-Japan portfolio. The other important change that is made is adding Siemens India to the Asia ex-Japan with a 4% weight there as well. So that's a change in the Asia Japan. In the India long-only portfolio as well, he has added Siemens India with a 4% weight, and he's cut the weight on AU Small Finance Bank, and he's also introduced HDFC Bank with 1% weight in India long-only portfolio by reducing the stake or by cutting the weight in Axis Bank. So that's the large changes which has been done by Chris Wood of Jefferies. Sanjeev Prasad of Kotak has written a note for next year, and he's also made some important changes to the model portfolio. He's reduced ICICI Bank by almost 90 basis points and allocated the same to IndusInd Bank. So given the fact that IndusInd Bank has underperformed so much, there is a bit of change within the financial in that particular name. In the consumer names, he's removed Britannia from that list, and also reduced the weight on United Spirits, and that's been added to the likes of Dabur and GCPL. Both these stocks the big underperformers of 24. Within the insurance names, he's removed SBI Life, which has been the best performing insurance name there, and he's allocated that same weight to the likes of HDFC Life and ICICI Pru Life. And finally, he's also increased the weight on Adani Ports. Remember, the stock is sharply corrected in the last few months, and he's added 50 basis points to Cipla as well. So these are the few changes that Sanjeev Prasad has made in his model portfolio. The big takeaway is a lot of the strategies are now adding the underperformers of last year could be as a potential winners for this year, and hence adding to their model portfolios.
Thank you so much, Nimesh, for joining us and highlighting these important model portfolios for us. Well, moving on, Karur Vysya Bank is in focus after the bank released its third quarter business update. Abhishek joins in to throw some more light on the fine print.
Well, Vivek, the business momentum has been strong, especially on the deposit front for them, and that may weigh on the net interest margin in this quarter. That will come out or will come to know as and when the PNL and presentation come out. For right now, the business momentum is really strong. Deposit growth of 15.75% YOY and about 3.5% quarter on quarter. As a result of better interest rate on term deposit, we are seeing CASA decline for many lenders. So over here, the CASA growth is about 4% YOY. And a decline of 0.2% sequentially. So the CASA ratio is at multi-quarter low, coming in at 28.4% when compared to 29.5% in the previous quarter. Advances growth have remained healthy for them, growing by 14% YOY and about 3.2% sequentially. We have been seeing industry growth rate with respect to advances slowing down as the industry is recalibrating their credit deposit ratio. So calculation does show that the credit deposit ratio might have declined, on a YOY and quarter-on-quarter basis. So it might have been at 83.55% when compared to 84.9% in the same quarter last year and about 83.8% in the previous quarter. We are in a high interest rate scenario. A decline in net interest margin could hurt their a decline in CD ratio could hurt their net interest margin. However, the business momentum has been pretty strong for them. Back to you.
Business momentum has been strong indeed. Abhishek, thanks a lot for that. 2.5% higher for Karur Vysya Bank. On to mid-cap spotlight then, and Upasana is now joining in, and the stock that she will shed light on is a footwear company, Metro Brands. Upasana.
Well, Motilal Oswal has highlighted Metro Brands as one of the top picks for 2025. It believes that the company has a long runway for growth going forward. Well, the brokerage has given a buy rating on the stock with a target price of 1460 per share. And it says that the stock performance has been flattish in the calendar year 25, and the stock underperformance was mainly due to both internal as well as external factors. Now, coming to internal factors first, it includes liquidation of old feline inventory, which impacted company's gross margins, and decline in revenue per square feet driven by a lower share of Crocs in incremental store rollouts. Now, coming to external factors, the brokerage has highlighted that it includes the overall demand weakness seen in the footwear category impacting the stock. Now, the brokerage believes that these are short-term bumps and remains optimistic about the overall long-term growth outlook of the company. It says that the company has seen a strong runway of growth and has a healthy ROIC of 30% plus maintained. Now, overall, this is the reason why Motilal Oswal reiterates with a buy rating and a target price of 1460 per share.
Thank you so much, Upasana. Metro Brands doing quite well in the session, almost 2.7% higher. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Three, two, one, zero.
Welcome back to Midcap Radar. Well, the market recovery has picked up pace, especially when you're talking about some of the names in the NBFC as well as the banking pack. A name like AU Small Finance Bank that was sulking earlier now near the day's highest point. And the gold financier company, Muthoot Finance, is up almost 2.5% in the session. That particular stock really shining on the first day of the calendar year. But let's now shift focus to the insurance space. Yash joins in with the top 5 things to watch out for in the insurance space in 2025.
Well, 2024 was quite an eventful year for India's insurance sector. Multiple regulatory reforms were introduced, and these were large-scale structural reforms. The insurance companies, all of them, life, general as well as health insurance companies, sort of work towards bringing these new reforms into their business operations. And 2025 promises to be an equally interesting year when it comes to the insurance space. There are 5 important reforms which will get all the attention in the year 2025. To start with, it would be the Insurance Act amendment. Of course, the expectation is that the Parliament approval could come through for the Insurance Act amendment, and this will carry multiple reforms under itself, like increasing insurance FDI to 100%, composite insurance license, lowering of entry capital for new players to come in the insurance space, opening up of the agent network, as well as changes when it comes to the investment regulations. The second one would be with respect to changes when it comes to GST on health as well as term life insurance. The last GST council remained inconclusive when it comes to the changes on GST as far as health and term life insurance is concerned. The expectation is that the next GST council meet will have some decision with respect to changes as far as GST is concerned. The suggestions are being gathered from industry players on this one, which will be then sent to the finance ministry. The third one is with respect to regulatory concerns around bank assurance and overall concentration of business coming from one distribution channel. We've been reporting on this particular part. The finance minister, IRDAI chairman have publicly expressed their concerns, and there could be some regulatory action that could come through in terms of reducing the concentration of business from one distribution channel. The fourth one is with respect to progress on various things like risk-based capital, risk-based monitoring, Bima Trinity, which includes Bima Sugam, Bima Vistar, Bima Vahak. All those interesting new reforms could come through as far as 2025 is concerned. The fifth one and the most interesting one, the current IRDAI chairman, Debashish Panda, his term ends in March 2025. All these reforms in the last 2.5 years have been undertaken under his leadership. It remains to be seen whether government offers an extension to the current chairman if he decides to continue at the helm of insurance regulatory body, and that will be very important for the entire sector.
Yash, thanks a lot for that. Now, moving on, government sources say that electronics manufacturing sector in 2024 will see rise in exports and growth in total production. Now, the sources also said that the sector could clock $135 to $140 billion. Now, Ashmit is joining in with more on that. Ashmit, tell us more.
Well, as far as 2024 has been, it's been a stellar year as far as electronics exports are concerned. If you look at just the exports for the total electronics space, that's gone up by 45%. It's expected to clock in at about 3.25 lakh crore rupees. That will be versus around 2.23 lakh crore rupees in FY24. Similarly, the story for mobile exports is the same. The mobile exports up, they're likely to grow by 35%. We've already seen 1.25 lakh crore rupees of exports in just a 9-month period between April and December. The one concern, however, appears to be the broader domestic demand. Now, bear in mind that there are two components to this manufacturing. One, of course, domestic demand, the other one being exports. While the exports are doing great, they're clocking great numbers, there is some concern with respect to flat demand domestically, which in turn, sources tell us, is hurting the total electronics manufacturing. So as far as the total output is concerned, electronics manufacturing for this year, it's likely to be in the vicinity of about $140 billion. That will mean that we've seen a 15% CAGR between FY24 and FY25. The core concern here that the industry has, that the government has, is that when we benchmark it against the total target that we've set for ourselves, that India has set for itself, of 500 billion by FY30, that would dictate a CAGR of over 27%. So this 15% growth that would be witnessed, that is likely to be witnessed in FY25, could be a concern that the government and the industry would want to address. Back to you.
Thanks so much, Ashmit, for pointing out those important details. Well, as you can see at the bottom of your screen, the monthly sales numbers for Maruti is out, and it appears to be a strong set, especially when you compare it to our poll. And the stock is now at the day's highest point. Remember, Maruti is up almost 1.7% after a strong set. And along with that, even some of the other auto names today are doing quite well. Names like Tata Motors too, now trading near the day's highest point. Well, Nimesh pointed out one particular stock that's had its weight increase as far as Kotak's model portfolio is concerned, and that's IndusInd Bank. And that particular stock too today is doing quite well, now near the day's highest point. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
lead is very clear because we have already the programs announced. Chandrayaan 4 is announced. We have the Bharatiya Antariksha Station building is announced. Mission to moon and landing on the moon is planned. So all of this requires docking. Docking will start from tomorrow onwards. Many processes will happen, but final docking will take place possibly by 7th of January.
This is the 99th launch of any launch vehicle from Satish Dhawan Space Center. So that's also very important number. So we are going for the 100th launch and in the beginning of next year.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now, what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now, with asset quality getting over with respect to the pain in H1 CY25.
Hello, good afternoon. You have tuned into CNBC-TV18. You're watching Your Stocks with me, Vinny Motiwala. A quick look at what the market is doing. Recovered from the day's lowest point, and since the last time I've checked, now it's moved and inched up closer to 23,800 mark. Just a point away from that level. So 23,007. Okay, it's done. 23,800 there coming in for the Nifty in today's trading session, up almost 0.6% in a trade. Nifty mid and small cap also doing quite well. Mid cap has picked up pace. Nifty mid cap is up almost 0.3% in trade. Small cap is up almost 1% is what we are looking at as of now. So outperformance is coming in from the Nifty small cap. Nifty Bank also lending some support there, up 0.7%, trading almost near the day's highest point is what the Nifty Bank is doing right now. Other than that, let's look at ICICI Bank as well as HDFC Bank individually as well. They were among the top performers coming in for the Nifty contributor wise. So ICICI Bank and HDFC Bank also holding on to gains of almost 1% in trade. But yes, that's how the market is looking like, recovered from the day's lowest point. But this is a show where we solve all your stock-related queries, and we have our experts joining in with us. Astha Jain, research analyst at HEM Securities, as well as Shivangi Sharda, analyst, equity derivatives and technicals at broking and distribution at Motilal Oswal Financial Services, to answer all your stock-related queries. Good afternoon, Astha as well as Shivangi. Thank you so much for joining in with us on the show. Let's get started with the queries today. But actually, before that, I do want to talk about the market because 23,800 is back. Shivangi, good afternoon. And, do you think we'll be able to sustain that level, or, what are the levels that you're keeping an eye out on for the market?
Very good afternoon, Vinny. Thank you for having me. So we've seen that, the indices have been facing some sort of pressure at the higher zones. And even though there has been consolidation, but follow-up is kind of very tricky in this kind of a market. India VIX has been acting up. So overall, we would expect some certain volatility to continue in this series going forward. Some swings will be expected. January has always been, full of swings. Historically, we've seen it has been, kind of a trap for both the call and put writers. So definitely we'll have to, put on our seatbelts to trade in this series. But if you talk about the immediate level, 23,500 is an important make or break zone here. Today also it's respected those levels, and we've seen a pullback move from those levels exactly. Now, there has been some sort of buying, but again, we are facing some resistance at 24,000. So the call writers have to unwind their position at 24,000 for the next leg of rally. So hurdles are immediate basis 24,000, but then if it crosses this level, then it could head towards 24,500 marks. So keep your stance very hedged, and it would be advisable to play on a strategy note rather than naked buying or selling.
Okay, absolutely. Thanks so much for that, Shivangi. And actually, Happy New Year to both of you, Shivangi as well as Astha. I forgot to give you all those New Year greetings because markets surely is quite cheery today in trade. But on that note, let's get started with the stock-related queries. The first query we have today is coming in on Adani Total Gas. This one is from Suresh, who's writing to us from Bangalore. He's holding 20 shares of Adani Total Gas and bought the stock at a price of 890 rupees per share. Wants to know whether he should continue to hold or look to sell this. Currently making some bit of a loss here. Astha, what's your view on Adani Total Gas on the fundamentals? How is it looking like?
Hi, good afternoon to both of you, and a very happy new year to all the viewers, to your team, and both of you. Now, talking about Adani Total Gas, I think this counter can show some upside momentum from here. The reason being, we have seen some sort of increase in their volumes. In fact, this company has opened some new CNG stations also. So I think going forward, whatever steps company is taking, definitely that will help the company in showing decent numbers going ahead. So our idea here is to stay invested in the counter. However, the cost price is high, so I believe that this stock has a potential to move upwards to the level of 800 to 820. So one can stay invested till those levels in this counter, because we believe that fundamentals are well placed, and whatever steps the company has taken definitely will yield results in the coming future.
Okay, and what's your view on this one, Shivangi? The stock, where do you expect it in terms of levels to move from here on, and what would you suggest the viewers should do?
So talking about this stock, we've seen that this has been in pressure from the last 3 months, and selling pressure is intact here. Although we've seen a recovery from 870 odd levels, but then overall this stock has been quite a lot in weakness. So I would suggest one could actually wait and watch for this stock to again recover, and there are better stocks out there to again accumulate.
Okay, better stocks that one could look to accumulate. That's a word coming in from Shivangi. Let's move on to the next query for the day. We have this query coming in from Vedang, who's writing to us from Hyderabad, holding 30 shares of Kotak Mahindra Bank at a price of 1,700 rupees per share. Wants to know whether to continue to hold or look to sell this one. And Astha, what's your view coming in on Kotak Mahindra Bank? What is it that we're expecting from this private bank? Would you suggest the viewer, continue to hold Kotak, or maybe sell and look at some other private bank is something as an option?
I think better idea is to remain invested for the initial price target of somewhere at around 1,800 to 1,870 odd levels. So now talking about this counter, what we have seen that now this bank is pursuing both sort of growth expansion strategies, that is organic and inorganic. So I think that will also help the bank, and we should always remember that it is the bank which has shown one of the highest NIMs among its peer set group. So going ahead, whatever strategies the bank will be taking place, I think that will help bank in posting better numbers going ahead. So we believe that this counter is well poised to show some more upside from here. And hence our view is remain invested in this counter with a price target of 1,870 at the initial levels.
Okay. Shivangi, when you look at Kotak Mahindra Bank in terms of a stock move, in the last month, at least month to, what you're looking at, how would you see the performance versus other private banks? And do you think that, it's a possibility that the viewer should actually sell, or would you concur with Astha in terms of the view?
So we've seen that banking space has been in a little bit of a pressure from the last 2 to 3 series. Of course, rollovers were also quite narrow this time in the entire banking pack. But Kotak Bank specifically, series on series basis, nothing much has happened. Of course, if you look at the daily time frame, we've seen a lot of consolidation and within a band. So of course, Kotak Bank is at this moment, I believe it is a long-term pick, not a trading bet right now. With over 95% rollover in this particular stock, there's definitely strength as compared to the other banking counters as of now. But overall, this stock has had a history of having volatile swings. So I would suggest one could remain in this stock for a longer time view, but not for the trading perspective. And next, we could expect somewhere about 1850 to 1900 levels.
Okay, long-term view coming in for Kotak Mahindra Bank. But let's move on to the next query, and this one is from a public sector bank query that is on Bank of Maharashtra. Harika is writing to us from Mumbai. She's holding 1,750 shares of Bank of Maharashtra. This is at a price of 64.8 rupees per share, currently making a loss on this one. Wants to know whether she should continue to hold or look to sell this. Asta, your view on Bank of Maharashtra?
So I think it's better to hold this counter with the initial price target of 58, although cost price is more, a little higher from these levels also. But I believe that maybe the results coming in will be a better one. Now, talking about this bank's fundamental, what is major attraction about their results is that they have surpassed their NIM expectation, because the management has itself guided for the NIM of around 3.75 or 3.8 odd levels, but their NIMs have come down to the level of 3.9. So in fact, they have surpassed their guidance, despite the fact that the cost of fund was a major concern. In fact, in the financial performance also, I think it was a decent set of a number with a stable asset quality. So I think this is one of the bank in the public sector space which has shown decent asset quality as compared to its other counterparts. And I think that is why there is a potential to move upside from here. No need to book any sort of losses at this point of a time. Better to wait for more upside. I think 58 is the target which we would like to give to this counter at this point of a time, but this target is subject to revision after the results.
Okay, so wait out for the results, and better asset quality is what you're highlighting versus other peers in the public sector space. But Shivangi, on the charts, what is it looking like for Bank of Maharashtra? Last 6 months, we have seen some bit of a correction, right? So, what would you advise the viewer to do?
Of course, Bank of Maharashtra has been in weakness, right where it made a top near 73 odd levels. And we've seen that the stock has been cascading down since then with absolutely no signs of recovery. Even in this year, we've seen that, we ended flat in the previous calendar year, and now some sort of buying interest can be seen from the lower levels, but again, it doesn't look very sustainable. So I would recommend, one could exit this stock. This quarter is very crucial for the private banks, and seasonality-wise also we've seen that heavyweights tend to perform more than these smaller banking names. So I would definitely suggest to be with the heavyweight names if at all you want to be with the banking counters.
Okay, thanks for that, Shivangi. Let's move on to the next query. We have Indira Lakshmi, who's writing to us from New Delhi. She's holding for 50 shares of RVNL at a price of 259 rupees per share. Wants to know whether to hold or continue to hold or look to sell this and, book out the profits in this one. Asta, what's your view on RVNL? We've seen those orders surely coming in, a lot happening in the railway space. Would you say the viewer should continue to hold, given that she's making a decent profit on this one?
I think partial profit booking is a better option at this point of the time, because the investor has already earned a huge profit. And one thing which I am positive about this counter is that their order book, I think it's around 800 billion, which is almost 4x of the TTM revenue. Although in the Q2 of FY25, they were not able to perform strong performance on the financial front, and there were reasons behind it. First of all, due to the monsoon, there is a delay, and that's why we have seen the execution was not that strong. But going ahead, I think H2 of FY25 will be a better half year for these companies. And in that way, this company can be a beneficiary of that. So I think, but here, since the profits are high, so better to book partial or maybe 25% of the quantity. I mean, profit can be booked in the 25% on quantity and remain, one can continue holding in this counter. We are expecting the price to move till the level of 460 to 470.
Okay. That's the view coming in. Partial profit booking is what Asta is suggesting. Shivangi, what's your view on RVNL, given that stock has seen a fabulous run-up in the last 1 year, all railway stocks, right? So what would you suggest? Partial profit booking or just completely get out and enjoy the profits?
So absolutely, they've seen a good run-up in the first half of the year, but then the second half was quite muted for the entire railway pack. In fact, there was a time when these stocks didn't move at all and were absolutely derailed. But we've seen that, on the daily basis, the time frame, we've seen RSI is turning, trying to turn kind of positive. But I believe the confidence in this stock would regain after it crosses 440 levels. So it's a wait and watch over here at these levels. One could put a stop loss near about 400 levels for the next up move towards 460. But condition is that it has to cross above 440 for momentum to regain, or else it would again be stuck in a lackluster manner. But of course, around the budget, we do expect some sort of movements around these PSE sectors as well. So one could be, hopeful for this stock, but not much of a, upside that we're expecting here.
Okay, not much of an upside that you're expecting here. Maybe some budget-related moves that is expected and one could watch out for. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more of your stock-related queries after the break.
Liquidity crisis that will slow down the loan growth for MFI players. Now, over-leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25 as well, which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while NBFCs may see improvement or stability.
Welcome back to Your Stocks on CNBC-TV18, and we still have with us our experts Asta Jain of M Securities as well as Shivangi Sarda of Motilal Oswal Financial Services to solve all your stock-related queries. Let's move on and talk about the next query that we have. This one is on Vedanta. Parag is writing to us from Mumbai. He holds 125 shares of Vedanta at a price of 214 rupees per share. So making a profit on this one as of now, 444 is what the stock is trading at. Wants to know whether you should continue to hold this or look to sell. Asta, what's your view coming in on Vedanta? Obviously, there are certain concerns that come in terms of the debt side, but how does that work out going forward?
Yes, there are certain concerns, but even if I look after the growth plans of the company, like in case of their aluminium division, they have a growth plan of becoming fully integrated supply chain from mining to metal. And in fact, in the zinc division also, they have certain plans to ramp up the production. So I think with these growth plans and the focus, maybe company can show much better performance from going forward from here. And that is why I think if there is no hurry to book profit, it's better to wait in this counter. Although at the initial levels, we are assigning the price target of 480 to 490. So hold is a strategy from our side for this company.
Hold is a strategy coming in from Asta, but Shivangi, what's your view on Vedanta?
So we've seen that this stock has been stuck in a very consolidative band recently, and after that, we've seen that weakness has been derailed in this stock. But overall, it's near its support zones of around 430 levels. It's taken a bounce back from those levels, but this stock is highly affected by the global market and the whereabouts. So we're recommending that you could exit this stock in the December series itself. We saw 94% rollover on the short side. So there has been short built up and consistently selling pressure is intact. So definitely I would suggest one could exit and avoid it for a bit.
Okay, exit and avoid for a bit. That's a word coming in from Shivangi on Vedanta. Let's move on, and the next query is on delivery. We have KP Kumari, who's writing to us from Guntur, Andhra Pradesh. She holds 20 shares of delivery at a price of 400 rupees per share. Currently, the stock is trading at 348. So yes, the viewer is making a loss on this one. She wants to know whether she can continue to hold this for a time period of 2 years. Asta, what's your view in terms of delivery? Fundamentals, how is it looking like? Because the viewer still has a long-term time period, 2 years, so not bad. Could she continue to hold this?
I think she could, because in the near term, what we are seeing the price target till the level of 400. So maybe the cost price at which the viewer or investor has bought the stock, I think it has a potential to move at least till those levels. So there is no need to book losses. Now, talking about fundamentals of this counter, first of all, they are market in the 3PL segment. And one of the major attraction or the focus point of this company is that they are profitable one if I compare it to their other counterparts. So the profitability is there, where the major attraction is because of the profitable nature of the business as well as a market leader, although they are facing some concerns in their B2C segment. But I think going ahead, definitely that will get solved out. So more or less, I think this stock can move in the northward directions, and hence we are positive on this counter, recommending a hold with the initial price target of 400.
Okay, and Shivangi, what's your view on the technicals for delivery? Last 6 months, very muted, right? Nothing exciting that has happened in the stock. What should the viewer be doing?
Absolutely. We've seen that, in fact, in this last 6 months, we've seen that the stock has exactly, maintained its channel bands. And we've seen that there has been a little bit of a recovery in the RSI segment. It's trying to turn positive, but again, follow-up is absolutely missing here. But overall, new age companies are in a lot of focus, and we've seen that this sector is looking quite positive. So I would actually recommend being in this stock for a bit. Of course, there is no quick movement that we're expecting. It'll require some bit of patience, from the investor side. But of course, this stock is getting poised to touch around 380 odd levels. So recommending to be here with a stop loss of around 340 levels.
Okay, keep an eye out on that. But let's move on to the next query. This one is on Mishtan Foods. We have Syamala, who's writing to us from Hyderabad. She's holding 1,720 shares of Mishtan Foods on an average of ₹21 per share. Wants to know whether to continue to hold or sell this. Asta, do you have a view on this one? It's not a stock that you normally track regularly, but Mishtan Foods, what's the word?
I think this company, they have they are basically into the rice, and they are exporting to USA, UK, Singapore, I suppose, apart from the domestic sales also. And the financial performance were also, not very strong. And here the major point is that there is, I think, no use of exiting at these levels, because if one make a exit at this counter, the losses will be huge. So it's better to wait, because already I think the investor has bought it at ₹21. It is going at 7. So I think it's better to wait for more triggers to come in. Maybe the result can be one of the triggers. I think it's better to wait. Otherwise, losses will be huge. And that is the only reason I'm not recommending to exit at this current level. So here, our stance is hold at least till the results come.
Okay, hold till the results come at least. And Shivangi, your view?
So this is, very rightly pointed out that this is a stock which we don't really track on a very regular basis. But of course, if we look at the technical charts, the volumes are a little shallow. And we've seen that this entire sector has been a little muted. If we talk about the entire consumption FMCG pack, there has been some sort of recovery and short covering move seen. But overall, this sector has been a little dented from the last 2 to 3 months. So if you talk about the sector tailwind, of course, there could be some sort of movement, but this particular stock has not really witnessed much of a follow-up buying. So it'll require a lot of patience. So I would definitely recommend exiting some positions at least and to utilize the funds for a better opportunity.
Okay. Thanks for that, Shivangi. And that was the last query for today. So Asta as well as Shivangi, thank you so much as always for joining in with us and solving our viewers' stock-related queries. But with that, we're absolutely out of time on this edition of Your Stocks on CNBC TV 18. Thank you so much for tuning in. Up next, closing bell.
Margin because the cost of borrowing from the banks will incrementally reduce, which is one of their key borrowing segment right now. Now, management terms are expected to end in 2025 for these banks like IndusInd Bank, Indian Bank, you have Bank of Maharashtra as well. Also for Central Bank of India as well as Punjab and Sindh Bank. Over the last few years or 6 years or so, the gross NPA ratio difference between the PSU banks and private banks have narrowed from as high as 967 basis point to about 127 basis point at the end of calendar year 2024 so far. Similarly, the net NPA ratio difference has narrowed from 451 basis point that you saw in 2018 to right now about just 11 basis point in 2024 so far. Historically, this is one of the lowest net NPA ratio difference seen between PSU banks as well as private banks. So from CY 2018 to CY 2024, PSU banks gross NPA ratio has declined from 14.2% to about 3.15% and net NPA ratio has declined from 6.25% to 0.62%. Private banks, their gross NPA ratio has declined from 4.5% to about 1.9% and the net NPA ratio has declined from 1.74% to about 0.5%. Will RBI change its stance on lenders? Now, RBI has banned many products or entities in 2024. So, RBI did ban, Kotak Mahindra Bank's onboarding of customers via the digital and mobile customer application, as well as they have placed limits on the credit card business due to deficiencies seen in Kotak's IT infrastructure. Now, RBI had raised material supervisory concern on Asirvad MFI, which is a subsidiary of Manappuram Finance. RBI intends to implement the expected credit loss guidelines from 1st of April 2025 to ensure that there is bank's financial stability, protect depositors' interest, assess the overall risk exposure and accuracy, reflecting the true value of bank's loans portfolio. Now, Project Financial, there may be additional provisions over there as
The resistance for our markets will be closer to 23,870, which is the 200-day moving average.
First rates for 2025 are absolutely in the green. It's only 0.1%, but nevertheless important.
But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform?
There is no overdoing anyone, I would say, because you really never know what fancy the market takes.
I think what we're trying to do is shift towards companies where earnings are a little bit more visible.
Overall, I think we have demonstrated the resilience in our asset quality.
Nishant Pitti, one of the co-promoters of the company, has resigned as the CEO.
Where our credit score could potentially change multiple times during the month versus once a month earlier.
First trading day of the new year, and there is a pickup in the markets now. The Nifty is up close to about 0.5%. A disappointing set of numbers. Total sales are down 1.1% on a year-on-year basis.
Started off
2025 on a strong note, on a green note, especially if the broad end of the market.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Closing Bell, coming to you from the CNBC-TV18 Motilal Oswal studio, and joining me is my co-anchor, Reema Tendulkar. Well, we have a market that's sprung up admirably. So Indian markets up almost 1% now as we trade in grand isolation. It's not just because we don't have negative global cues, at least for the next 24 hours. I think the important point is that the one domestic cue that we have, auto sales, is actually mildly positive. I mean, I leave you to give me your opinion, Reema, but the fact that small car sales have picked up and are showing a good number should be taken as positive, isn't it?
Indeed. I think that is the biggest positive, because you look at Maruti's numbers, and Maruti is now the top Nifty gainer. The overall sales growth is 29.6%, and in that, it's the small car, which is your mini and compact. That has grown close to about 30% on a year-on-year basis. On a month-on-month basis, it's still lower, right? But on a year-on-year basis, it's 30%. And this was the segment which was impacted the most. We know sales were weak. That said, April to December, sales for the small car segment is still down about 10%. But in the month of December, there has been a recovery.
How much is it down, April to December?
10%, approximately, is down 10%. But December to December, I mean, just, you know, December month on a year-on-year basis is up 29%. SUVs continue to remain strong, whether it's for M&M or even for Maruti. Both of them, you know, have a nice 18-20% kind of SUV growth. For tractors, M&M is the bigger player, and M&M is showing you good growth in tractors. So I think the auto sales on margins, I think, are fine.
Okay, but I take your point. Actually,
two-wheelers is a problem, at least Bajaj's.
Yeah, I take your point entirely about two-wheelers. We will have to still see, of course, Hero, but throughout the year, actually, Bajaj has been outdoing Hero. As well, we must remember that in Bajaj also, the electric vehicles are doing better. So it's quite possible that people are just, biding their time to choose the state-of-the-art vehicle over the conventional vehicle. So there could be other reasons, but, you know, the fact that cars are doing well and not two-wheelers just drives home the K-shaped recovery. And I want to take the point about how your December sales are better, even if April to December sales are still lower, to what we spoke about earlier in the morning about taxes, about capex. You know, the year-to-date, April to November capex by the government is still minus 13% year-on-year, or 12.5%. But if you only look November over November, the November capex is about 20% higher than the November of 2023. So incrementally, things could be improving. At least the early lead indicators we have for the third quarter seems to be having a fair share of positives. We still await a lot of data, but my sense is that we have something to cheer about on the first trading day.
Okay, let's talk about some of the winners and losers of today's trading session. So right on top, you've got Maruti and M&M. Both the stocks are up 3% and 2% respectively. Innocent Bank, which was the biggest Nifty drag last year with a 40% downtake, is rebounding. Innocent Bank is up 1.5%. L&T is the big boy, which is showing you strength. Asian Paints, HDFC Bank, Eicher Motors, Apollo Hospitals. These are some of the movers on the way up. On the way down, you've got Dr. Reddy's under pressure, Hindalco, Adani Ports, Bajaj Auto, Tata Steel, a little subdued in trade. But Mitesh is with us now to tell us how you should position yourself in the last hour of trade. Mitesh.
We've kind of bounced back from the levels which we had discussed in the morning, and I think we're just, back trying to get to the upper end of the range. For the Bank Nifty, it will be around 51,500, 600. There might be another 300-400 points left. On the Nifty, 23,850, 900 is the zone. So, we already had a high of 23,825. But yeah, I think around those levels. So if people have bought around the support levels, some profit should be booked and stop losses should be put tight. And then the trading should shift to, some kind of stock-specific ideas. I have a buy on about India with a stop at 29,650 and a target of around 30,600 to begin with. Then we may eventually look at slightly higher levels and a buy on Apollo Hospitals with a stop below levels of 7330 and a target of around 7550.
Okay. Well, I've been watching the Paytm stock, Mitesh. Actually, we should pull up a 1 year of the Paytm stock, or rather the 2024 chart. It's actually been a full string of higher highs and higher lows for that stock. It's giving you a dip today of about 2.5%. Is there a trade there, Mitesh?
Well, I think there are first signs that Paytm might be making a temporary high or top around the levels of 1,025, 1,050. And my sense is that I think, if people have it, now is the time to take profits. I believe a pullback to about levels of 940 to about 925 could happen. And then we'll see from there if the stock shows trend to recover. But for the time being, the immediate view, and you're right, I think, the stock has done extremely well in the last 1 year, starting from levels of 350 odd to tripling to about levels of 1,050. I think now is showing first signs of tiredness on the indicators, and my sense is that some consolidation is required here.
Okay. All right. Mitesh, we'll of course come back to you for the BTST trades and for other advice. For the moment, let's cast our eye on the year that was. The Indian market ended 2024 with positive returns, despite, of course, a roller coaster ride. But the big question, of course, on the first day of 2025 is, what does this year have in store for us? Nimesh has done a very wide-ranging poll, and he's here with more details. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to, will that be a spoil sport into 25 as well? Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Okay, thanks a lot for that, Nimesh. And with that, let's invite our good old friend and advisor, market expert Prakash Diwan to join us. Prakash, thank you very much indeed for joining us on the first day of a trading day of the trading year. And here's wishing you a very happy 2025.
Thank you so much, Lata. Thank you, and a great 2025 to you, Prima, the team that puts our shows together, and of course, our audience. So thank you and all the best.
Well, thanks a lot for that. And in fact, the team that puts together the show is someone you don't see often, of course, except when you visit the office. And they do a lot of work, much more than we are doing. But, the question on the platter for you is, what did you make of the auto sales? I mean, after a long time, we've seen Maruti's small car sales do well. So are we on the verge of something big and positive?
So hopefully, I think these numbers have been very interesting and a little bit of a surprise element there. Because remember, December is not the best of times for auto sales to perk up. Usually, people wait for the new year to buy into cars with a fresh year of registration, which kind of helps them in at least the perception on resale value is better. The indication that the A and B class or the micro and compact segments doing well means that there's recovery afoot, probably in the rural and suburban markets. The SUVs of the world, the electric vehicles, all of that is a very urban phenomenon. And all of us know that there's been not much of a disappointment there, Lata. But if these sales pick up, it probably is the start of, hopefully it's a start of a trend which could deepen. And, remember one thing, a lot of the competition that used to be in that space, which was from the Tatas when they came in with their new PV platform, or for that matter, the Hyundai, smaller cars or the Kia, they've all shifted up in terms of the value chain. Nobody wants to be in that space. Maruti is probably by default enjoying the market share. But interestingly, I love the fact that M&M has finally clocked better sales on the tractor segment. And that has been a big disappointment all this year. Throughout 2024, if you see numbers haven't been very positive. But if that were to take off as anticipated, we could be looking at a very virtuous cycle of improvement for M&M on all counts. Tractor was one leg which was not doing well. EVs will start doing well because of the launches that they have. And of course, SUVs, they continue to be a fairly strong player. So that's where I think the numbers are very interesting. Let's see if this gets followed through in January.
Let's just quickly recap the auto sales numbers for our viewers. So Maruti is the big winner, and Maruti's share price is now up more than 3%. The total sales have come in at increased by 29.6% at 1.78 lakh units, and this is ahead of the CNBC-TV18 poll of 1.63 lakh units. But the surprise was the mini and compact segment, which is the small car segment, that has seen a growth of 29%, while SUV growth is still intact at 21%. Bajaj Auto, on the other hand, is a disappointing set of numbers. Total sales down 1.1% in December, lower than expectations. Month on month, we're not comparing for most of the companies because November had the festive period boost. But for Bajaj Auto, two things stand out. One, on the export side, things are improving. The export, volume growth was about 70% in December. And secondly, export contribution is now 50% of the total sale. Also, on the electric two-wheeler side, the company is in pole position with a market share of 25% in the month of December, as per the Vahan data. So it's ahead of TVS Motors and Ola Electric. For M&M, it's a good, it's inline numbers. Both their auto segment, which is predominantly UVs, your SUVs, that is doing well, and even tractors is doing pretty well. So the company's tractor sales have gone up by 20% in the month of December, and this stands out because its peer Escort had reported a decline of about 10%. So when you do the comparison for M&M, the tractor sales are very strong. For Hyundai also, it's an okay quarter, in line with estimates at 55,000 units. Total sales are down 2.4%, but again over here, domestic has fared better than export. So in a nutshell, most of the passenger vehicle numbers are fairly, good, whether it's Maruti, whether it's M&M, or even for Hyundai, it's flattish on a year-on-year basis. So domestic numbers are fine on the car side, but domestic two-wheelers for Bajaj Auto is still a spot of bother. So, Prakash, you spoke about, Maruti, etc. But what about Bajaj Auto, Hyundai? Hyundai is still struggling in terms of a share price.
So, yes, Lima, Hyundai is definitely not in the best of spots. First and foremost, when it comes to the stock price, it's been offered with fully this thing anticipation of growth to be priced in a little bit of exuberant levels, but and the size of the float was so massive that whoever wanted to have exposure to Hyundai has already got that in the portfolio. So would you incrementally move ahead on that? You need some big trigger to actually justify that. And I don't see any reason why that would happen soon unless there's some change in its product mix or new launches or some sort of a market share improvement. So we'll have to wait for that. And it will probably, organically claw back into some sort of a value zone, which is at least 6 to 12 months away, if you really ask me. And I was not very positive on the IPO precisely for this reason. On the Mahindra side, on the Bajaj Auto side, it's very clear. Bajaj is now a 50-50 game on exports and domestic sales. While optically the Chetak sales have been very robust from the base effect standpoint, they still need to kind of be able to continue with that leadership, and they have the wherewithal to do it. The product, as I had mentioned once on a show, it's far more superior than any of the electric two-wheelers that have come into the market. So it does have the right to win in that space. But you'll have to give it some time to do something dramatically, superiorly different. Especially the CNG motorbike is, my sense, is the key trigger which can change things for them. Otherwise, at this level, it's well priced. Most of the positives are in. There's nothing much that you would kind of expect. But if the CNG motorbike starts taking off in terms of volumes, then you have a very different market.
Okay, point taken. Speaking about the performance of automobiles and the small car probable recovery and tractors, Prakash, is there anything in the auto ancillary space that comes to the mind?
Oh yes. So there's a little bit of this fear that some of the Chinese companies, if they are allowed to set foot in the European market, and some of them have done that, especially on the EV side, it could make life difficult for Indian ancillary manufacturers, because a lot of the export that is directed to, and the same thing could happen to the US. So to be very honest, everybody's waiting with bated breath that US doesn't let Chinese companies get into the US market and start competing aggressively out there. Because if that were to happen, Indian ancillary companies really have to step off that value chain. But as of now, if things don't change, unfavorably, you probably have the likes of Suprajit, Lumax, very, very strong franchise that they've built in terms of product superiority. And some of the other companies that have been very big in the beginning, in the sense when we started exporting to the world, they are the ones who will probably lose market share to more nimble-footed, agile players. You'll be surprised, last 5 years, the best performances come from pre-call within ancillaries. It's done a multiple of some, I think, about 9 times or 10 times in 5 years. Now, that is because, in spite of the fact that pre-call was supposed to be a dying business, and you said analog meters is not something which is going to be the future and all that, but things change dramatically, on the ground. I would be a bit selective, but as I said again, allocations would have to wait till the US policy framework is out. But you could look at some of these smaller companies like Lumax and Suprajit.
Okay, that's amazing. I never thought that for auto ancillaries we have to really wait for the US policy on tariffs. Very interesting, a very important angle, Prakash. Rima, with your permission, I wanted to ask Prakash about power sector as well. You know, today among the big order wins that we are announcing, a lion's share is coming from the power sector. We saw a big order coming in for SJVN, and there was also another T&D order that came in. Was it for Kalpataru?
KC.
So, yeah, I know even Kalpataru projects got a big order. Yeah, KC as well. So, I mean, in that space, what do you like?
So, no, that's a very interesting space. And again, I'll, add a little bit of the US angle to this, Lata. You have a massive surge in demand for power thanks to, the move towards data centers globally. By the way, this is the first time, places like UK and Germany are actually talking about power outages. We've never heard of that in Europe, but things have changed so much in terms of their energy mix, from nuclear to gas to, solar to back to, nuclear now. So there's this whole cycle that's happening thanks to the triggers from the Ukraine-Russia conflict. Now, what's happening is that power storage is going to become a very key area. So while you have a lot of renewable energy globally getting generated, whether it's from wind in the US, solar in France and in India and all, there'll be a lot of storage challenges that will have to be met. So we are working on identifying companies which are absolutely successful out there, which is called BESS, Battery Energy Storage Solutions. And there will be a lot of players that will emerge. The transformer part is the other thing. So, power has two things. One is generation, the other is consumption. My sense is there's a lot that's happened in investment on the generation side, but nothing much on the, not adequately enough on the consumption side. And that includes transmission and distribution. So we are quite positive there. But as of now, we haven't been able to identify any companies or businesses which look that promising from a valuation perspective. So if valuations permit, you'll probably start seeing some value there. But do allocate money to the likes of Tata Power or Torrent Power because they're fairly well placed in that value chain. So I'm very positive on this space, but newer names, under-discovered names is what I like, and yet to kind of zero in on some of these.
Okay, we'll await when you have zeroed in on Prakash. And yeah, good old power generators and distributors also, you advise that people keep their eye peeled on them. Thank you very much, as always, for joining us and giving us the benefit of your advice.
By the way, hotel stocks are seeing some buying now. Pull up a Taj GVK. It's a small one, but it's a 15% up move on that. The other one is Lemon Tree Hotels, 3.5%. And the surge is coming just in the last 10-15 minutes. Chalet Hotels, let's get that up for you on your screen. That too is spiking up. And Indian Hotels, I'm not sure if that's too moved up in tandem with the rest. No, Indian Hotels is still flat. But the rest of the hotel-related stocks are quite active in trade. And there is another company related to travel tourism, and that's Le Travenues Tech, basically Ixigo, the company which owns the platform Ixigo, which you go to for making your bookings for air, bus, etc. And that too has seen a bit of an up.
No, this could be just traders going up and down, traveling up and down, so to speak, because like I said, the cat is away and the mice are at play. If anything, the data that people have been putting out, media have been putting out, this holiday season, holiday destinations like Dharamshala, even Goa, have not seen 100% occupancy. So anyway, I mean, everything depends on at what price you are buying and what time period you're buying. So there could be buy even at such junctures. Nevertheless, I just want to introduce a note of caution that when we are pointing out to you things that are moving up and down, do remember that today is a day of thin trade. We are trading in grand isolation, and it could be that people are only trading for the day. You can wind it up tomorrow because the big cues of the US market are not going to be available today. They're going to be available only after trading hours tomorrow. On that note, we're going to take a break and going to come back with another important fund manager, Dinshaw Irani of Helios Mutual Fund, to be joining us on the other side.
reflected in their draft regulations. So this will be implemented in a phased manner, 2% by 31st March 2025, 3.5% by 31st March 2026 and to 5% by 31st March 2027. RBI has given new draft norms with states to increase the bank's liquidity coverage ratio by an additional 5%. Now, the runoff factor for retail depositors is a key cost, and this will also see that who are enabled with internet and mobile banking, that will see additional incremental over there. So it may come into effect from 1st of April 2025 and may lead to short-term slowdown in credit and impact the net interest margin of the lenders on the negative side.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom,
Welcome back. 23,750 on the Nifty. It's a good 100-point up move on day one. But the question is, as we get into 2025, what's the outlook? Now, Jefferies and Kotak Institutional Equities have announced their model portfolio changes. Nimesh is here with the details. Nimesh.
Well, 24 was a good year for a lot of the investors, but now going into 25, some influential, strategists have made some changes to the model portfolio. I'll start with Chris Wood first. He wrote a couple of days back in the Asia ex-Japan long-only portfolio. He's reintroduced HDFC Bank after a long time with a 4% weight, and he's done that by reducing the weight in 4 other companies, which is Macrotech Developers, L&T, ICICI Bank, and Axis Bank by 1% each. So that's a big first change that is made to the Asia ex-Japan portfolio. The other important change that is made is adding Siemens India to the Asia ex-Japan with a 4% weight there as well. So that's a change in the Asia Japan. In the India long-only portfolio as well, he has added Siemens India with a 4% weight, and he's cut the weight on AU Small Finance Bank, and he's also introduced HDFC Bank with 1% weight in India long-only portfolio by reducing the stake or by cutting the weight in Axis Bank. So that's the large changes which has been done by Chris Wood of Jefferies. Sanjeev Prasad of Kotak has written a note for next year, and he's also made some important changes to the model portfolio. He's reduced ICICI Bank by almost 90 basis points and allocated the same to IndusInd Bank. So given the fact that IndusInd Bank has underperformed so much, there is a bit of change within the financial in that particular name. In the consumer names, he's removed Britannia from that list, and also reduced the weight on United Spirits, and that's been added to the likes of Dabur and GCPL. Both these stocks were big underperformers of 24. Within the insurance names, he's removed SBI Life, which has been the best performing insurance name there, and he's allocated that same weight to the likes of HDFC Life and ICICI Pru Life. And finally, he's also increased the weight on Adani Ports. Remember, the stock is sharply corrected in the last few months, and he's added 50 basis points to Cipla as well. So these are the few changes that Sanjeev Prasad has made in his model portfolio. The big takeaway is a lot of the strategists are now adding the underperformers of last year could be as a potential winners for this year, and hence adding to their model portfolios.
Okay, Nimesh, that's most helpful for those who are building their own portfolios. But we now have a guest, of course, who builds portfolios for others. Dinshaw Irani, CEO of Helios Mutual Fund, joins us. Dinshaw, good afternoon, and thank you very much. Here's wishing you a very happy 2025 from all of us at CNBC-TV18.
Thank you, Lata, and wish you and your team also all the best. And obviously the viewers a very happy new year.
Thanks. Okay, let me continue the conversation where Nimesh left off. Where would you tweak your portfolios Of course, portfolios don't change when you tear the calendar and change it to the next year. But nevertheless, we've seen the early auto sales numbers. It looks like small cars have done well after a fairly long gap. We're getting good news over there. Not just autos, but is there anything that you're on the verge of changing in terms of sectoral allocation? Any sector that looks well priced?
So Lata, actually, we're very proactive in managing the portfolio. We always keep looking out for ideas and keep tweaking our portfolios. That's one thing, right? So a change in a date, the change in a date in the year is not going to make a difference to us. We've always been developing a portfolio for the future. That's one thing that I want to clarify. Secondly, if you ask me for the year itself, 25 itself, I think 24, though it started on a really good note, I think the last quarter was the one which really did away most of the gains in the market. But if you look at the overall year, the calendar year, the large cap index, which is NSE 50, I think was up some 8-9% odd. I don't see that to be a problem. I think, in fact, going into this year, maybe 8-9% is the kind of return you may just see. I mean, a high single-digit kind of return from the Nifty 50. The problem, however, will be in the mid-cap and small-cap space. And unfortunately, the mid-cap also has been identified as a market cap game. I mean, come to think of it, I think the mid-cap universe today starts at something like $12 billion. I mean, and I remember when I started covering stocks way back in the 90s, there was hardly any stock at a 12 billion market cap. So today, now imagine mid caps coming. So it's all in your mind right now that this is a mid cap thing. Obviously, I mean, the mid caps are compared to large caps in their own space that they're working in. So you got to be selective in that space too. However, as an index, I don't think that index is going to do the way it did. I think 24-25% kind of returns. And the same is the case going to be with the small cap space. But fortunately for small caps, there's a universe is way beyond the 250. I mean, anything beyond the first 250 is small cap. So the index is just 250 stocks. So you got enough ideas out there. So I think this year is going to be a very selective year. It's going to be clearly a stock pickers market rather than a rising tide lifting all boats.
Dinshaw, Nimesh did this poll, a CNBC-TV18 poll. I'm sure he called you too. And one of the themes that emerged is financials, right? I mean, it's not a surprise, but 39% of them would say that this is the top theme going into 2025. The thing is, the Nifty Bank has underperformed the Nifty in 4 out of the last 5 years. And even last year, same time when we were asking our guests which would be the top sector to bet, it was financials because of relative value. So once again, it's financials, but history is telling us that banks are going through a challenging period and stocks haven't performed relatively.
So Reema, here's the thing. I mean, I was doing my analysis for my portfolio to all of my research team to ask them what we missed and what we got right. So, the top 5 sectors that moved in the last year, calendar year, were probably pharma, real estate, IT, capital goods, and I think autos, right? These were the 5 sectors which really moved. Of these 5 sectors, we were bulk of the time underweight 4 of these. And still, we beat the index for the, I'm talking about my FlexiCap fund, my FlexiCap beat the benchmark for the year by around 11%, right? That's the kind of alpha that we generated. What we did get right, though we didn't get the sectors right, was the picks within the sectors, right? So that is what matters, even in the financial services space. I mean, for the BFSI space. You can't paint all the banks in the same brush. I mean, you saw the RBI's report, right? Most of the banks had strengthened their asset basis. The quality has improved. Obviously, there's been a red flag from the RBI saying that maybe the NPAs will go up going forward in the private sector space. But the fact is that the banks that we've chosen, we've done this kind of a stress test with them that even in the worst of times, did their NPAs shoot up? Were their asset quality always a question? So you got to be careful when you pick a stock within a sector also. So I'm sure there'll be way big winners in the financial services space. And that's how we got to go around picking as such. I don't think PSUs, banks today are going to be a fancy. Private sector will be, but again, as I said, that within private sector, avoid the ones which have disappointed in the past few quarters in terms of asset quality. And the names are obvious. I won't even take those names. You saw that with the declaration of September numbers, some of the banks collapsed 20-odd% because of the asset quality that they had, which was a questionable one. So you got to be careful here. I'll reiterate, it's going to be a stock pickers market, be it the sector or the market itself.
Okay. Now, I take your point. I mean, we just had SBI earlier in the morning speak to us, the SBI Chairman, to inaugurate the new year. His own stock has jumped 23.5% in 2024. Bank Nifty didn't do much. It did 4%. But SBI did well. And in fact, the top 5 gainers, Karur Vysya is up 32%, ICICI 28%, Federal Bank 28%, SBI 23.5%, like I told you, and Indian Bank 22.5%. So, you know, there have been standout performers even in an otherwise flat sector like financials. But Dinshaw, how do you look at the... see, earnings was the disappointment of 2024. Clearly, the second quarter was a shocking quarter of numbers. How do you see earnings growth both in the second half as well as in FY26?
So, Lata, our feel is, I mean, given that, again, the EOSs started way early in December, the end of season sales I'm talking about. So it's obvious that retail is under pressure, right? I mean, that's why this so early in the day, the end of season sales starting off. And once again, you also mentioned that you saw, I mean, you talked to a few people and they were saying that the destination points which were supposed to be filled during the new year were looking quite empty as such. And obviously, I mean, if you I don't know how many of you realize that the yesterday's celebration was quite tepid in terms of the new year that normally is celebrated. So our feel is that December also will be a very disappointing quarter. I don't think December is going to be very different from what September was. In fact, that's what my analysts also tell me. And looking at the advanced numbers, which have been brought out by a few corporates, it's not been that great in terms of consumption. Our feel is that probably March will be the quarter when things will trough out. And that also in the back of a hope that probably RBI, though it started now easing liquidity to an extent, and probably some rate cuts will creep in the Feb policy. Maybe the government in the first of Feb budget will do something for consumption. So the hope is that things will trough out in the month of March. And by the way, let's not forget that there were 48 like weddings in the December quarter. And despite that, it's not been a great quarter. I mean, that's what our feel is. So let's see how it goes. So our feel is that from March onwards, things will start looking brighter. And that also on the back of RBI's actions as such. And obviously a lot depends on the government and the budget this time around. They have to push CapEx, no doubt about that. I think the bulk of the slowdown started with the government cutting back on CapEx and hoping that the private sector will kick in. But looking at the real interest rates, I don't think the private sectors were interested in doing that at that point in time. And I'm sure the onus lies on the government this time around. So these are the kind of caveats that one has to look at.
There was an article, I think the Retailers Association of India said that the growth in the festive period, that's October till early December, was just 7%. And it missed their expectations of a 10% growth. So clearly consumption hasn't picked up, at least not till now.
Just to add a point, and maybe, Dinshaw will know this better. Goan hotels have complained of poor occupancy. I mean, it's just a media article. I don't know the truth about it. But occupancy in Macau has soared 90%. So it could be inflation is making the difference as well. Do you think so, Dinshaw? That things have probably become a little expensive in India.
True, very true, Lata. I know quite a few of my friends who've gone to Oman for celebrating the New Year rather than go to Goa as such. And they found it like, they're saying that they probably conserve 50% of their budget by going to Oman as such. Cheaper flights, cheaper hotels and stuff like that. So I'm sure that is what's worked out. I think the pockets now are feeling the pinch, given that at least the domestic tourism is, given the high rates of occupancy as such. I mean, rather the ERRs as such. So
I know there are videos surfacing online which show that Goa beaches are empty during this peak period, but the Goa tourism minister has pointed out that the 4- and 5-star hotels are operating at nearly full capacity, showcasing Goa as a top destination in India and emerging markets. Well, Nigel's there. We'll wait for him to come back and tell us. But Dinshaw, thank you for joining in and wish you, your family and the entire team at Helios.
Just an addition out here. Sure. That's called the K-shaped recovery. The rich are spending more and the guys who really run the economy are not are feeling the pinch right now. So, but thank you for having me on the show.
Thank you and wish you all the very best. I look forward to more conversations. Get into a break. As always, on the other side, we'll get you a few BTST calls from our technical experts.
were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government capex side, rising welfare spending is becoming a challenge. With the enforcement of the 3% fiscal deficit limit likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. Capex has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state capex is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.67 lakh crore in the first half of FY25 to just 28,300 crore by the end of November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp up in large, lumpy cases.
Welcome back to Closing Bell. It's that time of the trading day, last half hour actually, when we look for buy today, sell tomorrow calls, or even sell today, buy tomorrow calls. And joining us now is our technical expert, Mitesh Thakkar. Mitesh, thanks again, and tell us, any BTST or is it STBT today?
No, I have buy calls. Coromandel, I think, is something which has done extremely well. The stock is trading at the day's high. So BTST here with a stop at 1919 for targets of 1955, and a buy on Lemon Tree Hotels. I think hotels was something which had been pointed out on the show earlier. So Lemon Tree is a buy with a stop at 155 and a target of 170 can be looked at.
Okay. Mitesh, anything in the banking space at all? I mean, it's been yo-yoing like a rubber ball, but is it too volatile to trade?
In all honesty, I think, the Bank Nifty looks slightly weaker than the Nifty if I was to do a strength analysis. Okay. And therefore, I would want to take a short trade. Now, the Bank Nifty already fallen from 53,800 to about 50,800. So, and today we had some pullback. So, I think let this pullback play out and then we'll look at some shorting ideas in the banking and financial space. Though I think, I would suggest some kind of a negative outlook on HDFC, AMC with a disclaimer that I have put option positions over there. So I have negatively biased positions over there. I think as long as the stock is below 43, 15, 20, good chance that 100, 150 point kind of a decline from these levels can happen.
Fair point. Thanks a lot for that, Mitesh. We'll come back to you later on in the trading day if we have time. But for the moment, we are shifting from technical analysis to fundamental analysis. Joining us now is Mayuresh Joshi, Head of Equity Research at William O'Neill. Mayuresh, thank you very much for joining us. First of all, Happy New Year to everyone at William O'Neill.
Thank you so much, Lata. And we are wishing you, the entire team at TV18 and all your viewers, a very healthy, wealthy and a prosperous New Year as well.
Okay. Well, Mayuresh, we are just days away from the start of a fresh earnings season as well. I guess in a week we will get either Infosys or TCS, 9th, as always.
The TCS and Tata Elxsi to kickstart earnings.
Yeah, so just basically, how are you approaching the IT space at all? Are there going to be any better tidings from the IT companies in terms of, hires or in terms of orders?
So, Lata, I think two aspects. One, I think in terms of core earnings itself, the expectation as we went through Q2 numbers, a lot of mid-cap IT companies and select few large-cap IT companies have given a very positive outlook in terms of their revenue guidance in dollar or constant currency terms. Obviously, the rupee depreciation helps to a tad bit. But again, I think there is a steady expectation of earnings growth remaining stable with the premise that pricing should not be an issue for most clients in their existing contracts or new clients that are signing in. The other element in terms of maintenance of the EBIT margins should largely be stable enough for the next few quarters as well. And though traditionally Q3 is a weak and a seasonally weak quarter because of furloughs, what Q4 will bring out in terms of seasonality and in terms of discretionary spending patterns, as far as the North American and European markets are concerned, I think the management's commentaries will probably give heed to that. But our own sense is outside this, what Trump probably does and the expectations in terms of restrictions on H-1B, there was some element of a positive tweet coming through. Positive numbers coming in from Accenture in terms of the guidance revisions as well, makes us believe that the mid-cap IT space is where the momentum can very well continue. Earnings can remain stable, margins can remain stable, and the commentaries can remain very, very positive. So a few stocks like Emphasis, Persistent, Coforge is something that we continue holding onto our global portfolios.
Got that. Mayuresh, actually top of the mind today is autos because the early numbers have come. But before we come to that, one of the banking companies have also announced their third quarter initial business estimates. That's Karur Vysya Bank. Abhishek is here to tell us whether it looks good or bad. Abhishek, Karur Vysya stock has done well. I guess the numbers look good.
Well, one of the lowest NPA in the banking sector. Karur Vysya has the lowest gross NPA ratio, perhaps below SDFC Bank as of Q2 FY25. And they have given a strong business update as well. They have gained market share. At a time when deposits are hard to come by for the sector, their deposit growth in Q3 has been close to 16% YOY and 3.5% on a sequential basis. However, the trend with respect to CASA declining for the entire sector continues with Karur Vysya Bank as well. Their CASA has in absolute value grown by close to 4.3% YOY and has declined by 0.2% sequentially. So the CASA ratio continues to slide down. It is now at 28.4 versus 31.5% on a year-on-year basis comparison and about 29.5% in the previous quarter. Advances growth has remained healthy because the sector itself is seeing slowdown in advances growth. So considering that, the advances growth is healthy at 14% YOY and about 3.2% sequentially. The deposit growth being better, they have lost out on CD ratio. So CD ratio has declined for them to 83.55% versus 84.9% in the same quarter last year and about 83.8% in the previous quarter. So there could be a marginal impact on net interest margin due to the fact that deposits have outpaced the advances growth. Back to you.
Okay, that's very important news. Thank you very much, Abhishek. Especially the credit deposit ratio. In fact, even for the industry, the credit deposit ratio has considerably improved from what it was about 2 quarters ago when RBI was goading all the banks to get after deposit growth, and that led to lower credit growth till they had enough deposit cover. So Mayuresh, on that note, what in the banking sector pleases you?
So we like Karur. So our take is that outside the numbers that Abhishek just spoke about, provisioning is extremely elevated at this juncture. They've got a 96% PCR ratio as we speak. The cost to income ratio is dwindling downwards every passing quarter. And if you probably look at the restructured book, including the net slippages, net NPAs, the SME 1 and the SME 2 book, that's very well under control and coming down as well if you map the last 8 quarters performance as well. Yes, I completely concur with Abhishek. I think there might be a little bit of pressure because of the CASA slowdown that you've seen on NIMs. But generally, I think the business is well poised to grow expansively in the next few quarters. Their credit underwriting, specifically in terms of commercial and corporate banking, has been top-notch. And I think it's been well spread out in terms of the overall risk they are taking in both these segments as well. So I think this remains one of our top picks. ICICI Bank, Lata, within the larger names, the EPS rating, the institution holding is very, very strong on what we map. And therefore, being a very, very strong liability franchise, there can be a steady state growth within the larger banks that ICICI Bank can exhibit. And one of the other names that we're keeping on our watch list is Federal Bank. I think the numbers had been good in the previous quarter. The expectation is, again, asset quality pressure should remain stable and dwindle lower. At the same time, NIMs at around 3.12 should probably consolidate and then probably improve in the next few quarters. The biggest advantage that they've got is the remittances that they probably receive in terms of NRE deposits, which is almost 30% of their overall deposit.
Mayuresh, what have you and your team made of the auto sales numbers for the month of December? What are the key highlights to your mind or trends?
Afternoon, Rima. No, again, so I think autos generally, in terms of OEMs, might go through a consolidated patch in terms of absolute numbers. Our own sense is that M&M probably might stand out within the four-wheeler pack. And obviously, I think the say that they've got in terms of the SUV market share, expectations of more launches coming their way, expectations of the tractor business or the farm equipment business expected to hold up. And on an SOTP basis, the other subsidiaries expected to have a reasonable amount of show. I think M&M probably might stand out for all these factors put together. But generally, I think our own sense is that the next 2 quarters, there might be a little bit of consolidation that might probably happen as far as numbers are concerned. In lieu of competition, pricing might probably also play out in terms of overall growth. And therefore, the combination of all these factors put together makes us believe that Q3, Q4 might be a little bit soft for a large part of the universe. But M&M, in my opinion, within the four-wheeler packs stands out.
Oh. All right, let's move on and talk about Metro Brands, because Motilal Oswal says that this is one of their top picks going into 2025. Upasna's joining in to tell us what is it that Motilal Oswal likes.
Well, that's correct. Motilal Oswal has highlighted Metro Brands as one of its top picks for 2025. It believes that the company has a long runway for growth. Hence, it is given a buy rating on the stock with a target price of 1460 per share. Well, the brokerage says that the stock underperformance has been seen is what we've seen in calendar year FY24, and the underperformance was mainly due to internal and external factors. It has highlighted internal factors of the company such as liquidation of old FILA inventory, which impacted overall gross margins, and also decline in revenue per square feet driven by a lower share of Crocs in incremental store rollouts. Now, coming to external factors, brokerage says that external factors include overall demand weakness seen in the footwear category, leading to such a underperformance. But it believes these are short-term blips and remains optimistic about the long-term growth outlook for the company. It says that the company has a strong runway for growth and healthy ROIC of 30% plus. Hence, it reiterates a buy rating on the stock with a target price of 1460 per share.
Okay, got that. Thank you very much, Upasna. Mayuresh, very quickly, any consumer discretionary, the Metro variety?
So when it comes to footwear, Lata, I think if you probably map out Metro, Relaxo, and Campus Activewear, Metro Brands has a relatively better margin profile compared to the rest of the pack. Obviously, I think the expectations in terms of the inventory issues that plague the whole industry should probably get sorted out, because the timeline have now got extended to a large extent. And therefore, I think the store expansions that are happening in Metro's case shall probably help in the overall earnings growth. But I think Campus might have a good momentum because I think the vertically integrated operations that it has got. And specifically, I think the upper soles and the inner soles and the combination in terms of putting them together is a complete in-house process. And therefore, the SGA market, the sports and athleisure market, which is expected to grow exponentially over the next few years, is a 22,500 crore market expected to grow at a pace of 8 to 10%. And the casual footwear market is 66,000 crores expected to grow at 4 to 5%. So I think the S&A players might just have an upper hand as far as footwear is concerned.
Okay, got that. We have to take a quick break. Mayuresh, do stay on. A bit of a message for our viewers. Good news, I would think. India's business news leader is now only a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from Apple Store or the Google Play Store.
Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, The groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation
Welcome back. Market still with a decent spot of green and about 0.5% gain no matter which index you pick. And like I've been repeatedly saying, we can't take these gains very seriously when we are trading in isolation of global cues. We're practically trading in a vacuum, and perhaps some reality touch will return same time tomorrow. But nevertheless, banking as a sector didn't do much in 2024. But there were some standout performers. One of them was State Bank of India, which the stock rose 23% despite Nifty Bank growing only 4% last year. So we invited the chairman of State Bank of India, Mr. C.S. Sethi, to discuss the 2025 growth outlook. Let's just listen into some of the key takeaways from that conversation.
So I don't think there will be too much cost escalation on the deposits. Obviously, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits? Corporate credit growth essentially is coming from some of the sectors. Obviously, the renewables, roads, some of the petrochemical expansion has also contributed to the credit growth. But I think core sectors, the capital expansion has not been happening, particularly in the steel, cement. I think there's a more of consolidation which has been happening there. Hopefully, one important thing what we noticed is the housing sector is doing well, which means that some of these sectors like steel, cement probably would do better in the current calendar year.
Okay, so those are some thoughts. Mayuresh, we already asked you banking. Let me not throw any more sectors at you. You tell us what would be your top, say, 3 picks or even 5 picks for the first quarter of 25.
So, Lata, I think I covered a few. I think Karoot is something that we continue liking,
Yes.
so I'm not getting into the thesis of that. We're liking Praj Industries as well, because I think it's a complete play in our opinion, not just on making 2G, 3G ethanol plants now, but I think they're completely getting into new fuels. So biomarine fuels as an example, the sustainable aviation fuel is an example, and have actually developed products related to the same. So I think as these products find their way into the domestic and the export markets, a large part of the revenue growth that they have pegged for 2030 might actually get played out. And in my own sense, I think they can deliver those numbers even before 2030. So I think it's a good base case scenario for Praj Industries. Nesco is something that we continue liking at Markets with India. I think excellent EPS rating, strong institution holding, most parameters that we look at it and cancel in. The exhibition business, the IT business, and the food innovator business are all doing extremely well. And my own sense is that both the exhibition part of the business and the IT part of the business should continue growing. They've just utilized 30% of the available land that they probably got in their premises in Goregaon and Mumbai. So there is huge scope of growth in terms of development that can come through. They've got cash, which is almost 15-16% of the overall market cap. Valuations also not too expensive. Last but not the least, I think Apple India, which I discussed last week on the show as well, is something that we continue liking as a proxy to IT and as a proxy in terms of mobile advertising as well. The CPCU model that Apple has clearly in its favor with pricing actually improving in the first half of this year compared to the last few years as well. So again, I think balance sheet growth and earnings dynamics should favor Apple as we head into the next few quarters, supporting the historical 40% top line growth, 40% EBITDA growth.
Okay. All right, we'll leave it at that. Mayuresh, always a pleasure having you with us, and here's wishing you once again a brilliant 2025.
Same to you, Lata. Always a pleasure. Thank you.
Thank you. Okay, so the market's ending with a nice bright shade of green, about 0.5% gain, no matter which index you pick. So let me just pick the Nifty for you and give you the top gainers. The automobile sector has just driven away, speeding away with the gains of the day. The top gainer, Maruti, is up 3%, M&M up 2.5%, and Eicher Motors and Tata Motors are also chipping in with a good 1.5% in terms of gains. Their financiers, which is Shriram Finance, and to some extent maybe more minorly, Bajaj Finance, are the other two winners with about 1.3, 1.2% gains. L&T is a big gainer. That's up about nearly 2%. That's the top maybe 7-8 winners in the Nifty space. Those who haven't done well are, well, to some extent, DRL, Dr. Reddy's and pharma stocks have had a very good 25. So you're seeing perhaps some give back. Hindalco, Adani Ports, ONGC, Tata Steel and Bajaj Auto among the only auto stock that has not done well. That's because two-wheelers, not very flattering numbers as far as the December sales were concerned. Reema, you want to tell us mid-caps, any standouts?
Well, the mid-cap index ends with a gain of 0.5%. The small-cap index up nearly 1%. Positive advanced decline ratio on the way up. Tanla Platforms, very large volumes, 12% gain. Camlin Fine, board meets tomorrow to consider fundraise. SJVN, order win. Suzlon Energy, Reliance Power. So some of these renewable energy themes were active today. IREDA, numbers look good, the disbursement numbers. IRB Infrastructure on the winners list. On the way down, softness seen in Sagility, ITI, which has been a big mover, and Easy Trip to lower by 1%. With that, it's a wrap and closing bell. From the entire team, thank you for watching, but don't go anywhere. Markets Forward is up next.
It's a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance. Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that
Dalal Street extends morning gains. Nifty ends about 23,700. HDFC Bank, L&T, Reliance backed for the bulls. Broader markets rise in line with blue chips.
Bajaj Auto's December sales miss expectations. M&M numbers in line. Tractors see good growth at the cost of Escorts, which see a volume dip.
CNBC-TV18's big market poll of over 60 fund managers reveals that the expectation of equity returns are modest, with most eyeing under 11% returns in 2025. Those polled mostly prefer large caps, believe earnings will be a key stock driver, and RBI will cut rates early in 2025, and the rupee will weaken further. Hello, welcome to a fresh new edition of Markets Forward on CNBC TV18, your go-to show where we aim to get you all the key data points to gear up for the next trading day. Reema, hi, and an interesting day in terms of the market because we did see that recovery coming in.
Indeed, and it's a positive close on day one, so it's a great way to start the new year. Benchmark indices ending with a gain of about 0.4%. The Nifty closer to 23,740, up nearly 100 points. The Sensex surging 370 points. It started off very flat, absolutely flat and unchanged, but things picked up as the day progressed. A better performance for the broader markets, particularly the small cap index, which ended with a gain of nearly 1%, and the advanced decline ratio was positive at 3:1. That said, it was still a low volume languid session, and the Indian markets were trading in isolation because all the global markets were shut on account of New Year's. Sectorally, I think it's only autos which deserves mention. That's the sectoral winner for the day, because largely the December sales, whether it's passenger vehicles, etc., has been pretty good. So autos stood out with names like M&M, Maruti, even Tata Motors, Eicher Motors rallied in trade. Banks moved in line with the benchmark indices with a gain of about 0.4%, but ICICI Bank, IndusInd Bank, HDFC Bank came in for buying. And on the way down, I think it's only the real estate index, which was down over 1%. But other than that, there wasn't too much by way of a sectoral performance.
Absolutely not much there. Real estate as well as Nifty, metal, that's the only one with a slight bit of a decline.
Nifty metal was down like 0.1%, so really is the only one which deserves a mention.
Right? So yes, that's what it was like. But on that note, we will tell you the lineup that is in store for you today. We will start with the top movers and shakers for the day with Hormas, then move on, and auto stocks took the spotlight on the back of December sales data. While other stocks on the radar is Karur Vysya Bank, IREDA, as it surged in trade over its Q3 business update. So stay tuned in as we get you more on that front. But last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But starting up with the segment with Hormas, and Hormas, across to you for the top movers and shakers on the big one.
It was a day that was dominated mostly by auto sales and, of course, the broader market names. There was plenty of stock-specific activity that was seen there. But the larger players, be it the likes of M&M and Maruti, they were the ones that led the show today after the auto sales numbers. Then Escorts and Bajaj Auto, after they reported their numbers, recovered slightly from the lows of the day, because at one point both these names were down up to 3% each. There were a lot of companies that won orders movers in today's session. Power Mech won another order from Adani Power. RITES won an order from Guyana. The stock was up almost in double digits yesterday, and it's seen another move in today's session as well. Indotech also won an order. Kalpataru Projects also, and along with NCC, both of them ending with gains after an order win. Fertilizer stocks were in focus after the announcements made by the cabinet, and most of these names, be it Coromandel, RCF and the likes, ending with gains of anywhere between 1.5% to as high as 4%. There are plenty of other movers in trade today, most of them that saw stocks moving to a 52-week high, the likes of Blue Star, Lemon Tree, Muthoot Finance, Jubilant Foods, and all of these names ended at the highest point of the day, barring Blue Star, and even that stock at one point of time was up almost 6 to 7%, ending at a record high. And lastly, some of the movers in December that were witnessing some profit booking in today's session. Paytm ended lower after a 40% move in the last 1 month. Piramal Pharma ended at the lowest point of the day. Campus Activewear saw a brief spike towards the close of the trading session, and that saw a recovery from the lows of the day, while the others like Prestige Estates and Godfrey Phillips too ended near the day's low. Back to you guys.
Thank you. Let's invite our guests, Mayuresh Joshi, Head of Equity Research at William O'Neill, and Jay Thakkar of ICICI Securities on the show. Gentlemen, thank you. Jay, let me start with you. What have you made of the price action today? Is this a rebound? Because markets had sold off quite a bit in the run-up to today's trading session, and volumes were on the lower side. So would you give any weightage or credence to the kind of up move that we've seen today?
Hi, good afternoon to you, Rima. Well, see, today's up move is more or less coming from a bounce back, I would say, rather, Rima, from quite an oversold territory. Yes, markets are very oversold. If you look at the couple of data points, the most importantly, the FI net long position is, almost to 13 to 14%. So, they are short by 86 to 87%, which is, nearly to oversold, region. Second point is that, majority of these sectors, which are high beta names, Rima, are quite oversold. I would say we have seen huge short positions in all of them, may it be Nifty Auto, Nifty Oil and Gas, Nifty Realty, Nifty Metal. All of this had underperformed Nifty quite a lot in November and December months. And out there, we have seen highest OI that's getting built up in the last couple of months. So, there is a short covering expected out there. Apart from that, the strength is witnessed clearly in defensives, maybe, Nifty Pharma or maybe, Nifty FMCG. So now FMCG is turning back, showing signs of, short covering. So is Nifty Auto. I just hope that if Nifty Oil and Gas also shows that signals or indicates short covering going forward, then after Nifty will be able to move beyond 24,000. So the real strength, Rima, I would say on Nifty will be confirmed about 24,000 levels. If it manages to surpass those levels, maybe tomorrow or day after, because tomorrow being a weekly expiry, the first weekly expiry of 2025. So if it manages to surpass those levels, then yes, it can reach to 24,800, else it might just trade in that range of 23,300 to 24,000 levels.
Okay, right. Mayuresh, good afternoon, and thank you so much for joining in with us. What I also want to know is in terms of Pharma, Nifty Pharma, how are we looking at Nifty Pharma now? Given that we've seen a run-up coming in today, yes, obviously it's been a bit subdued, just a 0.2% gain that we're seeing there for the Pharma index. But overall, anything interesting that you're looking at in the Nifty Pharma front?
Good morning, and a very happy new year to you as well. So I think the pharma sector probably has outperformed to a large extent over the past few quarters, and a few stocks have done exceptionally well, case in point being Lupin. The other stocks like Dr. Reddy's, with a very strong specialty portfolio, is something that can be looked at as well, merely because of the point of biosimilars that they're probably going through at this juncture, and the kind of pipeline that they've probably created. The monetization and the approval of this pipeline, as it happens over the next few quarters, obviously becomes an offset effect for a lot of companies as far as Revlimid is concerned, which will probably go off balance sheets as far as 26 is concerned. So I think Dr. Reddy's is one stock that we're keeping on our radar. The other stock is Sun Pharma. I think very similar to Dr. Reddy's, they've got a huge and a very extensive specialty pipeline created. A few of their drugs are also going to phase 3 trials. And these are very, very niche applications that we're probably looking at. So as these approvals come through and as that core monetization phase starts coming in respect of revenue exclusivity with better margins, I think these companies are poised in a better fashion to probably have a better earnings growth compared to the rest of the pack. So yeah, I think about the larger names, Dr. Reddy, Sun Pharma is something that we're keeping on the list.
Let's talk about autos because that dominated the headline, the auto sales numbers, starting with Maruti Suzuki. This was a standout performer, and here total sales have gone up by nearly 30% on a year-on-year basis. And the growth or the surprise was led by the recovery in the compact or mini car segment, the small car segment. That saw a growth of 29% on a low base. However, for the full year, that's from April to December, small car sales are still down 10%. So it's still weak, but in December, we've seen a recovery and SUV growth has been strong. Bajaj Auto was, I think, the sole, even Escorts. Bajaj and Escorts were the two disappointing numbers. For Bajaj, total sales were down 1.1%. So there's no recovery in domestic two-wheelers, but exports are doing very well for the company. Export sales went up by nearly 70% and is now 50% of the overall portfolio. And even the electric two-wheelers, according to the Vahan market, Vahan data, the electric two-wheeler market share of Bajaj Auto is at 25%. It's the market leader right now. For M&M, and that's the other standout performer along with Maruti, because the company's passenger vehicle sales does well with a growth of about 18%. So SUVs are doing well for M&M again. And even the tractor performance has been robust at 20%. For M&M, the tractor performance particularly stands out because Escorts reported a 10% decline in the tractor sales in the month of December, while Hyundai was a sort of a flattish, subdued year, month. Total sales were down 2.4%, but again, domestic fared a little bit better. Mayuresh, in the auto pack, which one would you bet with? Would you be concerned about the continued weakness that we're seeing in Bajaj Auto's domestic sale? And would you read anything into the recovery in Maruti's small car segment?
Just to answer your question, Rima, I think Bajaj might go through a soft patch. So to that extent, I think really to be seen in terms of both their hybrid vehicle that they've probably launched and expectations in terms of their export sales, how they are shaping up, both two-wheelers as well as three-wheelers. So I think Q3 numbers will put some interesting perspective to that. So I think we'll wait and watch on that one. As far as Maruti is concerned, I think, yes, it was indeed a surprise. But whether this holds on is something to be seen. I think the initial data points that were coming through were cars in excess of 15 lakhs were not seeing any demand pressure. Cars in less of 15 lakhs in terms of a price tag were seeing some sort of a pressure, but it doesn't seem from Maruti's numbers, at least at this juncture. But let's wait and watch. Obviously, this stock remains on our watch list. But as I discussed in the previous show as well, I think M&M, with a very strong performance expected in terms of their SUV sales, expectations in terms of more launches expected to come over the next few quarters. And though pricing and though competition might probably remain as headwinds for the sector as a whole, I think it should be a steady state performance from M&M as far as the SUVs are concerned on the PV side, the tractor side expected to hold up as well. And the other parts of their businesses, including their financial subsidiaries, the overall asset to P value should probably see some element of increase as we head into FY25 as well. So I think M&M stands out. The Maruti stands on the watch list. Within two-wheelers, TVS Motors probably stands out.
Okay. Keeping an eye on the stocks there. Now, on the first day of New Year, Jefferies and Kotak Institutional Equities have announced model portfolio changes. Nimesh is joining with us to give us those details. Nimesh?
Well, 24 was a good year for a lot of the investors, but now going into 25, some influential, strategists have made some changes to the model portfolio. I'll start with Chris Wood first. He wrote a couple of days back. In the Asia ex-Japan long-only portfolio, he's reintroduced HDFC Bank after a long time with a 4% weight. And he's done that by reducing the weight in 4 other companies, which is Macrotech Developers, L&T, ICICI Bank and Axis Bank by 1% each. So that's a big first change that is made to the Asia ex-Japan portfolio. The other important change that is made is adding Siemens India to the Asia ex-Japan with a 4% weight there as well. So that's a change in the Asia Japan. In the India long-only portfolio as well, he has added Siemens India with a 4% weight and he's cut the weight on AU Small Finance Bank. And he's also introduced HDFC Bank with 1% weight in India long-only portfolio by reducing the stake or by cutting the weight in Axis Bank. So that's the large changes which has been done by Chris Wood of Jefferies. Sanjeev Prasad of Kotak has written a note for next year, and he's also made some important changes to the model portfolio. He's reduced ICICI Bank by almost 90 basis points and allocated the same to IndusInd Bank. So given the fact that IndusInd Bank has underperformed so much, there is a bit of change within the financial in that particular name. In the consumer names, he's removed Britannia from that list and also reduced the weight on United Spirits, and that's been added to the likes of Dabur and GCPL. Both these stocks the big underperformers of 24. Within the insurance names, he's removed SBI Life, which has been the best performing insurance name there, and he's allocated that same weight to the likes of HDFC Life and ICICI Pru Life. And finally, he's also increased the weight on Adani Ports. Remember, the stock is sharply corrected in the last few months, and he's added 50 basis points to Cipla as well. So these are the few changes that Sanjeev Prasad has made in his model portfolio. The big takeaway is a lot of the strategies are now adding the underperformers of last year could be as a potential winners for this year, and hence adding to their model portfolios.
Thank you very much for that. Talking about Karur Vysya Bank, that surged after coming out with their business update. IREDA also gained. Abhishek is here with a wrap. Abhishek.
Well, to begin with, IREDA has given strong business momentum this time around. The disbursements are up more than 67% quarter-on-quarter. That helped the loan growth. The loan growth came in at 36.4% YOY and close to 7% sequentially. If you take a look at the disbursements and AUM growth number, it looks like the tenure of the book might have increased. So, disbursements to AUM ratio that I calculate is at 60.5% versus 29% in the previous quarter, suggesting an increase in the tenure of the book. Karur Vysya Bank, they have gained market share, especially the deposit growth is pretty strong over there. Deposit growth is at 15.75% on a year-on-year basis and about 3.5% on a sequential basis. The CASA has been declining for the entire sector. Their CASA absolute growth is about 4.3% YOY and a decline of about 0.2% sequentially. So they have seen their CASA ratio decline both YOY and quarter-on-quarter. Advances growth is healthy at 14% YOY and about 3.2% quarter-on-quarter. Calculation shows that their credit deposit ratio has declined both YOY and quarter-on-quarter. So in terms of the net interest margin, that could come under pressure in this quarter versus the previous quarter. Back to you.
Okay. Net interest margins maybe could come under pressure this quarter versus last quarter. Thanks so much for that, Abhishek. Keeping an eye out on Karur Vysya Bank over there. But Mayuresh, what's your view coming in for Karur Vysya Bank? Looking at the Q3 numbers, anything that you would be looking at here? Is it attractive right now?
So, Vinny, I think we continue liking that. We remain optimistic on this bank. This is one of our picks within the mid-cap private space. Obviously, in addition to what Abhishek just mentioned, the provisioning coverage is at 96%. There might be some compression on NIMs that might come through, but in my opinion, very, very marginal. It should not be a significant decline. And therefore, I think the business mix that they've got, retail business around 25%, a large part of their business stems from commercial and corporate banking, where the credit underwriting has been very, very superior over the past few quarters. And I'm pretty sure they'll continue doing that. And as far as the overall restructured book is concerned, so if you look at the overall restructured book, including net NPAs, which are one of the lowest in the industry at 0.25, along with the SME-1, SME-2 book, which lies at around 0.5, 0.6. My own sense is that the overall ratios are expected to come down even further, along with cost-to-income ratios coming down and a decent capital adequacy, giving it support for superior ROAs of 1.7 and ROEs of 17%. That it boasts about. So yeah, I think we remain very, very optimistic about Karur.
Let's get to some more stock-specific action. Shares of power generation company SJVN gained 6% after it signed an MOU with Bihar government for multiple pumped storage projects. Vivek is here with the details.
Well, that's right. So SJVN remained in focus and was the top gainer throughout the trading session, given the fact that this hydropower company actually yesterday announced to the exchanges that they had signed multiple MOUs. These are for pump storage projects in the state of Bihar. The company, in fact, has committed to investments of close to 10,000 crore rupees in Bihar itself. Now, along with that, the company also gave details of one particular project where they had gone ahead and done the feasibility study. And this particular project is the Hatida Durgavati PSP, which amounts to close to 1,000 megawatt, where the company has 4 units of 250 megawatt each. What is the cost of the project? Close to 5,663 crore. The company anticipates a daily peak energy of close to 6.325 million units, which works out to an annual peak energy of close to 2,308 million units. The levelized tariff appears to be quite high at 9.39 rupees per kilowatt hour. This is something that the company anticipates based on February 2024 levels. Now remember, SJVN operational renewable power generation capacity of close to 2.5 gigawatt, total capacity of 17 gigawatt, taking into account both under construction as well as proposed construction projects that the company has announced.
Thank you very much for that, Jay. Any thoughts on SJVN? Because today you had a big move on large volumes.
Absolutely. In fact, today, yes, Rima, as you rightly said, the volumes were quite high, and the stock technically, I would say, has reversed from quite an important level of 105. Rima, there's not much to read into futures data as it was just recently introduced in December series. However, looking at the options data, it indicates that the levels of 110 to 115 has good amount of call base. So if those levels are taken off, the stock is likely to inch towards 130 as well in this series. 105 is a very crucial critical support, and on the weekly charts, it's quite oversold. So there is a good chance of a bounce back, because on the daily charts, we have already seen the positive divergence coming in the momentum. So 105 on the lower side, it's trading at 111. If there is a chance to go until 130, so I think it's a good risk reward on the long side.
Good risk reward on the long side. That's the word coming in on SJVN. But okay, thank you so much, Mayuresh, as well as Jay, actually, for joining in with us on the show and giving us your views on the markets as well as individual stocks. On that note, we're going to slip into a very short break, but after the break, we'll get you top corporate voices along with the key market events to watch out for on the other side.
The exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports.
Welcome back to Markets Forward on CNBC-TV18. Now let's take a quick look at the key corporate voices we had over the course of the day. First up is SBI. The lender doesn't expect any significant cost escalations on deposits as it renews its focus on deposit mobilization. The management said that post-COVID, it witnessed a significant rise in credit growth, and further, the management expects stabilization in NIMs on regulatory clampdowns on mis-selling of insurance products. Now, the SBI management says that the regulator is likely to take a look at suggestions submitted by the banking industry as well.
Next up is Mazgaon Dock Shipbuilders. The management guides for a 10 to 12% growth in FY25 and FY26. They say the company has seen a certain uptick in their margins while maintaining the 12 to 15% level. Further, they've delivered 5 Scorpene-class submarines. The 6th is yet to be delivered. It is expecting a contract for 3 more such submarines.
Moving on from shipbuilders to healthcare providers, KIMS Hospital expects its revenue to double in the next 2 to 3 years. The hospital chain is looking at adding 2,000 beds in 2025, and it expects growth to improve and revenue to pick up pace due to its recent expansion. The management believes margin will see a decline in the short term, but it expects margins to be at 27% range in the long term.
And before we wrap, we'll bring you some of the key market events to watch out for tomorrow. Upasana is standing by.
Well, it looks like quite an eventful day tomorrow. First up, let me start with the global economic cues. US will be reporting its initial jobless claims. manufacturing PMI data, and crude oil inventory data. Europe will be also reporting its manufacturing PMI data for the month of December, and back home, India will also report the S&P Global Manufacturing PMI data. Now, let us look at the key stocks that we'll be closely watching out for on the back of corporate action. Companies like Camlin Fine Sciences, Dollar Industries, and Balkrishna Paper Mills, all these three companies, board meeting is scheduled for tomorrow for their fundraising plans. And lastly, on the IPO front, Indo Pharma Equipment IPO closes for subscription on 2nd of Jan. So these are all the list of key events that we'll be closely watching out for tomorrow.
Thank you. And that brings us to a wrap in this edition of Markets Forward. We thank you for watching. Hope you enjoyed the show. We'll be back with more news and updates on the other side.
That factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC.
Hello and welcome to Business 360. I'm Shireen Bhan. Here's wishing all our viewers a very happy new year. Hope 2025 is kinder and gentler to us all. Here are the headlines that we're tracking on the first day of the new year. A positive start on the Lal Street. The Sensex gains over 360 points and Nifty up nearly 100. The rupee, though, continues to weaken, ending at a record low once again. Majority of the market participants expect single-digit Nifty returns in 2025, according to an exclusive CNBC-TV18 poll of top fund managers. More than one-third pick financials as the sector to bet on, followed by tech and pharma. Nearly 50% of market participants polled expect the first RBI rate cut in February. Expect the government spending to drive growth in 2025. No one expects GDP growth to cross 7% in FY26. A sober end to what has been a forgetful year for Motown. Maruti Suzuki shines in December as small cars and SUV sales grow. M&M's tractor division sees good growth at the cost of Escorts. Bajaj Auto misses expectations but ends at the top of the E-two-wheeler pecking order with a market share of 25%. The electronic industry calls for simplification of what it calls the most complex tariff regime ahead of the union budget. Also bats for rationalizing the tax on import of components. Sources say electronic exports likely to grow 15% this fiscal, hitting nearly $140 billion. The Defense Ministry declares 2025 as the year of reforms, lists simpler procurement, integrated theatre commands, impetus on emerging technologies like artificial intelligence as priorities. Israel strikes kill 17 people in Gaza on the first day of the new year. Refugee camps are flooded after heavy rains, piling more misery on Palestinians. United Nations says Israeli raids on hospitals have left the healthcare system on the brink. US President-elect Donald Trump reiterates his support for H-1B visas even as his inner circle remains deeply divided. Trump says America needs smart and competent people, adding, "We need a lot of people coming in." Ease My Trip co-founder Nishant Pitti resigns as CEO just a day after failing to find buyers for his 14% shareholding in the block deal window. His brother and co-founder Rikant Pitti take over as the new CEO. Grips, chips, condoms and Eno quick commerce companies make a splash as volumes of orders soar across urban India on New Year's Eve. Zepto, Blinkit and Instamart report the highest number of orders to date. Well, let's begin with the positive start to the new year on the Lal Street. The Sensex gained over 360 points and the Nifty added 100 points today in what was a steady trading session. So that's the story on day one of 2025, 98 points higher on the Nifty. The Nifty Mid-Cap Index added about 250 points and 200 points higher on the Nifty Bank as well. In the money market, though, the rupee continues to weaken. It weakened by 3 paise against the dollar and it now stands at 85.64. That's the dollar rupee for you, and that's the bond yield as far as the bond markets are concerned, also declining in trade, leading to a spike in bond yields. Getting back to the markets, Jefferies and Kotak Institutional Equities have made changes to their portfolio. Kotak has reduced its weight on ICICI Bank and allocated the same to IndusInd Bank. It has removed Britannia from its portfolio and cut the weight on United Spirits. It has instead allocated this to Dabur and GCPL. Finally, Kotak has increased its weight in Adani Ports and Cipla. Let's talk about Jefferies. Jefferies will reintroduce HDFC Bank with a 4% weightage by reducing its investments in macro-tech developers, L&T, ICICI Bank and Axis Bank by 1%. The brokerage firm is also betting on Siemens with a 4% weight by removing its investment in AU Small Finance Bank. So that's the portfolio reallocation there for Kotak and Jefferies. So where is the Nifty headed in 2025 and what should investors expect? Now, we at CNBC-TV18 polled more than 60 fund managers, high net worth individuals and dealers for their outlook on the new year. A majority of them expect modest returns. Financials emerging as the top sectoral pick. Nimesh is standing by now to take us through what the poll is highlighting. Nimesh.
So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks. which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
It looks as if FIs are selling, but they are effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market.
Well, that's the big market call, a fund managers poll of over 60 fund managers and high net worth individuals on how they expect the markets to pan out through the year. Now, it's been a sober end to what has been a largely forgettable year for India's automobile industry. Maruti Suzuki's small cars and SUV sales registered growth in December. M&M's tractors saw steady growth at the cost of Escorts. Bajaj Auto missed street expectations. Reema standing by now to tell us more about the auto sector's year-end performance. Reema, how did we close 2024?
So Maruti stood out, and here it's because the small car segment, which has been under pressure, has rebounded. So Maruti's total sales went up by 29.6%, and here the mini and compact cars have shown a 29% growth, albeit on a low base. That said, small cars are still down 10% for the period of April to December, but in December we have seen a pickup. The SUV growth remains intact for Maruti, up 21%. Bajaj Auto, on the other hand, is a disappointing set of numbers. Total sales are down 1.1%, lower than street expectations, but exports are doing well. The export contribution has now risen to nearly 50%, and it's been steadily rising for Bajaj Auto. And the electric two-wheeler performance has also been very strong and ahead of peers. Vahan data shows that Bajaj Auto is now the market leader with a 25% market share. M&M too has done very well in the month of December, both passenger vehicles and tractor. So passenger vehicle growth has been in line with expectations. Here, it's the SUV segment for M&M, which continues to shine with a growth of close to about 18%, and tractors Tractor growth at 20% is ahead of its peer, Escort, but for Escort, the December tractor sales declined by 10%. For Hyundai, performance is in line with expectation. Total sales are down 2.4%. They acknowledge that things are still challenging. But for Hyundai too, the domestic performance has been better than exports. And for the full year, they've ended with a domestic sales growth of 0.6% for 2024, which is the highest ever.
Rima, many thanks. Now, less than a month to go for the union budget, the electronics industry has called for simplification of what it calls the most complex tariff regime. In a letter to the finance minister accessed by CNBC-TV18, the India Cellular and Electronics Association has called for rationalizing the tax on the import of components. Ashmit is standing by to take us through the specifics of the demands for different categories. Ashmit, what kind of simplification are we talking about?
Well, the first and foremost, the issue that has been highlighted by the ICA is that the current structure, which features as many as 6 slabs, and that's not counting the surcharge, is a complicated one, leads to interpretational issues, leads to confusion, and therefore the solution that has been recommended by the ICA is to have a simpler framework where there are 4 bands in place, 0, 5, 10 and 15%, which will allow for ease in interpretation and therefore give relief to the industry. But this, of course, is a structural reform that the ICA is seeking. On the other count, however, they've sought a number of duty reductions as well within the current existing framework. This is in line with the recommendations that have been coming from the industry that India, when compared to geographies such as Vietnam, Thailand, Mexico, faces a competitive disadvantage with those geographies offering lower duties. So with that in mind, there are various duty reductions that have been recommended by the ICA. Number one, for mobiles, a lot of sub-assemblies and components attract a 2.5% duty that is sought to be brought down to 0. That's one recommendation. For TV manufacturing, to encourage TV manufacturing domestically, locally, within the country, again, there are sub-assembly inputs for open cells, which also attract a 2.5% duty. That is sought to be brought down to 0. Another key recommendation that is made by the ICA is that in 2022 budget, there was a phased manufacturing program introduced for hearables and wearables to attract investments here, to attract manufacturing here. Those incentives that were introduced are expected to clock out by FY26. The ICA is seeking an extension of those benefits, given that the industry is in a nascent stage and requires more support going forward to help build scale. And finally, as far as the auto space is concerned, the car displays, various components of that attract a 15% duty. This again is an opportunity that the ICA bats for and is saying that to actually grow there, to grow manufacturing in that space, again will require incentive with benefits by way of at least a 0 duty structure for enabling more display manufacturing within the country.
All right, Ashmit, appreciate you joining us. Now, electronic manufacturing is expected to clock $135 to $140 billion in FY25. This is a growth rate of 15% in dollar terms and 45% in rupee terms compared to FY24. Sources have told CNBC-TV18 that domestic demand is likely to remain flat this year, and it's also likely to impact total production. Prime Minister Modi set a target of $500 billion in electronic manufacturing by FY30 for the industry. Now, the first Union Cabinet meeting of 2025 has approved new measures for farmers. The government has enhanced the allocation of the Fasal Bima Yojana to more than 69,500 crore rupees. The Cabinet has also cleared extra fertilizer subsidy of nearly 3,900 crore rupees, calling it a one-time special package. The Cabinet also approved setting up an 800 crore rupee fund for innovation and technology. The Tamil Nadu Power Distribution Corporation has scrapped a global tender floated for procuring smart meters by Adani Energy. The state government claimed the company quoted high costs despite emerging as the lowest bidder. This development comes after Gautam Adani was indicted, after the Adani Group was indicted by a US court with fraud and bribery charges in November. That is the latest there in the Adani saga. Moving on, Defence Minister Rajnath Singh has said that 2025 will be the year of reforms for the sector. The Defence Ministry has listed simpler procurement, integrated theatre command, impetus on emerging technologies like artificial intelligence as its priorities. Parikshit is standing by to take us through what the ministry has planned for the year ahead. Parikshit.
Well, the Indian government has been seeing defence as a standout sector in terms of manufacturing and exports. In FY24, we attained a milestone of a record 22,000 crores in defence exports, and the aim is to take this to 50,000 crores in exports by FY29. So there are about 9 or 10 steps that the defence minister has announced, and these are steps where there will be a lot of action in terms of reforms and simplifying the sector. One, of course, is encouraging and bolstering preparedness for jointness and integration of the three services and facilitate establishment of integrated theatre commands. A lot of defense experts have been writing and calling for integrated theatre commands. There will also be more focus on domains such as cyber and space, emerging technologies like AI, machine learning, hypersonics, and also procedures required to win future wars in all these areas. So there will be a reform push and a nudge to the industry as well. Developing a shared understanding of operational requirements and joint operational capabilities through inter-service cooperation and training. Acquisition procedures would be made simpler and time-sensitive to facilitate swifter and robust capability development. This has been a long-standing demand of the industry, and facilitate faster technology transfer and knowledge sharing between the defense sector and civil industries as well. So on the whole, the idea is to bring in more efficiency in the system, have faster technology sharing and knowledge sharing agreements, and make the acquisition process faster as well. Remember, India has a target of achieving 3 trillion in defense production by FY29. Our annual defense production was a record 1.27 lakh crore in FY24, up 16.7% over FY23. So defense continues to be a big priority sector, and this meeting held by Rajnath Singh on New Year's Eve was a step in that direction.
All right, Parikshit, many thanks for joining us. The shares of Ease My Trip under pressure today after the company's CEO Nishant Pitti stepped down on account of personal reasons. His brother and co-founder Rikant Pitti has now been appointed as the new CEO. And this move comes just a day after Pitti failed to find buyers for his 14% shareholding in the block deal window. Hormuz is standing by now with the details. Hormuz, it's getting curiouser. Nishant Pitti had decided to offload his entire remaining stake in the company via that block deal, didn't get picked up. Meanwhile, he's decided to tender his resignation.
Today, the big development that came in earlier this morning was the fact that Nishant Pitti has resigned as the CEO of the company with immediate effect, and he has cited personal reasons for the same. And Rikant Pitti, one of the other co-promoters of the company, has been appointed as the CEO in his place. Now, Nishant Pitti has been on the board of Ease My Trip since 2008, while Rikant and Prashant Pitti, the other two co-promoters of the company, joined the board in 2011 and 2016, respectively. Now, Nishant Pitti has not cited any further reasons as to what led to this resignation. He has only mentioned personal reasons in his resignation letter. But now the top management looks like this. He's resigned as CEO, but he remains chairman. Prashant Pitti remains managing director, and now Rikant Pitti, who was earlier the executive director, now takes charge as CEO and co-founder. Now, Nishant Pitti's, the news, the stock has been that the fact that he was planning to sell 14% stake, but he could only manage to sell 1.4% on Tuesday, while the remaining stake remained unsold. So there is no clarity on what happens to that now. And he had also sold a 14% stake earlier in September and another 3.5% back in June of 2023. So some stake sales from Nishant Pitti there, and his other business interests also have kept the stock in the news, be it partnering with Ajay Singh to bid for Go First and then pulling off out of that bid, the foray into electric vehicles. And some interesting bit is the fact that he has also been a co-producer of a lot of Bollywood films, be it the likes of Fanne Khan of Batti Gul Meter Chalu, or even Manikarnika as part of his branding initiatives. So for now, the big news that has come in, the fact that Nishant Pitti has resigned. There is a new CEO at the helm, but what happens to his remaining stake still remains unclear.
All right, Hormuz, many thanks for joining us. We will head into a short break, but up next, quick commerce companies cash in on the New Year celebrations across urban India. That and more when we get back.
And CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned, and after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth.
India's quick commerce companies made a splash on New Year's Eve as Indians ushered in 2025 with their near and dear ones. There was an inordinate rise in demand for grapes, chocolates, milk and even condoms, Eno and underwear as Urban India planned their party and after party. Shilpa joins us now to tell us how Q-commerce companies celebrated as Indians partied on New Year's Eve. Shilpa.
Well, you know, it's been yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in all their New Year party needs. Apart from the usual party essentials, many interesting items made the list like grapes, condoms, Eno, milk packets and even men's underwear. And these were ordered in huge quantities. Now, across apps. But let's look at Blinkit first. It saw its highest orders in a day, highest orders per minute and per hour as well. And in terms of trends, last night saw the most amount of chips and the most grapes being sold in a day. Now, the biggest order on Blinkit received was from Kolkata for 64,908 rupees. Now, Instamart too saw its highest ever orders, which was the double of last year. And consumers, what were they looking for? milk, chips, grapes, chocolates and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now on Big Basket, orders for things like games, soft drinks, mixers, etc. were up anywhere between 200 to 1300% up. And after 2024 turning out to be the year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025 when it comes to the quick commerce industry. He says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, the second prediction is that this year, quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto gears up for an IPO this year, Palicha says that the capital market environment from private to public will also be very different compared to 2024 and 2023. So from a year of its boom to a true test of its scale in this year, it will be interesting to see how quick commerce evolves in 2025.
Right, Shilpa, many thanks for joining us. That's what India ordered on New Year's Eve via quick commerce companies. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Do stay tuned. We're back in a moment with more.
to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's a big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC TV18.
Let's talk money.
Hello and welcome to 2025's first edition of Let's Talk Money. Let me start by wishing all of you viewers a very, very happy new year. We have been your partners in the wealth creation journey in the year 2024, and the year gone by was a fairly rewarding one. The equity market had a good ride, but investors' patience was also tested by the end of 2024. So what are the lessons that we have learned, and how do we approach our mutual fund portfolios in this brand new year? Well, joining me are two stalwarts of the MF industry with their most dazzling picks for 2025. So they will tell us what to keep in mind and which funds to pick. Let me introduce Feroz Aziz of Anand Rathi Private Wealth and Kaustav Belapurkar of Morningstar India Research. Thank you, gentlemen, for joining in. And let me start by wishing both of you a very, very happy new year.
Happy New Year, Surabhi, and glad to be here.
Happy New Year, Surabhi, and to every viewer who's watching the show.
You know, Feroz and Kaustav, I really want to start with gratitude, as both of you have really helped CNBC-TV18's viewers and investors to make informed choices throughout the last many years, including, of course, in 2024. So I want to start with taking stock of what we really learned in the year gone by. I want your thoughts on some of the major trends that we saw, whether it was the NFO rush or thematic funds, and, you know, how we should reflect on some of these trends, because there was so much going on. Last year, by the way, equity funds were pulling in tons and tons of money. Thematic funds, sectoral funds, they were the ones that were really doing very, very well. So let's begin with what we learned from 2024. Feroz, what did you make of the trends that you saw?
Yes, I think there were some really good trends which can be picked up. The one thing which definitely stands out is the net flow in thematic schemes. Was exceptionally large. It was almost about 140,000 crores of net flow in thematic and sectoral funds, of which 55,000 was NFOs. Is it very healthy? We did a study. If someone were to buy the top 3 asset management companies, all NFOs launched for the last 5 years, would they beat Nifty? The good part is they have beaten Nifty. All the NFOs of the top 3 AMCs. Now let's assume SBI is the top AMC in terms of assets under management. It has launched some tens, 2, 25, 27. If you bought, let's assume 1 lakh rupee in each of them, SBI ne launch kar diya, main kharid raha hu. If this was the decision made, would that beat Nifty or not at a transaction level? The answer is yes, by about 4% per annum. So when NFOs have been used to expand the industry, it used to worry me. After seeing this data, I'm not so anxious. So to answer your pointed question, this is the theme. Thematic and sectoral funds have got a lot of money in it. Second is NFOs have been the theme, but it's not been scary because mathematically it has expanded the industry, got so many new investors, and they've beaten Nifty. I think that's one very important hygiene check for having invested through a mutual fund. That's one trend. The second trend is that the SIP numbers are a reasonable barometer of India doing 2 things. Now, if I see that in conjunction with derivative trading. So because we meet a lot of people on ground, I've done a small little study. When I was in 5 such events, I asked people, how many of you invest in SIP? And I also asked them the question, do you do derivatives? And we found 73% intersection. Okay, this is something which calmed my nerves again, because it's not 2 different people. They are trying to use the derivative space to quench the thirst of the adrenal. At the same time, they're not disrespecting discipline. If it was 2 mutually exclusive sets, the regulator had a bigger problem.
That's really a fantastic insight, actually, Feroz. I mean, that those who are dabbling in F&O and doing all of that funky trading, they're also keeping their SIPs intact. The SIPs are running, so that's heartening to note. Perhaps it's a sign of the maturity of the Indian investor psyche. Kaustav, let me come to you, your views.
Yeah, so I think, Feroz alluded to some of the facts, that in terms of flows, right? I mean, I think it's been a phenomenal year to be an investor, to be an asset manager, because, I mean, we've had a strong year, albeit, volatility has been there, but I think the good part is that, we kind of ended the year strongly. And, I think the most important thing when you look at the flows, right? So when obviously Feroz spoke about the thematics, and maybe we have a slightly different view in terms of thematics, because the color of the money is important in terms of, and that's a great study that the team's done, and perhaps maybe it's an idea for a fund of all NFOs that come out. But like some of the studies we've done in the past, what we found is thematics, given that there are so lumpy in their returns. The timing needs to be impeccable, right? And there are times when investors will pick certain funds based on past returns and it may not really play out. So I think that's one trend I'd want to keep an eye on.
Yeah.
Obviously, the industries look to fill gaps. You know, all the diversified equity buckets are all now kind of already there for most asset managers. So there's the thematics that has come into play. But I think just the pace of thematics that have come about and some of the launches, depending on the more recent performance of those strategies, and they've collected big money, right? We've seen 10, 12,000 in funds that have just recently been launched coming into some of these thematic funds. I think that's something I'd want to keep an eye on. Does every investor understand what they're getting into? I'm sure there are a lot of nuanced investors who know what they're getting into. They want that exposure they're getting into. But, is it for all? That's, I think, a question that I'd want everyone to think about.
The data that we are just putting up on the screen right now, that is really telling a story. And the figure that Feroz also quoted, in 2024, thematic and sectoral funds pooled in the largest chunk of money when you're talking about equity mutual funds. It wasn't the large cap category. It wasn't really small or mid cap funds. It was these thematic funds that, through, of course, a lot of new fund offerings, they kept on pulling in the money. In fact, over 1,40,000 crores came in just through thematics alone. And then, of course, there was a multi-cap category, the flexi cap. All the numbers are on your screen. All of those categories also fared really well. So just to complete the point on thematics, and I completely take your caution on board on this, because I remember, Costa, we did a show on this in the middle of the year as well. And you had pointed out that, thematics need to be handled with care. Take that point. But Feroz, let me come to you in terms of all the major NFOs that we saw this year on the thematic side, on the sectoral side, or even other NFOs. There were so many NFOs. Which are the ones that pass muster with you and the ones that perhaps you think are fit to invest in even now?
See, I think top AMCs launch certain themes at the right time. Okay, I definitely don't subscribe to a thematic or a sectoral fund. In fact, in my model portfolio for the last 11 years, I've not seen one. Only one we've just included, which is SBI Infrastructure. Okay, but coming back to NFOs, I think the energy sector NFOs were timed beautifully, especially the SBI's Energy Sector Fund. HDFC's infrastructure fund was timed not in this calendar year, the year which went by, but that was timed very well. The manufacturing sector NFO of HDFC was also timed very well. So these large AMCs, when they've picked up themes, they've been very, very responsible is what I would say. Okay. The second thing is, why are suddenly so many NFOs, 32 NFOs and 55,000 crores? It is a resultant outcome of something which is a 2018 phenomena. When SEBI said that now you can't have any number of funds in the same category, so every large asset management company has its bouquet full with the flowers which are there. Now, thematic and sector creates an unlimited canvas. After 10 years also, you can keep launching thematics because the theme could be companies starting with the alphabet A. Could be a theme. So thematic gives you a very, very open canvas. And since everybody has finished their NFOs, that's why this is happening. So I personally think that I think I have to give some degree of credit to the large AMCs when they have launched sector or thematic schemes. They have timed them impeccably.
Yeah, absolutely. Feroz, do you still feel that this is a market where it is actually active funds that make more sense? And if at all one wants to dabble with passive funds, what are the questions that we should ask as investors?
It's a myth that passive is simple. Okay, it's a myth, and I'll substantiate that with some data. One is 84% of the total passive universe of AUM is between Nifty and Sensex. So the tail might be long in terms of the number, but the money is concentrated, like Kaustubh Saab said. It's in Nifty and Sensex. Point one. Point two, you have to understand that how are indices created in India? Apart from these factor investing, they are created on a growth style only. Larger the performance, higher the weight, higher the inflow, higher the performance. So it is like when you have a child, chavi ki gudiya hoti hai na. I'm giving a very, very correlatable analogy, but a child's analogy. It's like winding a toy. What has happened in the US? Why are these businesses obscenely valued? Because they are top heavy. They're top heavy. If you're making a passive investing, please remember, you are saying valuation is irrelevant. Because you are not, in a passive index, you're going to be only chasing momentum, at least the way Indian indices, conventional ones, are created. That's one problem. See, Nifty 50, the top 5 stocks have about 38, 39%.
Sure.
If they underperform,
then
their
your
weight
fund
will
will
come down.
underperform.
The
Yeah.
weights will come down in the index. There are 2 review periods of NSE, which is 31st Jan and 31st July. People don't even know that, when there is a rejig.
Yeah.
NSE 500. Now, the second problem is NSE 500, the smallest stock, free float, is not even 3,000 crores. So people might say it's great to invest in NSE 500, but that's the most academic index.
Yeah.
India has 60 lakh crores of mutual fund AUM, 41 lakh crore of equity AUM. Hypothetically, if India decided tomorrow morning, let's move all passive, hypothetically, of course, you won't believe you don't have stock, because the stock is only 2,400 crores.
Yeah.
The amount which it needs to buy, this is a study which completely told us that if you go passive as a country, your supply isn't there to absorb that kind of. And we did a study of which stocks are benefiting from this trend and which stocks actually have a problem with this trend. And that was a very, very interesting analysis.
Okay, got it, gentlemen. Well, the short point is that Feroz is still not convinced of allocating a very large sum of money to passives. The debate continues. But, gentlemen, we've done a lot of theory now. So we have to take a break. We've done the taking stock of the year gone by. Now it is time for action, because after the break, top fund picks for 2025. Which ones should you back? Both Feroz and Kaustubh will give us their top mutual fund ideas in just a bit.
Let's talk money. Let's talk money.
Welcome back. You're watching the New Year special edition of Let's Talk Money. And once again, we wish all of our viewers a very, very happy 2025. Now we have spent some time recapping the key mutual fund trends of 2024. It is now time for action. Which are the funds and maybe even the star fund managers to watch out for in this new year 2025? We have Kaustav Bilapurkar of Morningstar here with us in the studio, as well as Feroz Aziz of Anand Rathi Private Wealth. So now is the hottest part. What viewers really want to know, gentlemen, in terms of what to do, are the funds to track, the fund managers to track. So Feroz, I'm going to come to you first. Let's start by setting some house rules, in place, some ground rules in terms of how we need to evaluate and look at our equity fund portfolio as this new year kicks in. So let's start with the basics.
Yes, Surabhi, I think that's very important. If you're choosing a scheme, first you have to choose a category. Before you choose the category, you have to choose the asset class. So markets become a fundamental pillar or a building block of a mutual fund portfolio. Now, markets are into three parts. We look at it like this, right or wrong, I don't know. Short term, there is a separate barometer. For medium term, market earnings or stock earnings or company earnings will decide medium term, and economy will determine the long term market trend. If you look at the short term barometers, we look at 5 short term barometers, which tells us whether it's time to be very scared or not be too scared. Should we put lump sum or STP? That short-term barometers help us get some clarity. There I would say we are 8 on 10 even on short-term barometers. Out of the 5 barometers, 4 of my barometers are showing that market is not going to show a catastrophic fall. Okay, we can go completely wrong, but that's what it shows. Perhaps we might be right. Now coming to the earnings bit. The perception of earnings being bad is very high. When I'm looking at people, they're cribbing about earnings, but the last quarter Nifty earnings is 8.3% growth. First quarter was 4.3, second quarter was 8. The full year, full half year, well, not full, it's an oxymoron, half year is almost about 6.9% growth. But in the small cap space, last quarter we have seen degrowth. Earnings have been marginally disappointing, not as disappointing, so medium term is okay. Long term, we look at 9 variables, macroeconomic variables, out of that 1 is wrong or 1 is red. So long-term teams is good, medium-term is okay, short-term is safe. So that's what I would say from a market standpoint. Now that this has been the synopsis, if I were a person who has 5-year plus money, if I don't have 70-80% of my money in equity, especially for a mutual fund investor, which is anyways a risk mitigated tool, I would say that I will not be able to beat inflation. So 70-80% in equity is the most important decision. And most people in India don't have that. They iskaan se sunte hain, uskaan se nikal dete.
All right, fair enough. Now, before I get to the choice of the funds, the picks, once again, I just want to focus on the selection process and the whole framework that you need to follow. And Kaustav, I know that you guys at Morningstar did an interesting study in terms of the performance of funds and their future track record. Tell us more about the study.
I think some interesting data that came out of it, right? The first thing we tracked was if I just try to correlate 1-year returns, right? Using the hypothesis that investors, there are a lot of new DIY investors who are making these choices on their own. There are obviously great, advisors and distributors like Feroz and his team who are helping investors make more nuanced choices, but there's a large segment of the industry who are making those choices themselves. And sometimes with the lack of a better alternative, looking at very short-term recent performance and investing.
So basically what you're saying is that we go to the Morningstar website, we check the year, 1-year return, 3-year return, 5-year return, and we see, oh, this fund has done really well for the last 5 years, so it must be a great fund. That's not a good approach.
Not a good approach at all. So what the data showed us was 2 very stark things, right? The first thing was that half the flows, if I just look at 2024, in fact, not even 24, we went back 5 years, and what we looked at was over a 5-year period, if I just look at the monthly flows that came in, 50% of the flows came into quartile 1 funds ranked on a 1-year return. So if I was making a fund choice, I'll look at the past 1-year return. And this is within the diversified equity categories, right? We're not even getting into sectoral and thematics. And 50% of the money came into quartile 1 funds. Another 32% came into funds that didn't even have a 1-year track record. So, newer fund launches and things like that. So think of it this way, more than 80% of your flows are coming into funds that probably have done well recently or have just been launched recently. But the staggering extension to that is when you ran this data as of 2019 to 24. So if I was sitting in 2019 and I picked these quartile 1 funds, how many of those funds sitting in 24 were still quartile 1, right? So out of 10 funds, less than 3 funds still remained in quartile 1, right, on a 5-year time period. So the point that I'm making is that, well, performance can give you a sense of how a fund has done in the past, but it's not necessarily a surety that it's going to continue to do going well ahead, because there are various factors that you need to consider. So performance is good, perhaps way of shortlisting, risk-adjusted parameters, but, don't stop your analysis or base your decision purely based on that. I think that's what the study is resoundingly telling you, that, don't just pick the most recent short-term winner.
Which is really important, because we do need to understand, right, what these other factors are that we must consider. Even if you are taking an advisor or distributor's help to arrive at that fund selection, decision, it's good to have an informed discussion with your advisor and understand what actually you're investing in and whether it makes sense for you or not, right? So what are the other things apart from past performance that we must consider before buying a fund?
Sure. So, when we look at analyzing funds, right, there are 3 things we look at, and so we call it the 3 Ps. So one is the people, the process, and the parent, right? So I'll get into each of these, some pointers that we can look at. So the people is obviously you want to look at who the fund manager is, the track record that they've kind of developed over a period of time. Perhaps if they're a new manager to that asset manager, what's been the track record managing similar strategies in the past. You would want to look at the support costs of them, because, while the manager is doing what they're doing in terms of they're the face of the strategy, there's a dedicated pool of analysts who are delivering that raw material in terms of ideas for them to, consistently kind of, generate that alpha for them, right? You want to see some things like bandwidth, because if a portfolio manager is managing too many strategies of differing types, can they, a person has only X number of hours that they can, he or she can dedicate, right? So how are they kind of, channelizing their time? Do they dedicate enough time for that? Then the second part, which is very important, is the investment process, right? What is the investment process of the strategy, and has it been consistently applied over a period of time? You don't want managers who are extremely fluid in terms of chasing market trends, because you could get it wrong both ways, right? So you want a process that has an edge, right, and is repeatable over market cycles. And there'll be periods where that process could underperform because maybe you have style headwinds. For instance, if you're a growth manager sitting today, you will underperform in a more value momentum driven market. But you stick to your style. That's good, because as growth, as and when it comes back, no one knows when, it will,
your style will work again.
Yeah. And there are a few things you can look at it, right? So you can look at the historical, what you call the style holdings or the size holdings of the manager in terms of how they allocate across market capitalizations between value, growth, and blend stocks. Are they adding too much cash in the portfolio, which could be a challenge with too much money coming in and they don't find enough ideas to deploy? Number of stock holdings, how concentrated or diversified their portfolio. Is that changing over time, right? So you as an investor, you can look at all these data points and actually make a sense of, is it steady state or have things materially changed with the process?
All right, so now that is the framework, and we have understood it completely in terms of the things to keep in mind before we decide to buy into a fund. Now it is time for our guest top fund choices, and there are lots of categories to go over. So we are going to kick it off with the large cap category. Feroz, your picks, best large cap funds for 2025 and why?
Yes, my large cap pick is going to be a reasonably offbeat. Quant large cap is my pick, because in large cap to generate alpha, you have to be courageous, very, very courageous. You can't hug the benchmark like a Nifty or a Sensex and expect to generate alpha. The active weights is what is going to give you the alpha. If you're going to mirror the index, for example, if HDFC is 11% in Nifty, you can't be exactly 11%. Anything more or less is called an active weight. So a quant large cap has this strategy of picking up 17, 15, 18 stocks. In a large cap portfolio, I don't mind concentrating because it's a liquid counter. You can always in 2 hours get out of any of these top 20, 30 Nifty counters. So point one, I would want concentrated bets. I would want high conviction. I would want a smaller scheme so that he can be agile. So it passes that litmus test. And I also want a asset management company which believes not just in fundamentals, also gives 20-30% respect to demand and supply. markets are demand and supply. A stock could be great on fundamentals. It will be at 20 PE for the next 20 years. And there could be a stock which is at 60 PE at half the great fundamentals. So demand and supply, quant respects demand and supply. And Sandeep Tandon has been a treasury guy. And I've looked at his models, how he models risk and demand and supply, which is over and above the fundamentals a fund manager should ideally do in a market like that. And Kaustubh Saab is here. We also subscribe to Morningstar. And they give us a lot of information to understand who's the owner of the stock.
Kaustubh, what about you? What do you guys at Morningstar like in the large cap category?
Yeah, so, for us, and I think, Feroz made a very important point that large cap has become harder and harder to beat the benchmark. And if you're very, very, hugging the benchmark, it's going to be hard to consistently beat. So we have a couple of names that we like, and some of them may be what we visually, when you would look at it, you would say that they're closer to the benchmark. But let me share some theses around that. So one is, it's been an old favorite, the Aditya Birla Frontline. Now, Mahesh is obviously a super experienced manager. I think, from his perspective now, with the overall CIO role, he's kind of managing this particular strategy in entirety and not really got too much else in terms of fund management responsibilities, which is great. So he's got his focus there. While he is benchmark aware, I think he takes active bets in the underlying stock holdings, right? So he'll align sector portfolios in line with the benchmark, close to that, but his stock bets would be pretty active. And secondly, what he does is, because he's valuation conscious, as and when he believes that a stock's valuation's gone up excessively, he will trim some of his long-term holdings and potentially, if it corrects, buy it back. So that adds a potential element of alpha, and it's been a pretty reasonably consistent performer over a long period of time. Right? That's one. I think the other one that we like is the ICICI Prudential Blue Chip. Now, Anish, again, now he runs a slightly differentiated strategy where what we call a barbell approach, right? So ICICI is traditionally always known as a value shop, given Narayan, obviously.
Because of Narayan's.
Yeah. So, but Anish comes from a slightly different school of thought. So obviously they've got a huge dedicated pool of analysts where he can get the ideas from in terms of, fair value of stocks and, what are the potentials for growth. So he will build what we call a barbell approach. So he will at one end buy high growth stocks, probably pay a little bit of a premium valuation, but the other end of the spectrum, he'll also buy fundamentally sound companies that are probably, trading at lower than, the regular valuations could be because of, some negative news or, something that's not baked in. So I think that, again, adds a fair bit of active management within the perspective of large caps. And I think that's another strategy that's done pretty well over, extended periods of time.
All right, gentlemen, we're actually out of time on this particular edition, but viewers, worry not. We have only just gotten started. We've just covered the top large cap fund ideas for 2025. These two gentlemen, they're going to stay on with us because next week we bring you the part 2 of this series where we'll go over all the other categories, the top mid-cap funds, the small-cap funds, the flexi-cap funds, and even the tax-saving ELSS funds that you can pick for the new year 2025. Views from both Morningstar as well as Anand Rathi Private Wealth will continue. So keep your date with us. See you again on Let's Talk Money, same time, same place next week.
Let's Talk Money.
Three, 2, 1, 0.
need is very clear because.
Hello and welcome to News Center. Wishing all of you a very happy new year. I'm Parikshit Luthra. Defence Minister Rajnath Singh has declared 2025 as the year of reforms for the sector. The decision was taken at a high-level meeting chaired by Singh. The minister has said that the focus in the new year will be on new domains such as cyber and space, as well as emerging technologies like artificial intelligence. The broader aim of the reforms would be to make defence acquisition procedures simpler. The reforms will also aim to ensure deeper collaboration among key stakeholders and optimize utilization of resources. The ministry has also said that the reforms will facilitate establishment of integrated theatre commands. Under this model, the government seeks to integrate the capabilities of the three branches of the armed forces. At present, the Army, Navy and the Air Force have separate commands. The welfare of veterans is also on the list of priorities. To take this forward, I'm now joined by Vice Admiral Madanjeet Singh, former Flag Officer Commanding-in-Chief of the Western Naval Command, Rajinder Singh Bhatia, President at the Society of Indian Defence Manufacturers. He's also the Chairman of the Defence Business of the Kalyani Group. We also have with us Arun Ramchandani, the Head and Executive Vice President of L&T Defence. Gentlemen, thank you very much for joining us and wishing all of you a very happy new year. Mr. Bhatia, if I can begin with you. If we speak about this high-level meeting that took place in the Defence Ministry, one of the issues that was prioritized was acquisition procedures, how to make them more simpler, how to make them time sensitive. What has been the industry ask here?
Firstly, Parikshit, a happy new year to you and to all your viewers and listeners. Regarding these acquisition procedures, the issues are actually twofold. One is that acquisition procedures must be time bound, and secondly, they must be in a certain time frame. Now, time-bound will allow the industry to prepare for the orders which need to come in, because then the investments can actually take place in the Indian industry. Secondly, making it time-bound is also important from the point of view of technology obsolescence. If your acquisition cycle is longer than the technology development cycle, the products which you are going to get are not going to be of the state-of-art technology. In the current scenario, where technology is changing so rapidly, and when we are talking about new domains, I think it is paramount that the acquisition cycles become shortened, and hence they will enable the industry to offer products which are state-of-art as far as technology is concerned. Anything else?
Right. That is an important... I will revert to you, sir. I'll come back to you again shortly. Let me also get in Mr. Arun Ramchandani. Mr. Ramchandani, there was a lot of discussion on bringing reforms to facilitate greater preparedness in new age warfare, such as cyber warfare, artificial intelligence, machine learning, robotics, and also having adequate training and preparedness to win wars with these new technologies and new domains. How is the industry preparedness here, and what is the kind of support you need from the government?
So once again, Happy New Year to you and all your viewers. Coming to your question, let's just say that the industry is looking at all of these technologies with a lot of focus, both in the civil domain and in the defense domain. The deployment of these technologies probably is far ahead in the civil domain, and it's good that the government is giving a thrust to deploy these technologies in the defense domain. We are quite geared up to look at deployment of these. In fact, stuff like AI is already finding its way into many of the control software that we write for defense systems. There is a whole ecosystem of startups and new age technology ventures that is being encouraged by the government. And we have various schemes like the IDEX, the Aditi, the TDF, which provides funding for trying out these technologies and deploying them in real life environments, in defense environments. So I think with the thrust on building this ecosystem, with the industry embracing these technologies, it is the right time to put an impetus to create a thrust for deploying these technologies in the military domain. And I would say that we are geared up. These technologies are changing fast. We will have to keep pace with the world as these technologies are deployed in a greater way. We would have to seek a high degree of innovativeness from amongst our people to make sure that we are able to deploy them effectively. And I think India today is well geared up to take advantage of these technology shifts and prepare itself for the wars of the future.
Right. Let me go across to Rajinder Singh Bhatia once again. Mr. Bhatia, when it comes to our defense budget, the allocation for capital acquisition has been going up on a year-to-year basis. What is the kind of capex push for modernization, for acquisition that you're actually hoping for in this budget? And when we want to achieve the aim of becoming an economy which has achieved 3 lakh crore in defense production, 50,000 crores in defense export by FY29, what is the kind of growth in capex that we need on a year-on-year basis?
So, Parikshit, let's take a look at the growth in the defense manufacturing in the country. It has been growing quite well. In fact, if you take a look, last year we were 1,08,000 crores. This year we are at 1,28,000 crores, which shows an increase of nearly 16 to 18%. But if we were to reach 3 lakh crores, which is the target which has been put by the Raksha Mantri, obviously the allocations on the capital side or capital acquisition budget would need to go up by something like 20 to 25%. In my talks with the people and in the ministry, they have always indicated that there will not be any shortage of funds for capital budget in case the requirement of the service is there. But we really need to see this happen. The second part is on the export side. Today we are standing at about 21,000 crores. If we need to really double, we need to, last year we grew almost 32% from where we were. But we need a growth of regular growth of about 25% CAGR or little more if we are to achieve 50,000 crores. Now, exports are not dependent upon capital budget. And in fact, this can fill the deficit in case the domestic budget is not enough to actually fill that void. So one recommendation which the industry has been making is that try to facilitate the exports, because exports will have more than one advantage to the Indian industry. First is that the Indian industry will be able to supply their goods outside the country, but it will also be able to take care of the hacksaw demand, which is always a very important characteristic of defense manufacturing in the country, which means you get one particular order and then for a few years you do not get an order and hence the demand continues to go down. But if you have an export market, then you can fill that voids when the demand is going down by supplying products to other countries. So if you ask what is the industry asking today, industry is asking actually help in exports and whatever reforms we have put into place or what we intend to put into place, operationalization of some of those reforms. And most important in all of this would be that two announcements which were made last year. One was reservation of 25% of R&D budget for the private industry. And secondly was that 1 lakh crores which were earmarked for deep technology development in the country. If both these things are really put into place, I think both these targets are well within the reach of Indian industry.
Absolutely. Let me also go across to former Vice Admiral Madanjeet Singh. Vice Admiral Singh, I would like to ask you about integrated theatre commands. There has been conversation about this since 2021 when the exclusive Department of Military Affairs was set up. Work on establishing integrated theatre commands has been happening since then. Experts have been demanding that this should happen. What do you think have been the hurdles so far? And considering this was the #1 priority in terms of reforms listed out by Rajnath Singh's office for 2025, do you think this will happen?
It should happen. The problem is that there is not a very clear understanding on what exactly you want to, create. And this is within the service as also in the government. This issue of jointmanship has been actually focused upon from 1985. Then we had the post-Kargil task force, and I happen to be a member of that. We went through that in great detail. Now, 25 years later, we are still trying to define what exactly we want to create. And in all the countries where such integration has taken place, one of the net benefits has been reduction in manpower. And this has been flagged earlier too. And whether we want integrated theatre commands or a regional command is also, to the best of my knowledge, there seems to not be adequate clarity. And if you remember, in the countries, big countries with big armed forces, they have been led by the government and not necessarily left to the services headquarters. And well, very prime example is what happened in USA, the Goldwater Nichols. Unfortunately, we don't have those people who have a reasonably clear understanding. When the DMA was created, I think, in my opinion, personal opinion, it was a bit lopsided because we made the CDS a secretary in the Ministry of Defense. The CDS was supposed to be, or is supposed to be, a principal advisor to the government. He does not have an operational role. Now, we started thinking around with what exactly is going to be, created, and he's become a bureaucrat. And so that is not the way.
Right.
I mean, I've been involved in these discussions in the past, and that is not the way. We did away with Commander-in-Chief India in 1952 for good reasons. And in no democratic country do we have a system like that. They report, for example, I'll give you a very quick example of Chairman Joint Chief of Staff of U.S. forces. He has no operational role. He's the principal advisor to the president.
Sir, I just want to bring in another point. Integrated theatre commands, as you've been saying, has been spoken about since 1989. Now, when you speak about defense challenges in 2025 and beyond, one of the reasons why we are spending what we are spending on defense is because we need this for our defense needs. We have a threat from China. We have a threat from Pakistan as well. There is insurgency issues in the Northeast also. Given the threats that India faces at this juncture, what kind of military preparedness or production capabilities we need to have at the earliest? What are the kind of issues in our acquisition process we need to remove for further efficiency?
The acquisition process itself, the first DPP was laid down in 1992. In fact, I happen to be a signatory to that. Since then, we have changed it so many times. Does it make things move fast? No. Our whole system approach, for example, I'll give you a very simple example. Let us take aviation. There are 7 different entities in Bangalore. The HAL being the biggest player, then there, ADA, AD, Semilac, etc., etc. They all have different bosses. They operate through a system of writing letters and notes to each other. It should be a one simple entity, and we should do that. And similarly, between the DRDO, rationalization is far long overdue. There's a committee which has gone into this last year. But I think, to the best of my knowledge, they only tinker around with the small items. The whole system approach, what we are developing, we are not able to produce because the transfer of technology is not taking place. By the way, people are talking about high energy weapons and etc. etc. Now, this project was given by Naval Headquarters to DRDO in 1990. Who's forecasting future technologies? We have to have a system approach, and that is not happening. That is still lacking. And finally, on this issue of defense production, let me just say, unless it is a partnership between the DPSUs and private sector, and essentially led by the private sector, we will not approach the figures that we are talking about. And let us look at not the quantity, let us look at the qualitative aspect of what are we exporting. Why can't we give these targets of defense cooperation or exports to our missions abroad? Other countries do that. We are not doing it. What are the targets given to any mission of ours in a big country?
I think, sir, missions are being involved, but probably they can be involved on a much greater level. At a much greater level.
But we have to give a target. If you've got a country and let us say we've got big partners in Russia, US, France, etc., there has to be a target given to the mission, and it's not to be left to the defense.
We're going to take a... Okay. Admiral Madanjit Singh, we have to take a break. I'll request Rajinder Singh Bhatia and Arun Ramchandani to also be with us. We'll be right back. Don't go anywhere.
Programs announced, Chandrayaan 4 is announced. We have the Bharatiya Antariksha Station building is announced. Mission to moon and landing on the moon is planned. So all of this requires docking. Docking will start from tomorrow onwards. Many processes will happen, but final docking will take place possibly by 7th of January. This is the 99th launch of any launch vehicle from Satish Dhawan Space Center. So that's also very important number. So we are going for the 100th launch and in the beginning of next year.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lending.
Welcome back. You're watching News Center. We still have with us Vice Admiral Madanjit Singh, Rajinder Singh Bhatia of the Society of Indian Defence Manufacturers, and Arun Ramchandani of L&T Defence. Mr. Ramchandani, now when we speak about collaboration between DPSUs, the DRDO and the Indian private sector, how successful has been the partnership so far? Yes, Rajnath Singh has said that this will be one of the areas of reform where we want things to be speeded up. But what's really desired here, and what's been your experience so far?
Well, the government has spelled out its intent, and clearly it's an area of reform. Traditionally, the private sector really had somewhat of a backseat with a lot of nominations of orders going to the public sector. And the government has been progressively changing this. The need for us to work together to exploit the infrastructure that exists across the sectors is something that is important. And it is something that is taking shape. There is a lot of dialogue. There is a good amount of programs where public-private partnership is taking place. In fact, we, for example, at L&T are working on some gun systems with the ordnance factory infrastructure and so on. The collaboration with DRDO has been fairly strong, and DRDO has used private industry as a partner. They have the development cum production partner model, where they induct industry as partners in the development phase to speed up the production phase. And this is something which needs to scale up. Probably the whole, the construct and mindset that the private sector, the process probably is more stringent when contracts are awarded to private sector industry. And that kind of mindset shift where private sector is seen on an equal footing with the defense public sectors in terms of partnerships, in terms of contracts, in terms of speed of placing of contracts. All of this will be great enablers, and it will unleash the power of the private sector to grow the industry.
Right. When it comes to the R&D fund, as Mr. Bhatia pointed out, on deep technologies, on R&D on future technologies, we want the research fund to be operationalized. How far behind are we from countries like China, Russia, United States, which have a much higher defense budget compared to India?
So,
Mr. Ramchandani, that's to you.
Okay, so my take would be that there is really need, because defense is something which has to be government supported. It's a niche technology area. It requires high risk investments in R&D. It has long payback periods, and unless the government supports it, we will lag behind in cutting edge technology. There has been a constant demand that R&D funds need to flow into industry so that industrial R&D can propel growth. The industry has an ability to build new products, to innovate on existing technologies and build new products, and money needs to flow in to support that kind of venture. Long-term, highly futuristic work can be done in government labs, but a lot of the conversion level, moving things from technology readiness levels of, say, 3 or 4 to higher levels can be easily done by the industry, and enough funding needs to go in place for that.
All right.
The government
let me also...
Yeah,
let me also get in Mr. Bhatia on that. Mr. Bhatia, we've got these numbers on our screens. United States, the defense spending was $939 billion in 2024, according to the Lowy Institute. China was $373 billion. Russia was $225 billion. India was $132 billion. And then you have Saudi Arabia. But when it comes to specifically R&D, capital acquisitions, where does India need to step up, according to you?
So, Parikshit, you had asked this question, and let me take it up a little bit on what you asked before. So basically, the technology development in the military parlance is divided into various revolutions on military affairs which have taken place. There was RMA-1 which came up, which was probably missed totally by us. RMA-2, when command-centric warfare came into the country, we were trying to play catch-up. RMA-3 is on us, which means all these so-called emerging and advanced technologies come into place. We are behind many countries in this case, and it is a well-known fact. But going ahead in that particular queue can only happen through breakthrough technologies. If you are going to go with the traditional methods of research and development and innovation, you will still continue to, but catching up is going to be difficult. And that's where the role of the so-called, startups come into the country. We, over the period of last 4 years, there are almost close to 9,000 startups which have registered themselves for defense various challenges, out of which 900 actually have now been successful in one way or the other in developing certain technologies.
Right.
Now, these startups have a way of making you jump that queue. You can come with a breakthrough technology which can give you a jump start into the technology bandwagon, which is what India needs today. So I would say that we need to focus more on developing these breakthrough technologies through startup ecosystem. And that's where that role of that 1 lakh crore, which we are talking about, deep technology funding, becomes extremely important. And let me give you a small caution here. If you see that Technology Development Fund was initially given out in 2007-8 after Kelkar Committee. But to operationalize that fund, we took many years. And finally, when it was operationalized, it was adjunct to the DRDO funding because it was placed under DRDO. Now, when you are talking about research and development funding, I think it needs a separate framework. And that is where I think the thrust should be, so that we can, maybe there can be 1 million startups in defense. And India has the ecosystem, India has the brain power to take this on.
Okay. And finally, sir, what would be your outlook on the full year defense production for FY25 and the exports?
You're asking me again? So,
yes, sir.
Very difficult to answer. I would say that it is looking into the future. The spending, because of the elections and certain reasons, was lacking pace, which you know in your economic predictions, it has already been indicated that the government spending was not up to the mark, and hence certain growth patterns. But I'm sure we are surely aligned to do better than the last year as of today, and we are hoping that we'll do much better than last year.
Okay. So hopefully the defense production and exports will be better than FY24. That's all we have time for. But Mr. Arun Ramchandani, Mr. Bhatia and Vice Admiral Madanjeet Singh, thank you very much for joining us on the program, giving us your outlook on the reforms promised by Defense Minister Rajnath Singh.
Are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25 as well, which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders
we know ended with positive returns, about 8 to 9% on the headline indices, but about 23-24% for the mid and small caps. But the big question is, what's in store for us for 2025? Nimesh has done the most comprehensive market poll, and he joins in to give us the answers. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
We are going to speak to two veteran fund managers about what the year ahead holds for us. Let me welcome our guests for the day. Joining us are two market veterans, Sameer Arora, founder and fund manager at Helios Capital, and Sunil Singhania, founder of Abacus Asset Manager. For starters, what is the philosophy a stock picker should assume? Bhagta hua ghoda ki piche, the one that's already performing for us, the EMSs, the e-commerce, the mid-caps, or do you go to the one that did not perform, the HDFC banks, ICICI banks, Reliances of the world?
So, I think the last 4-5 years have been pretty good, Lata, for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets has done much better. 24 also is similar. If you actually see, Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward, it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in, and valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoon's good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid-caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy the stock. And obviously when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250 you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is, maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed and the markets as well as the economic environment being so dynamic, from time to time one ends up, finding a few bets which you can look out for. So I think at this point of time, what we are trying to do is in our funds, which are like we have an all-cap fund, which is more a mix of large and mid. We have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much better than otherwise. And I think little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like that Jyoti CNC, I think it was 300% or something above issue price. You don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy.